least, while Treasury yields fall amid growing concern around the pandemic. California joins Texas in reaching 1 million infections. And making a statement, President Trump bans investments in firms controlled by China's military. This as U.S. election officials say the vote was the most secure in American history. Welcome to the program, everybody. Happy Friday morning to you. We're just under an hour away until the cash, an hour from the start of the cash equities trading session here for Europe. And we have a kind of mixed picture in futures at this stage. So an hour away from the European trading day, European futures look negative. Yesterday, US stocks dropped, European stocks dropped. All of that to do with concern around the extent to which we might see new lockdown measures in various parts of the United States, really. Now we have a futures picture where Europe is weaker, wanting to play catch up with some of the latter day losses in the United States yesterday, but US futures actually point to the upside, so you can see there. NASDAQ futures in particular, that in itself not a particularly risk-on sign, though, is it? Because some of those NASDAQ stocks have been treated very much like havens, really, during the time of coronavirus. Let's have a look at the GMM and have a look at where we are across a broader swathe of assets. You see some weakness in China there. Interesting to see President Trump then in the last couple of months of this presidency. Then President Trump focusing in on the things he can still act on. China Mobile, China Telecom, both of those falling as a result of a new order from President Trump prohibiting U.S. investment into anything that is Chinese military, and he makes that link there. We'll keep an eye on the stimulus conversation in the United States. That's it. The White House seems to have taken a step back from that particular dialogue. As I said, US lockdowns, though, and the potential for any further tougher measures, certainly a focus for markets. Let's get into that market conversation with Laura Cooper, Bloomberg's Markets Live macro strategist here in Europe. Good to speak to you then, Laura. A lot of focus in yesterday's session on the extent to which the United States might have to introduce tougher measures as we go through the Northern Hemisphere winter. And some pretty alarming commentary coming through. I was looking on the Markets Live blog, one of our colleagues in the US suggesting that risk is on the verge of a meltdown. What are you seeing in terms of the link between the virus and where we trade?
Well, I think certainly the fact that we are seeing these renewed lockdowns come across the U.S. is starting to shift the market narrative away from this vaccine optimism that drove price action earlier this week back to being, could we be in a situation like we saw in March when risk assets sold off on the back of these lockdowns and this wave of infections. But if we look, we can see that, markets largely shrugged off the second wave emergence through the U.S. in the summer. And I think, back in the spring, we did have this impulse from the monetary policy. And so we won't get that again, which is certainly keeping investors nervous. But at the same time, we are going to see these spurts of vaccine progress. So I think that's likely to be enough to support risk sentiment overall and not kind of retest those March lows. But certainly I would expect these bouts of volatility as investors kind of weigh the tug of war between this vaccine optimism for the future and the near-term challenges of fresh restrictions currently.
Yeah, there's going to be interesting to see how markets manage to navigate all of that, Laura, because as you say, there can be sort of medium-term or short to medium-term optimism around a vaccine, but in the very immediate future, a real concern about how the winter develops. So I suppose investors come up with some kind of base case as to how tough the winter will be, and performance against that base case will, through the winter, will be crucial. And that's why a lot of people, I guess, are focused on the extent of lockdown measures to be reintroduced in parts of the US.
Absolutely. And I think, if we look at stringency gauges that kind of point to the degree of restriction, they are in Europe not at the levels that they were back in the spring. So ultimately, the economic contractions that we saw back in Q2 are unlikely to be repeated this time around. And I think ultimately governments want to keep restrictions more localized and not have these sweeping national lockdowns. Now, as of yet, that's not yet proven to be as effective. In the UK, for example, we are seeing that daily case count climb to record highs, but that's too soon, I think, at this stage for kind of markets to pin just that near-term focus on kind of the economic collapse, because we do still have this support coming from central banks. And I think crucially for the U.S., it's going to hinge upon, fiscal gridlock. It's unlikely that we're going to see this near-term stimulus that markets still rely upon. And there is this mismatch between vaccine deployment and the near-term challenges, both on the growth outlook, but certainly for infection.
Now, I must have taken my eye off Bitcoin for a little bit too long, Laura, because it's clearly done something interesting. And I know you've been thinking about this on the Markets Live blog. What could drive Bitcoin to above 20,000? It's currently above 16,000. It's interesting to see it rally through the vaccine news because, I mean, some people don't like Bitcoin at all, but some who do suggest that it is a haven and that it can have some haven properties. Why a haven would rally through the vaccine story is difficult to see, though. So what do you make of the Bitcoin rally?
I think certainly Bitcoin is one of those things that you kind of pops up on your screen once in a while and you think, oh, goodness, what is happening here? So I think it is quite interesting, the fact that, we could potentially see it break above those 2017 record highs. So I think the fact that it has rallied on the back of this vaccine optimism is in part because a lot of retail investors can be used as a proxy for kind of their sentiment. So the fact that they're, renewing, piling in does suggest that, we could see these reflation bets, this reopening trades kind of being priced into that effect. But as well, when we look at kind of the Bitcoin cycles over time, we are in currently the fourth cycle. And so just at the historical cycles in the past, that would suggest that we could actually see momentum build through 2021 before some consolidation is due there. But of course, just given the extent of the rally, 130% up year to date, it is quite a volatile asset. Its intrinsic value can be somewhat questionable, but certainly I think just the fact that it is this proxy for retail, and this point, yes, it is a haven as well. So those two confluence of factors should keep it propelling higher, even though we've seen this blistering rally so far.
Laura, something that I found interesting this morning, I wasn't sure how much the comings and goings at number 10 Downing Street, the advisors in, the advisors out, how much that story was going to feature on investors' radars. It was explained to me yesterday by Ed Evans from our Bloomberg team that depending on who stays, it could set the course for how the government governs in the future, and specifically around Brexit, perhaps. And interesting to see that on the current news flow, on the talk of Dominic Cummings departing by Christmas, we are seeing the pound pop a little higher, perhaps the market then suggesting that this is going to have some impact on the Brexit negotiations.
But I think it is not really that surprising, just given the fact that Dominic Cummings is considered to be quite a hard Brexiteer. So his departure alongside another similar colleague earlier does suggest that, that we could actually see a softening stance in terms of Brexit as negotiations continue into this kind of crunch time. But I think ultimately the fact that we do have these significant gaps remaining, there's limited signs of any kind of near-term breakthrough. And so markets are still priced for optimism in terms of a deal coming through. So yes, we are seeing this knee-jerk reaction, but ultimately I don't think this departure really materially changes the negotiations, just given the tight time frame. And so I would expect that no deal risks are still on the table, and that's not being priced in the markets at this stage. So I would expect that we're going to likely see downside from sterling from here instead of material gains unless we see kind of a deal come through in the coming days.
Yeah, OK. And then there are deals and there are deals, and we'll see what the market makes of that. Laura, thanks so much. Laura Cooper, Bloomberg's Markets Live macro strategist. A reminder, you can join the debate, get involved with the question of the day that they're asking on the Markets Live blog. What could drive Bitcoin to above $20,000? I know some of you have some strong views on this. Reach out to us and the Markets Live team. IB plus TV Go is the function to use on your Bloomberg. Up next on the European market open, don't stop now. The IMF says actions by governments and central banks have put a floor under the world economy. We'll talk about that next. This is Bloomberg.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
They have been here for quite a while. They have obtained the SBF license back in 2016. They've also been granted a license for the virtual bank. They will continue to play an important role in Hong Kong.
Welcome back to the European market open. 12 minutes past 7 here in London, so 45 or so minutes to go until the start of equity trading. This is what the global picture looks like for you right now. Chinese stocks under pressure. Part of that is a global concern around resurgence of coronavirus. Part of that is action taken by President Trump against certain companies in China with a military leaning. Euro Stoxx 50 futures point to the downside. US futures point to the upside, and that's the sort of mismatch we're dealing with, or a fairly flat, actually, US futures. NASDAQ futures do, though, point to the upside. A bit of a mismatch, perhaps, there. Europe needs to play catch-up to some of the losses in the latter part of the US session yesterday. Let's get a Bloomberg First Word News update. Here's Laura Wright.
Good morning, Anna. The US is banning investments in firms it says are owned or controlled by the Chinese military. It's President Trump's latest bid to add pressure on Beijing over what he describes as abusive business practices. Relations between the US and China have deteriorated, with the president vowing to punish Beijing over the coronavirus pandemic. State and federal officials say the 2020 election was the most secure in American history. They see no evidence of deleted or lost votes, or that the election was compromised in any way. It comes as President Trump and his allies continue to make unfounded claims of fraud. Poland is joining Hungary in threatening to veto the EU's recovery fund. That's over the bloc's efforts to make sure funds only go to countries that uphold the rule of law. The EU needs unanimous approval to borrow for the stimulus package. If they manage to block the budget, Poland would lose about 23 billion euros. Hungary would lose about 6 billion. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Anna.
Laura, thanks very much. Laura Wright here in London. The IMF is seeing green shoots of recovery. Managing Director Kristalina Georgieva said actions by governments and central banks have put a floor under the world economy. That comes as the virus ravages the United States. The CDC warned no part of the country is being spared, with California alone passing 1 million cases. Richard Saldana, fund manager for global equity income at Aviva Investors, joins us now. Richard, good to speak to you. So this week has been fairly incredible in terms of the news flow. Just at the beginning of the week, we got the news around the vaccine, of course, and a lot of hope and expectation. Well, there was a lot of expectation and hope, and then we finally saw some concrete progress. The market jumped on that, pivoted to value, sold momentum, sold tech. How did you do through all of that?
Well, you're absolutely right. It's certainly been an incredible week. I mean, for us, we do think this Pfizer-BioNTech trial news that you saw on Monday is a game changer for markets. And I think the moves that you saw on Monday reflect how skewed positioning really has become right now. So you've seen a lot of people sort of sheltering in the work-from-home, stay-at-home names and some of the big tech names that I think you mentioned have almost been viewed as safe havens so far this year, and really shun the areas that we've seen that have been heavily impacted by the pandemic, such as travel and leisure and banks. I mean, the fact that you've seen some of that rotation reverse over the past couple of days, I think just really reflects the fact that the market is really getting to grips with the fact we're in the midst of a large second wave right now. And also, even though obviously the news that we had on Monday was very welcome and really provides the light at the end of the tunnel, I guess, that we've all been looking for, we need to see further data rollouts, and we know there are going to be hurdles in terms of logistics and rollout for these vaccines. So I think that's why you've seen a bit of a retrenchment over the last couple of days. But in our view, we think this rotation that you saw on Monday certainly has legs, and you could see that play out over the coming months.
That's interesting. The rotation has legs, and so where do you see further room for movement in that rotation? How much? I mean, have we made no real indent into the value story? Does it have much further to run?
Well, certainly, if you look at how much the move you've seen in some of these, growth areas of the market, then I'd suggest there could be quite a lot further to run here. I think a lot of it will depend on the the further data points we get out of this trial, and obviously trials from Moderna and AstraZeneca as well. And then as we think going into next year, potential for a fiscal package in the US as well, I think will certainly play on sentiment. But in our view, we do think this could play out, certainly over an extended period. And certainly in terms of sectors that we think are interesting, I mean, financials would be a good example where, we see there's quite a bit of potential upside, potentially, if you do see a return to economic activity. It's a sector that's really, seen a big impact in terms of having to take provisions for credit losses. But we see right now, valuations, are looking attractive here. And, I think if we see a movement in the 10-year yield, and that's one area we're keeping a really close eye on. If you do see a steepening of the yield curve, then I think that really would be the sort of welcome release the financials sector's been waiting for.
And that's something that makes life easier for banks. How do you position then through what could be a very volatile winter, Richard? Do you just set your sights on a portfolio that makes sense on the other side of this, well, shall we say, spring? Do you set your sights on that portfolio and just sit through any volatility in the short term? Because depending on how tough things get through the winter, a portfolio that's positioned for recovery could come a little unstuck in the very short term. How do you approach that?
Yeah, I think in the short term, it's really hard to call right now. I think, as you said, we're in the midst right now of a pretty big second wave. And I think Jerome Powell's comments, I think, are right. Our focus has to be on controlling that and getting, the rises that we've seen in terms of cases and hospitalizations down. But I think as we think, longer term, and particularly as we think going into next year, we expect monetary policy to remain pretty supportive. You've got the prospect of some fiscal stimulus in the US, and clearly there's still quite a big gap to bridge between where the Democrats and Republicans are right now. But I think a fiscal package would be helpful. And then, as I said, the potential for resumption of economic activity, with the caveat of being able to roll out a vaccine. So I think as we sort of think on a sort of let's say 6 to 12 month view, I think that there are reasons to be optimistic. And I think that's where investors need to be focusing on, thinking about some level of normalization playing out next year. But certainly trying to call the next 3 to 6 months is tricky right now. We really do need to get a grip on this second wave.
Thanks very much, Richard. Stay with us. Richard Saldana, fund manager for global equity income at Aviva Investors. He was mentioning the response from some in the central banking world. We'll talk about that next. No silver bullets. The world's leading central bankers warn a vaccine won't solve the economic woes caused by the coronavirus. We'll linger on that topic a little. This is Bloomberg.
The outlook for the economy is extraordinarily uncertain and will depend in large part on the success of efforts to keep the virus in check.
They're torturing themselves to explain that they're there, ready, willing, and able.
The Fed has basically done all it can do, with the exception of extreme emergency measures.
That is certainly good and welcome news for the medium term, although significant challenges and uncertainties remain about timing, production, distribution, and the efficacy for different groups. And from our standpoint, it's just too soon to assess with any confidence the implications of the news for the path of the economy, especially in the near term.
Gradually, as we get more news on the vaccine situation, I hope that not only will it obviously give encouragement and hope, but it will also start to begin to reduce that level of uncertainty over the outlook for the future. Now, we're not really there yet, as Jay has said, but that is important, I think, for monetary policy, because we are having to make monetary policy in conditions of extreme uncertainty.
I don't want to, be exuberant about this vaccination. Because there are still uncertainty about the logistic, about the transportation, about the rolling out, about the fabrication, about the number of people that will be vaccinated in the course of 21, so that we can reach the herd immunity, which will then give us more certainty from the health point of view.
A host of central bankers limiting their exuberance. Christine Lagarde, Jerome Powell and Andrew Bailey there, warning that the possibility of a COVID-19 vaccine isn't enough to end the economic challenges created by the pandemic. Richard Saldana, fund manager for global equity income at Aviva Investors, still with us. And we've talked a little bit about this, haven't we, Richard, about how it's great news for the medium term, but how does it help in the short term? What about central bank support then? You referenced this in our last conversation. Do you expect the ECB to have to do more? Let's take that one as an example, as we head into the winter?
Well, I think it's very clear that, central bankers globally are still going to remain quite supportive. And I think the commentary that we've seen, certainly suggests that. I think for us, the key is also to see, fiscal stimulus as well coming into play here. And I think the US is an area we're focusing a lot on. Clearly, we've there's still quite a big gap, as I said, to bridge right now between where Democrats and Republicans are. But the size of any sort of fiscal package will have pretty significant implications for inflation expectations and the yield curve as well. So, I expect monetary policy to still remain, very supportive. I think there's an understanding that, even though we've had that positive data on the vaccine, it will take time for that to feed through. So, in the meantime, we do expect that backstop to be there. But as I said, we really want to see fiscal stimulus as well coming into play as well to support economies.
So clearly, Richard, the virus is the number one challenge that we're living with at this point. When we look ahead, though, perhaps the challenge of our lifetime, more around the climate agenda. We've heard from all of those central banks, well, many of them on that subject of late as well. So when we think about this other challenge and also the structural pivot and opportunities that maybe this brings, how are you positioning yourselves around the new sort of green agenda? Is it around infrastructure investment for you? Is that one theme that you're jumping on?
Yeah, absolutely. I think climate is one area, particularly, post this US election result, where you could see quite a sea change in policy here. So, there's lots that we think the Biden administration can do within the sort of executive order framework to influence policy there, and rejoining the Paris Agreement would be quite a major step. So for us, I think there's lots of areas where you could see beneficiaries here. Infrastructure you referenced, I think building efficiency. The Biden climate plan outlines the upgrade of 4 million buildings across the US. That would be beneficial for companies such as heating and ventilation companies, air conditioning companies, also companies that are helping on the energy efficiency side. The likes of Siemens, Schneider, and in Europe as well. So there's lots of companies that can really benefit from this. I think the key for us this year is that you've really seen governments step up to the plate here. You've seen the European Union announce a significant roadmap for energy transition. China as well stepping up to the plate, and I think the US rejoining Paris would be a significant step in terms of re-establishing themselves as a key player as well in climate. So
yes,
yeah, absolutely. As I think as we go into next year, lots to focus on that.
And how do you play, Richard? How do you play renewables now? Are you looking for pure play exposure to renewables, or are you looking for businesses that do other things but are moving in that direction?
Yeah, for us, I think you really need to be thinking about the supply chain here. So it's been quite interesting this year. You've seen the pure play names, as you referenced, have done extremely well. So whether it be the names that are tied to wind power or solar power generation. But if you look further down the supply chain and you think about, companies such as cable manufacturers that, are playing a key role in connecting some of these offshore wind farms to the main grid, that's a real area of focus for us. We also think, companies that are helping in terms of improving grid efficiency, helping making the grid more resilient to events, such as forest fires that we're seeing in the US, also have a role to play. So there's lots of areas. It's not just about the pure play names. When you think about the supply chain and the whole ecosystem around renewable generation, there's lots of interesting areas there as well.
Richard, thanks so much for your time. Richard Saldana, fund manager for global equity income at Aviva Investors. Just want to bring you some latest lines coming out of China. The Chinese Foreign Ministry currently giving its briefing, saying that the U.S. executive order harms firms, urges the U.S. to withdraw that executive order, vows to defend Chinese companies' rights and interests. This in connection with the U.S. banning investment in firms it says are owned or controlled by the Chinese military. Up next, we speak to China specialist and author Jonathan Femby about relationships with China. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
I don't believe the renminbi will be a viable reserve currency quickly, but I do believe it'll happen much faster than anybody expects. The question is, what is the storehold of wealth in the meantime?
Give you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
Welcome back to the European market open. 30 minutes until the start of your equity trading session. European futures look pretty negative. US futures look quite mixed, actually. Mixed to positive. Nasdaq futures actually now up by around 0.5%. That's not always a terribly risk-on sign. Oil prices move to the downside. Now, the US is banning investments in firms it says are owned or controlled by the Chinese military. It's President Trump's latest bid to add pressure to Beijing over what he describes as abusive business practices. Trump's executive order says that China is exploiting US capital for its military. Joining us now to discuss is Jonathan Femby, an author, of course, and the chairman of China Research at TS Lombard. We're looking at live pictures, Jonathan, of the Chinese Foreign Ministry briefing on this and obviously pushing back against what we've heard from President Trump overnight. What is the significance, do you think, of this? Is this a sign of what we might get more of this, I suppose, from President Trump in the next couple of months? He can do this kind of action by himself.
Yes, this is part of a steady ratcheting up of measures aimed against China, which I think people in the Trump administration want to get through before the transition in the U.S. at the end of January to a new presidency. And so, other actions are quite probable indeed.
And let me ask you about other points of tension between China and the United States. And clearly Hong Kong has been on that list for a while. I guess we're looking for early signs or continuation of thoughts from President-elect Joe Biden and his approach around Hong Kong. Do you sense any change in strategy from the United States on these points around Hong Kong and on human rights issues with China?
Well, I think there'll probably be a greater emphasis on human rights, which you just mentioned here. And the Biden, certainly, word from his advisors, his team, is that they intend to continue a tough line towards China. But they want to make it a more strategically organized strategy, if you like, bringing in Western allies as well.
Yes, and what can the West do on this subject? I mean, we heard from the UK yesterday criticising the actions in Hong Kong. We're now hearing from the Chinese Foreign Ministry that this UK criticism of China's Hong Kong actions is a double standard in their view. But the UK is critical, the EU is critical. But what can any of these Western countries do if they want to try and influence the way that China
leadership, that is part of an overall political effort to tighten up political control in China, which we've seen in a lot of different areas. And Xi Jinping is looking forward to a long period of struggle, which is the word he uses, with the outside world, and particularly with the United States, which goes everywhere from technology to Hong Kong, indeed, and means that this is a central core element in Beijing's policy, which I don't think it is going to give way on at all, whatever the protest.
Right. So do you have any sense, Jonathan, of the way that China might behave in the months to come as the US is slightly distracted by its own electoral process, perhaps? Do you have a sense of other moves that China might make? Some have suggested that China has done what it's done around the legislative body in Hong Kong at this point because the US is distracted. Does that open the stage for China to take other action? I'm thinking around Taiwan, for example.
Yes, well, the rhetoric on Taiwan has been stepped up, and mainland Chinese military aircraft have been making probing flights in the space over the Taiwan Straits. That will continue, I think, and at the same time China is trying to build up its domestic economy, its technological resources and capabilities, so that it is able to act more and more without any dependence on the external world, and particularly on the United States, what's called de-Americanization, which will be a long process, but we'll see plenty of moves in that direction, and those will no doubt add to the general tension in China-US relations under the future presidency.
But it doesn't sound as if you expect any escalation on Taiwan imminently. Just briefly, Jonathan.
Well, I think that a rhetorical and a probing and perhaps action against some islands in the Strait, but not all-out military action, no.
Jonathan, thanks so much for your time. Good to speak to you. Jonathan Fenby, author and chairman of China Research at TS Lombard, still bringing you, as you saw there, those pictures coming through to us from the Foreign Ministry briefing, talking about a host of issues, points of conflict between China, the US, the UK and Australia. Let's get a Bloomberg Business Flash. Here's Laura Wright.
Thanks, Anna. Disney is rallying after adding more online subscribers than expected last quarter. The entertainment giant is still reeling from the pandemic, but the growth of Disney Plus is softening the blow. It also saw gains at its ABC broadcast network that led to a smaller than expected loss for the quarter. TikTok has won a reprieve on its US ban. The deadline for Chinese parent ByteDance to sell was yesterday, but judges blocked the order. The Commerce Department says it will comply with those rules but is appealing. The proposed sale of a stake in the app to Oracle and Walmart is also in limbo. Goldman Sachs and the New York Stock Exchange expect staffing levels in their New York offices to remain the same until there's a vaccine. About 20% of Goldman staff have worked in the office since September. The bank is up to about 50% in Europe, but that's come down in recent weeks as the pandemic continues to surge. That's your Bloomberg Business Flash. Anna.
Thanks very much, Laura. Laura Wright in London. Quick check on the markets. 23 minutes to go until the start of the cash equity session. Here for Europe and Euro Stocks 50 futures still in the red, down 0.7%. S&P futures, Nasdaq futures points a little higher. Europe has been an epicenter of the pandemic's autumn surge, even if it is now concern around the United States that, at least in the last 24 hours, has been gripping markets. After many European countries enacted new restrictions, including closing non-essential shops, progress is mixed. Joining us now to discuss is Danny Berger. Danny, what do the latest figures show?
Anna, the headline figures certainly still are grim. This week, we saw Italy, France, UK, and Spain all surpass 1 million cases. But in terms of each individual country, there certainly are some differences in patchworks in terms of how they're treating the virus and the effect of that. Both the UK and Germany, we know, have a national lockdown. And that weekly growth, especially for the UK, has more or less plateaued. That 332 million cases on average over the past week is about what we saw before the lockdown. So the fact that we haven't seen an increase of numbers is really the story behind those UK figures, despite some grim milestones we're reaching. The stringency index, I should say, all the way on your right, is a way to judge how strict the restrictions are in these countries. Germany, their weekly growth down a significant amount before they had their lockdowns. That weekly growth figure was something like 80%. Now they're seeing just over 220 cases per million people. Again, that's the 7-day average. Italy, which doesn't yet have a national lockdown, it does have a curfew. Their figures remain higher than some of the other European nations at more than 562 cases per million people over the past week, Anna.
Yeah, of course, we did see a big jump in infection numbers in the UK just yesterday, and so that might take some time to filter into that 7-day average cases per million number, Danny, but worth keeping an eye on that. How is Europe's corporate world then coping with this second wave? Better, one assumes, than the first time around.
Well, it's a case where the first time around, earnings after earnings, companies couldn't give forecasts. They were projecting pretty grim earnings forward-looking. But this time around, it's more uneven. So we see some companies in their earnings projecting more confidence that they would do better. In Italy, Telecom Italia is one example of this. But we have to remember, when it comes to the company's stock benchmarks, you have this weird effect where they're pricing in the future. So in the beginning of the week, we had that vaccine optimism. That starts to wane. As you mentioned, some of those UK numbers not looking great, and some concerns over how logistically the vaccine would be distributed. But again, you see companies like Burberry in the UK beating on their sales estimates. Adidas, though, one of the companies this week to really drag down the German benchmark, saying that because of the second wave, they see a worsening outlook. Anna?
Thanks very much, Danny. Danny Berger with a look at Europe from a number of angles and the way that the virus is playing out. Let's stick with that theme, because up next, Europe's new wave shows signs of cresting, perhaps in some countries at least. New virus cases plateau or begin to ease in Germany and in France. Could restrictions be eased by Christmas? This is Bloomberg.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Well, it's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Trade in China, and of course those two things are related, for sure. Now, I would expect that a Biden administration will be substantially less belligerent in its rhetoric. Firmness rather than belligerence is probably what you would get. And I also expect that some of the things that the Trump administration did on trade, such as declaring that Canada presents a national security risk, might not be sustained. I think, when we talk in 4 years, I think we'll probably identify those two areas as ones in which you could see more continuity in policy rather than less.
That was former Federal Reserve Governor Dan Tarullo on what we can expect from President-elect Joe Biden when it comes to China, something we will continue to revisit in the days and weeks ahead, of course. Let's get a Bloomberg First Word News update. Here's Laura Wright.
Thanks, Anna. Some Republicans in Congress are starting to back the initial steps of a presidential transition. Texas Senator John Cornyn says Joe Biden should start getting presidential-level classified briefings, but he and others are stopping short of recognizing Biden as the winner. President Trump is continuing to make unfounded claims of electoral fraud. Poland is joining Hungary in threatening to veto the EU's recovery fund. That's over the bloc's efforts to make sure funds only go to countries that uphold the rule of law. The EU needs unanimous approval to borrow for the stimulus package. If they manage to block the budget, Poland would lose about 23 billion euros. Hungary would lose about 6 billion. Prime Minister Boris Johnson's top aide Dominic Cummings is quitting. Sources tell Bloomberg he will leave by the end of the year. He's the second key advisor to leave amid tensions over how the Prime Minister's inner circle operates. Cummings has long been a controversial figure in British politics. He was the mastermind of the Leave campaign in the Brexit referendum. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Anna.
Laura, thanks very much. Laura Wright in London. Let's get to your market check then. 15 minutes until the start of European equity trading. And Euro Stoxx 50 futures continue to be negative. US futures look a little more optimistic at this stage, in particular NASDAQ futures. Let's talk about the lockdown measures that we see taken in Europe and in Germany. The IMF is seeing green shoots of recovery. Managing Director Kristalina Georgieva said actions by governments and central banks have put a floor under the world economy, and there's some hope for Europe's worst affected countries. Over the past week, the number of new virus cases has plateaued or fallen in Germany and in France. Joining us now is Marcel Fratscher, DIW Berlin president. Marcel, very good to speak to you. There does seem to be some data suggesting a bit of a plateauing happening in some parts of Europe at this point. How do you view the path through the winter with the virus resurgence, the possibility of extended lockdowns?
Now, as you say, most of European countries are in the midst of the second wave, but many virologists tell us that this might not end before Christmas, but that we have to be prepared for 3 or 4 months of repeated waves and requiring repeated wave breakers. So an intensification of restrictions to prevent the flaring up again of the wave. So if we believe that this is the case for the next 3 or 4 months, this, of course, will be a hard hit for the European economy, which already is the weak spot in the world. So it's a lot weaker than what we see in terms of growth, in terms of activity in most other parts of the world.
And when you think about Germany, when you think about lockdown measures version 2 versus lockdown measures version 1, of course, they're not the same. How much? What is the size of the impact on the economy the second time around versus the first? What's your sort of rule of thumb there?
So far, the restrictions in the second wave are a lot lighter than the first in Germany. For instance, schools and daycare centers remain open. Most shops remain open, which were all closed in the first wave. So this is a big relief, in particular for families. And but still, we estimate that simply in the month of November, The German economy, the companies and sectors most affected, directly affected, so traveling, restaurants and so on, will lose about 20 billion euros in terms of revenue. And this is only for the month of November. The big concern is that companies have been cutting back on investment, that consumers are actually saving more. So even though the German government has been very generous in terms of fiscal stimulus, many people don't consume. So despite the German economy doing better than most other European in terms of the economy, we still expect a contracting German economy by about 1% in the fourth quarter. So we are clearly in a seesaw pattern of the economy, and we simply don't know how long that will last. That really depends on whether the second wave can be ended and we can return to a new normalcy afterwards very quickly.
Yes, it's very easy to find the bad news, isn't it, Marcel? I mean, yesterday we were talking here at Bloomberg about, well, Germany was projecting higher tax revenues despite the toll taken on the economy by the virus. Were you surprised by this? Was this just the forecast was too gloomy the first time around and this was just a correction? I mean, what is the tax and spend situation in Germany like at the moment?
There's hardly any country in the world that has spent more on the economy, on stabilizing the economy than Germany. I think one has to put it in perspective. Yes, the tax numbers, the tax estimates are better than what was feared in the summer. In the summer, we had an economic contraction for Germany of about 8% for 2020. Now we estimate probably a contraction of 6% for 2020. This is a lot stronger than what the world economy is contracting. It's weaker than countries like France, Spain, Italy and UK that are contracting a lot more. But this further revising up of the estimate is really the key factor why now the tax figures have been revised. And it's not that the government is receiving more tax payments. It's simply that the decline, the collapse in tax revenues is a little bit smaller than what we previously estimated.
And what about the need for new debt? What is your thinking at the moment, Marcel, on the need for new debt to get Germany through this? I know you've been critical of the debt brake in the past. What are your thoughts on getting rid of the debt brake at this point?
The debt brake clearly has very strong support in Germany. It is very restrictive. It basically requires the government to run a structurally balanced budget. That has been suspended for this year and also for next year. But the big challenge clearly will be Germany has a very quickly aging society. Working population is declining more rapidly than in almost every other country in Europe. So after this crisis is over, Germany can no longer rely on an economic boom, on a big increase in employment to generate more tax revenues and to reduce debt. Moreover, Germany will have to invest massively in digital infrastructure, in digital transformation, in climate protection, in innovation and education, so that after the pandemic, the big contradiction or big problem is that revenues probably won't be rising as quickly, tax revenues, as they did after the global financial crisis. Public investment will have to be very strong, but yet at the same time, the debt brake requires actually not just a stable deficit, but a balanced budget, and that will be very hard to achieve without substantial tax reform, without substantial tax increases. And I'm wondering whether this will be a key issue in the election debate. Germany will have national elections, federal elections next year, and I think this will be a hotly debated issue. How does Germany want to reduce debt while at the same time be strong on public investment?
Marcel, thanks so much for your time today. Marcel Fratscher, DIW Berlin president. Let me just get back to briefly the China conversation. We're just seeing some lines across the Bloomberg that say that China is congratulating Joe Biden on winning the US election. That is something that we had not seen up to this point. Minutes away then from the market open. Up next, we'll get your stocks to watch, including Rosneft, as the Russian oil giant's return to a net loss undermines its dividend prospects. We'll talk about that and other stocks to watch in the European trading day. This is Bloomberg.
explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe.
Minutes away from the market open, let's get your stocks to watch. Danny Berger joins us for a briefing. Danny.
And look out for Rosneft today. The oil giant in Russia swung to losses in the third quarter. A collapse in oil prices, production, and the ruble hitting the oil giant. This might call into question their dividend, a dividend they've been paying since 1999. Banks also might be active today. We had one of the governing council members, Mattis Muller, from the ECB, emphasizing the need for cheap loans, ultra cheap loans, or the TLTRO program. This would help banks, but of course, banking stocks also might struggle a little bit today with that value trade fading out. Finally, chip makers also might be active today as well after one of the U.S. chip makers, Applied Materials, gave a bullish revenue forecast. Anna?
Thanks very much for that, Danny. So, Danny, there with a look at some of the sectors that we are watching. Carnival Cruises, that's also one that we're keeping an eye on, given the latest news flow surrounding the virus and indeed specifically around that business. So, European equity market futures point to the downside. U.S. futures a little bit more positive, though a lot of that has to do with technology names. We'll see how this last trading day of the week develops. The open is up next. This is Bloomberg. Minutes ago until the start of cash equities trading, here are your headlines. Approach with caution. Jay Powell is joined by Christine Lagarde and Andrew Bailey in warning over economic challenges despite the prospect of a coronavirus vaccine. US cases weigh on stocks. Stocks look set to continue the slide in Europe, at least, amid growing concern around the pandemic. And China congratulates Joe Biden. The move comes as President Trump bans investments in firms controlled by China's military. Really interesting line and timing of that line coming out of Beijing at a time when tensions between China and the Trump administration, at least, are still clearly in view. This is what we have for you in terms of European equity markets. Then we've got an expectation that we will head lower at the start of trade. But as I've been saying, US futures have been pointing to the upside. Not a very risk-on move, though, because it's NASDAQ futures that seem to be leading the way in the United States. But this is what we've got for you on European futures at this point. So let's see how European equity markets managed to open up. Of course, we've been focused very much on the second wave of the virus here in Europe for many, many weeks, for many months, in fact. And it only seemed to be yesterday that in the US, the prospect of second lockdown measures, however limited and however geographically specific, seemed to capture the imagination of US traders. And so that was certainly something that weighed on the US investment story in yesterday's session. To some extent, we have to catch up with that. So European equity markets opening lower as we play catch up, really, with what happened in the US. The FTSE 100 down 0.7%. The CAC 40 down 0.4%. Keep an eye, when you look at the FTSE, keep an eye on what's going on with the pound. The pound a little stronger this morning, 131.62. A lot of comings and goings, and I use that word intentionally. Comings and goings at number 10 Downing Street, it seems, and some further planned before Christmas, and that has pushed the pound a little higher, we are told this morning. Joining us now to talk about where we are on the global risk story, Stephen Major, HSBC Global Head of Fixed Income Research, who's with us this morning to give us his thoughts. Stephen, great to speak to you. So it's been an incredible week, hasn't it? We started the week with the new news around the vaccination, and for many people, that increased their risk appetite. Looking at what you've done to your estimates of where yields go from here, where Treasury yields end this year and next year, I wonder if you're not buying into some of that risk-on vibe that the vaccination created. What are your thoughts?
Well, there's been something for everyone this week, Anna, as you pointed out. For me, these periods of volatility are an opportunity to reset the portfolios for longer-term performance. So in fixed income, we believe we're in a lower for longer rates environment, which means we need to take opportunities to pick up cheap bonds when they come. And I'm talking about taking duration here, and to look at ways of diversifying. So switching across the globe, really, across different parts of fixed income. So this week, we cut our bond yield forecast for 2021 and 2022 to 75 basis points for 10-year treasuries, for example, before they were 100 basis points. And the premise of this is that nothing much is going to happen. Bond yields are going to be in a range of 50 to 100 for the 10-year. If we see the yields at the top of the range, we have to have the strength of our convictions and step up and buy. And that's what happened this week. We had this opportunity. It just so happened to be the vaccine. A few weeks ago, there was expectation of a blue wave. So in the space of 1 month, we've had two big buying opportunities for long bonds.
So does that mean that the fiscal stimulus won't have an impact, the vaccine won't have an impact, because central banks will simply keep a lid on these yields? Is that your expectation?
Yeah. Well, look, there's no doubt that the vaccine is good news for everybody, but valuations of whatever, bonds, equities, FX, must have incorporated to some degree the likelihood of a vaccine in 2021, many vaccines actually. So it just so happens that one of them seems to be ready a bit earlier. But of course, there's still quite a few questions about how this is going to be rolled out. So that is good news. Let's face it, it's good news, but it was partly in the price. And the thing that matters to the bond market is what the Fed's going to do. Is the Fed going to meet in December and change what it said a few months ago, because they've already committed to 3 years at zero and they have an average inflation target. All of this tells me that rates may not be going up for as many as 5 years. So does this vaccine announcement change anything? To me, not really. And if other people think differently, then perhaps that makes an opportunity for me. As regards fiscal policy, yeah, please.
So I was just going to say, so you don't see what the Fed said there as contingent on any vaccine news? Because I'm just looking at figure 1 in your research, which I'm very grateful for, Stephen, which just illustrates how low yields will stay and for just how long. Because even if we stay at the zero lower bound, you say, for 3 years, we only get up to what a yield of 1.47%. This is just illustrating just how low interest rates and yields will stay over a very long period.
Well, let me explain the chart. Our view is that it's the path of the short rate that matters most of all. So the question about fiscal policy, I can take that later. But to me, when we value bonds, it's really about the path of the short rate. And as you move rightwards on the chart, we go from 3 years to 5 years to 7 years at zero as possible scenarios. As you go upwards on the blocks, you change the terminal rate to higher levels. Now, 2.5 is the terminal rate that the last dot plot indicated. So by this, they're saying we're going to stay at zero for 3 years or so, and then we're slowly going to go up to 2.5. And that's how we would value the bond, based on that path of short rates. But to me, 2.5 seems most unlikely, given how the real natural rate is falling and given that the AIT is based on 2%. The maximum I could imagine is 2%. Maybe even 1.5% would be the maximum terminal rate. In that case, the 10-year Treasury is bounded by between 50 and 100. As I say, you have to look at the chart in a way where you go from left to right, 3 years, 5 years, 7 years, and then upwards is based on how high the terminal rate's going to be. Those are the most important criteria for valuing bonds. It's as simple as that.
OK, that's really interesting. Apologies, we weren't able to show that particular chart on air, but that's really interesting. Yeah. And you mentioned your thoughts on fiscal and how you think that ties in. What are your expectations on that front? I mean, many people have limited expectations now, given what the Senate looks to be made up of come January. But what are your thoughts on that?
Well, look, as we're trying to imagine charts, I'll create one in our minds. People tend to think that as the deficit goes up, there's more supply of bonds. So the greater the supply of bonds, they think the more likelihood the price will go down and therefore the yield up. So more supply, higher bond yields. That's what people think. But the empirical evidence of the last 20 years for the biggest bond markets, in the developed markets certainly, shows that it just isn't true. And in fact, the opposite is true. The increasing debt has been associated with lower and lower rates. That's because we can't afford higher interest rates, Anna. So I reverse the causality here. And I say that debt's a policy instrument. And the more of it you have, the lower the rate has to go. Now, it seems to me people don't want to believe this, but I've written a lot about it in the past, and I think that the data has borne me out pretty well this year. If ever there was going to be a stress test of that hypothesis, it was this year. and it seems to have held up pretty well.
Stephen, really interesting stuff. Thank you. Yeah, the real world can be an annoyingly complex beast, can't it? Stephen Major, HSBC Global Head of Fixed Income Research. He stays with us. More thoughts from Stephen shortly. Quick check on what's going on markets for you then. We're down around 0.3% on the Stoxx 600 right now. US futures, though, we're pointing to the upside and actually increasingly so. Nasdaq futures now up by 0.75%. E-mini futures also make modest gains. Coming up, ultra-cheap loans could be the core of the ECB's next stimulus package, according to Estonian Council member Madis Müller. We'll focus on the European Central Bank next. This is Bloomberg.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
It came in better than expected, not only in terms of job creation, but also a sharp fall in the unemployment rate consistent with higher labor force participation. That's really good news.
Overall, the gain was solid, but even while this is a very robust pace of job gains, it's a lot slower than it has been in the summer months.
Great that we saw the job gains we did, but they still are diminished from what they were, of course, back in April and May. And the scarring, the sort of wounds that were created by COVID are beginning to fester.
I would caution people to look at the top line number because I don't think it tells the entire story. Employment relative to population is still well below where we were pre-crisis, and that's because I think that we're going to have some lasting damage.
Depending on what you look at, jobs creation or the unemployment rate, you have different views as to whether the improvement in the labor force is keeping up or slowing down.
That is certainly good and welcome news for the medium term, although significant challenges and uncertainties remain about timing, production, distribution, and the efficacy for different groups. And from our standpoint, it's just too soon to assess with any confidence the implications of the news for the path of the economy, especially in the near term.
Gradually, as we get more news on the vaccine situation, I hope that not only will it obviously give encouragement and hope, but it will also start to begin to reduce that level of uncertainty over the outlook for the future. Now, we're not really there yet, as Jay has said, but that is important, I think, for monetary policy, because we are having to make monetary policy in conditions of extreme uncertainty.
I don't want to, be exuberant about this vaccination. Because there are still uncertainty about the logistic, about the transportation, about the rolling out, about the fabrication, about the number of people that will be vaccinated in the course of 21 so that we can reach the herd immunity, which will then give us more certainty from the health point of view.
Christine Lagarde, Jerome Powell and Andrew Bailey there warning that the possibility of a COVID-19 vaccine isn't enough to end the economic challenges created by the pandemic. Stephen Major from HSBC, Global Head of Fixed Income Research, is still with us. Stephen, good to speak to you on this subject. Let me get into the ECB conversation then. As we look ahead to how the winter will develop, the stresses and strains the European economies will be put under, do you expect the ECB to have to do more here?
Well, they've kind of pre-committed, because in the various statements and press conferences, they've spoken about their preference to do more, and it seems to be clearly steered towards the PEP, TLTRO, forward guidance type of policies, and steered away from the rates. And I think that one thing happened this week was the possibility of them cutting the negative rate even more negative. I think that's been knocked on the head, perhaps helped by the virus, actually, and by developments elsewhere in the world. I think in New Zealand, for example, there was expectation of negative rates, and that's gone away. So it seems to me that it's all pointing towards a bit more of the same, but they want to somehow keep the optionality, because I've also heard various speakers trying to talk about being more creative, because if they become too predictable, then the marginal utility of each step fades, and it has less impact on the real economy.
central banking's turned into a very creative business, hasn't it? And indeed, fiscal stimulus has, Stephen, here in Europe. When we look at the different ways that Europe is trying to raise money at the moment, and then at a European level, we see these Sure bonds and the moves on the recovery fund, and those will be green bonds in a green direction. How do you go about pricing those kind of bonds when you look at all of the various countries that covers? How do you look at this new class of bond from Europe?
Well, this was the game-changing event of 2020, in my opinion, certainly in the bond market. Others might have preferences for other stories, but for me, the common bond issuance, which has come through in the form of the Sure bonds, and then there'll be the next generation EU bonds next year. This completely changes everything. I know there's a tendency to focus on the niggly little details. So I hear this morning Poland and Hungary have some issues, and there are creditor countries that aren't that happy about the fact that they could be paying in. It seems that some countries might be concerned about the stigma of taking the loans. But anyway, these are just details. It's happening. And in terms of pricing, there's already a curve for the ESM. There's already an EU curve, albeit much less liquid than the new bonds from Sure and Next Gen. And then there's the swap curve for Europe, which is a generic measure. And it seems to me that we've got some good reference rates. And over time, these bonds from the European Union in their various guises are going to take over benchmark status. Now, it's going to take a few years, but this is a game changer because it reduces the pressure on individual countries, particularly Italy, for example. And in the longer run, it gives Europe the chance to have a debt instrument that can challenge the US Treasury market.
So how long until the Bund is not the benchmark in the Eurozone, Stephen?
That's going to take a good few years, Anna. These kind of things will take a while. So 750 billion euros is planned of the EU issuance, and I imagine that won't be the end of it. I think that this is not a temporary program. I think that this becomes like a permanent treasury facility in the end, and so it will take way beyond next year, 2022, 2023, until we'll see the benchmark status on bunds chipping away. And that has to be true. Today, 2-year bunds, even after the good news of the vaccine, are about -70. That's 20 below the policy rate. So bunds still have that safety appeal, but it will be gradually chipped away over time. But I think we'll have to give it a few years.
Give it a few years. And so just to finish off then, Stephen, you're bullish on US Treasuries and you're mildly bullish on various other parts of the world. Just give us a sense of where you're diversifying then geographically.
Well, the thing is, this year you've had some great opportunities in fixed income with the benefit of hindsight. And I look at it and I think, well, China bonds have done nothing, although the high yield market's done well, but the government bonds are pretty much the same as they were at the start of the year. Where you've had the return is in the currency. Now the question is whether that might rotate into 2022, whereby it could be the bonds that give you the performance. Chinese government bonds yield well more than 3%. And that's a good source of diversification in a country that has no inflation. And the rates aren't going to be going up. They could be going down next year, possibly. Then there's places like the UK and Canada, which I would see as good surrogates to the Treasury, because the price action and the evolution of yields is very much the same. They're moving in tandem. They have local stories, but they're great sources of alternative duration. Rates aren't going up in these countries. And in EM, we look at Mexico. Just think how different things are today compared to 2016, Anna. 4 years ago, Mexico was right in the sights, and there was all this talk of various actions from the president back then. It's completely different. So now you see the yields move in parallel with the US, and they've got yield. So
Things are very
changed.
different to 2016 in a number of ways, don't they?
Yeah.
Stephen, thanks very much. Stephen Major, HSBC Global Head of Fixed Income Research. Stephen will be continuing his conversation with me on Bloomberg Radio at 9 a.m. UK time, where we will continue to paint pictures of charts in our mind's eye. Very effective process. Let's talk about where we are on these markets right now. European equity markets down by 0.2%. So actually pairing losses here in Europe. The energy sector feeling a little bit of pressure. Oil prices down by 1.2% here, $43 a barrel on Brent. S&P futures do point to the upside. NASDAQ futures point to the upside. Coming up, we will talk about things stateside for a moment. A happier place. Disney shares gained after streaming subscribers jumped last quarter. We'll get the latest on what is happening at Disney next. This is Bloomberg.
We would love, at the right time and the right way to have a digital bank license. We would almost certainly do that in partnership with a strong local partner, and we would use the technology and the experience that we've gained from Mox in Hong Kong.
The outlook for the economy is extraordinarily uncertain and will depend in large part on the success of efforts to keep the virus in check.
They are torturing themselves to explain that they're there, ready, willing, and able.
The Fed has basically done all it can do, with the exception of extreme emergency measures.
Welcome back to the European Market Open. It is Friday morning, 8:22 here in London, and this is a picture for you across the European equity markets. We're down, but not by as much as we were, is the overall message. US futures continue to point to the upside. Oil prices weaker, energy stocks to the downside. Now, Disney jumped in late trading as it reported a smaller than expected fourth quarter loss. The star was Disney Plus, smashing subscriber estimates. Disney's CEO recently shook up the company's management structure to emphasize streaming. He spoke on the company's earnings call.
Despite the many challenges and hardships, I'm proud to say we have been steadfast in effectively managing our businesses under enormously difficult circumstances. We haven't just persevered during these tough times, we've also taken a number of deliberate steps and smart risks that have positioned our company for greater long-term growth.
For more on Disney, Alex Webb, our Bloomberg opinion columnist, joins us now. And Alex, we'll come to some of the more challenged parts of the business in a moment, but let's focus on Disney Plus. Can it take away Netflix dominance in the streaming market?
Well, I think that might actually be slightly the wrong way of looking at it. It's not necessarily about taking away Netflix's dominance. It's about coexisting in a way that gives enough space for both of them. I think people on the whole will have 2, 3, maybe even 4 subscription services. Disney wants to be one of the kind of default options that people take. And it has got, recorded staggering growth inside just a year of itself of being launched. It's totted up almost 74 million subscribers globally, which is a staggering number.
Mulan was a film that premiered on Disney Plus because, of course, a lot of cinemas, a lot of movie theatres were closed, and so the decision was made to do it that way. It had an interesting political baggage that went with it, so maybe not a full test case. But how did it test the straight to Disney Plus formula?
So Disney tried to ascribe some of its difficulties to some of these political considerations. I'm not sure that's entirely the truth behind it. Ultimately, what they did was they said that you had to subscribe to Disney Plus and then pay an additional, I think it was $18 to rent the film, essentially. And it was an experiment which doesn't seem to have worked, but I suppose full credit to Disney for iterating, trying different things, seeing what does work for them. I do think it maybe poses questions about the value of investing in massive, big-budget films to go on these platforms. But there is still, of course, absolutely the argument that Disney needs to invest more across the board in just having more original content for Disney Plus.
And what about the side of the business for Disney that it has been pretty challenged, very challenged by the pandemic, the theme parks division? How is it coping?
Not brilliantly. I mean, they say that they are now running at 35% capacity. One can question the wisdom of that, given the surge in cases, particularly in the US. That clearly is that the theme parks and their broadcast networks have historically been the big money spinner for Disney. That is clearly not the case right now. As my Bloomberg Opinion colleague, Cara LaChapelle, I do recommend that everybody reads her column on the earnings. She wrote that, historically we thought of Disney, and then Disney Plus was the service that came in addition to that. Increasingly, that's being flipped on its head. But Disney Plus is actually the thing that investors are looking at, and everything else, the theme parks, the broadcast networks, the film studio, come in addition to that streaming service.
Alex, thanks very much. Alex Webb joining us to talk about Disney, our Bloomberg Opinion columnist. Covers all things, media in this case, but also technology. Let's have a look at where we are on the markets. Stock 600 then moving to the downside, but off session lows. That's been the theme. In fact, some European equity markets actually into green territory. So the CAC 40 flirting with a flat line. The IBEX in Spain, that's been moving around more than your average, essentially, the European market over the course of this week. And now the IBEX up by around 1/4%. US futures do point to the upside, despite we've got some weakness in the energy sector, essentially, here in Europe, which is pulling things down. We're down by 1.1% on European energy stocks. Up next, Angel Gurria's 15-year stint as head of the OECD is coming to an end. We'll speak next to somebody who would like to take his place. This is Bloomberg.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Welcome back to the European Market Open. 30 minutes into a trading session that is increasingly positive, actually, as we go through it. The Stoxx 600 still just in negative territory, but a lot of that has to do with London, where energy stocks have a heavy weighting and they seem to be weighing things down. The FTSE 100 down 0.6%. Elsewhere, things are improving in Europe as US futures point to the upside. So this is what we have in terms of the way that the session has developed on the screen for the Stoxx Europe 600. Let's get a Bloomberg First Word News update. Here's Laura Wright.
Thanks, Anna. China is joining the growing list of countries congratulating Joe Biden and Kamala Harris on winning the US election. It ends days of speculation about when Beijing would formally acknowledge the victory. President Trump is still contesting the result, making unfounded allegations of voter fraud. Italy's government is asking for parliamentary approval for up to 20 billion euros in extra borrowing. Sources tell Bloomberg Rome wants the funds to cover measures to protect businesses from the new coronavirus restrictions. No official comment yet. Bloomberg earlier reported the monthly cost in Italy could be up to 10 billion euros. Prime Minister Boris Johnson's top aide Dominic Cummings is quitting. Sources tell Bloomberg he will leave by the end of the year. He's the second key advisor to leave amid tensions over how the Prime Minister's inner circle operates. Cummings has long been a controversial figure in British politics. He was the mastermind of the Leave campaign in the Brexit referendum. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Anna.
Laura, thanks. Laura Wright in London. Let's turn to the green agenda. This week, JP Morgan released a new European ETF to track the global carbon transition. Its purpose is to offer equity exposure to an increasingly low carbon world, taking into account both direct and indirect emissions for the companies tracked. The ticker, JPCT, will be listed in London, Milan and Frankfurt. Joining us now is Katie McGee, JP Morgan Asset Management Solutions Investment Specialist. Katie, good to speak to you. And I want to understand a bit more about how this ETF works, because you say you don't want to have to rely on excluding various companies or sectors. So how do you make sure that that this ETF is green enough without excluding things?
Excellent. Good morning, and thank you for having me. I think that's an excellent question, because a very easy way to reduce the emissions of an investment portfolio is simply by excluding the high emitting sectors. But that misses out on a lot of the opportunities that are presented by this transition to a low carbon world. So what do we mean by that? Effectively, when we think about combating climate change, we're going to need to see a reduction in the use of fossil fuels, but also an increase in the use of renewable forms of energy. So our climate change research has really focused in on three key pillars to help us identify the winners and avoid the losers in every sector. So these three key pillars focus first on really what can companies do to prepare themselves for this transition to a low carbon world. The first pillar focuses in on greenhouse gas emissions. So as you mentioned, we look at both direct as well as indirect greenhouse gas emissions and how this has changed over time. Really, how are companies thinking about managing their business for the future in a sustainable way?
So second, does that mean...
Yeah.
If I could just pick up on that then. So in terms of the screening that takes place to get into your ETF, does that mean that if you are the best in your sector, if you are the companies within that sector that are doing most on the climate agenda, you get in, whereas others may be left behind, even if you're in a sector that maybe as a whole is not seeing great for climate?
Absolutely. We invest across all sectors. Climate change is impacting all sectors, and we want to avoid the winners. Invest in the winners while avoiding the losers across every sector. And even in the big high emitting sectors like energy, we're seeing companies make a significant change here. They're really the ones investing in the solutions that we need to see here, investing in renewable forms of energy while changing their own businesses to reduce their carbon emissions.
What have you seen in ESG-related ETFs over the last couple of weeks or so, Katie? Because when we saw the news around the vaccine, a lot of people thought, as the momentum trade dropped away and tech dropped away, that we would also see ESG ETFs drop away because some of them do rely so much on heavy tech exposure. But that didn't seem to be the case. How do you justify this ongoing strength then, or how do you see the ongoing strength of ESG ETFs?
Sure. I think we've seen a very strong support across the industry for sustainable-oriented strategies throughout the year. And I think this is really capturing a much longer-term trend, that we are going to need to see companies transition their business and take advantage of some of the new opportunities coming through in this space. And we expect that trend to play out over the next 3, 5, 10 years. This isn't just something that we expect to go away overnight.
Katie, thanks very much for joining us. Katie McGee, JP Morgan Asset Management Solutions Investment Specialist. Really interesting launch of that ETF, an interesting way to look at green issues. Speaking of the green agenda, don't miss our new show, Bloomberg Green, premiering today on Bloomberg Quick Take and over the weekend on Bloomberg TV to bring you the news, science and data to understand one of the biggest stories of our generation. Market check then. We've got European equity markets, yes, on the back foot, but really that's very much about London. The DAX is flat, the CAC is moderately positive. Peripheral markets in Europe actually make decent moves to the upside as US futures point higher. We're trading in and out of the virus story, it would seem, at the moment. This is Bloomberg.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
We don't have a sort of fixed order of use of tools, and I think that's appropriate. It would always be dependent upon the state of the world and the state of the economy that we found ourselves in.
Welcome back to the European market open. Nearly 40 minutes into a trading session that has been improving as we've been going through it. Still, the FTSE 100 lags behind, down around 0.5%. But we have had something of a move in the pound to keep an eye on, up 1/3% at 131.60. Turning to equality, and the Investment Association is demanding that its portfolio companies reveal the ethnic diversity of their boards, or they'll name and shame. For more, we're joined by Danny Berger. Danny?
Anna, the Investment Association told me that they are putting out a call that they need companies to take more seriously the diversity makeup of their boards and the transparency to keep their investors updated. And the Investment Association has a lot of heft behind it. Its members, it's a trade organization, its members oversee about £8.5 trillion worth of assets. So that's a lot of money that they can really use as leverage to get these companies to comply. But they were disturbed by the fact that 3/4 of FTSE 100 companies in this past AGM season did not report the ethnic makeup and gender makeup of their boards. They say they're ready to call out these companies, give them what's called a red top, essentially a warning to investors that there's issues with equality within these companies. I spoke to the CEO of the trade group, Chris Cummings. Here's what he had to say.
This isn't some kind of nice to do. Actually, we will hold them to account on the plans that they set out in terms of increasing boardroom diversity, and that we'll want regular progress reports. And I don't think in this day and age that's actually too much to ask, whether it's to do with the environment or to do with the really important issues of ethnicity and diversity of company leadership. This is the time to make those changes.
And the CEO there, Chris Cummings, really emphasizing to me that the time is now and companies need to get with the program.
And there's also a report out, Danny, looking at how investors acted when voting for diversity plans at companies. What is the role of investors themselves then in this story?
Right. So investors, ones that are, for example, members of this investor association, they go through a very important proxy vote process. Well, Morningstar studied various votes and found that minority shareholders tend to vote for these various social initiatives put forward to the board. However, the troubling thing here is that increasingly the larger companies, so someone like a BlackRock or Vanguard, are less supportive of some of these measures, and very often they are the deciding vote. They found that Vanguard only supported some of these measures 19% of the time over the past year, and BlackRock only 13% of the time for these various racial inequality votes brought forward to the board. So they're saying that they'll continue to hold more heft as passive becomes more popular. So they're really important here in deciding the vote, Anna.
Danny, thanks very much. Interesting to think about the role of passive funds there. Thanks very much, Danny Berger, with the latest on that diversity agenda. Let's look at the European equity markets then, and Nasdaq futures and US futures also. Let's bring those to you. Down by 0.2% on the Stoxx 600. The FTSE underperforms. It's banks and energy that have been the sectors under pressure this morning. So that's partly the reason we see the FTSE weak, and partly because of the FX moves, of course, as well. But elsewhere, Europe looks a little brighter, and US futures, now the Nasdaq actually in good company. E-mini futures and Dow futures all up by around 0.5%. Now, 10 candidates have been nominated to lead the Organisation for Economic Cooperation and Development. The victor will succeed Angel Gurria, who's retiring as Secretary General next year after 15 years in the job. The US has put forward Christopher Liddell, a top aide to President Trump, but being the single largest contributor to the OECD budget, doesn't offer any guarantees. There is some strong competition, with countries all clambering to get a seat at the head table of global policy negotiations at the G20. 7 nominees hail from Europe. Among them is Michał Korteka. He is Poland's climate and environment minister and joins us now. Minister, good to speak to you. I wonder if you think the fact that your government is threatening to veto the EU Recovery Fund over the rule of law, does that damage your chances of getting the top job at the OECD?
Well, I'm confident we can find a consensus, and we all are aware that the climate challenge is our common challenge. and that somehow we need to address it. And when we are discussing in the context of European Union, but also when we are discussing in the context of OECD countries, there is an overwhelming majority of us thinking that we need to mobilize funding for job-rich recovery after the pandemic. And in this regard, I think we can do all which is possible, whether in European Union or in OECD, in order to create a framework to reach our goals.
Yes, you want to mobilise funding to tackle climate change, as many people do, Michał. That's what Europe is trying to do, and Poland is threatening to veto the EU Recovery Fund over the rule of law. What justifies that stance?
Well, Poland can be one of the biggest beneficiary of the upcoming budget in terms of justice and recovery funds. It is extremely important that we are able to move forward in these directions. We all are aware of the fact that there are some countries which are in a very different position than others. And Poland, with an energy mix inherited from previous Soviet era, is still a country with a very different starting points. We need more resources. I hope that we can find a consensual way and build solidarity among member states. This solidarity could be expressed in the upcoming budget of the European Union. But as you rightly also pointed it out, I'm candidate for OECD top position. And I think that among OECD countries, there is a growing understanding of the fact that at the heart of the recovery process, greening of our economy is central. So I believe, I trust that we can find a way through all these difficulties in a common good.
OK, so will it just it'll take more money then, perhaps, for Poland to sign up to the 2050 neutrality targets that the EU has?
Well, this is a very capital-intensive revolution which is going on. When you are moving from previous ways of producing electricity with gas or coal, and you are moving to renewables such as solar or wind, you are in fact, you need in fact a lot of available and cheap capital. And this part of Europe is unluckily for historical reasons in a less wealthy and in not such a good position as Western European countries. And it is recognized by many. It has been also recognized in the conclusions of the European Council in last December, stating that as European Union, we go for the target of climate neutrality by 2050, and still we recognize that there is one member state which needs additional solidarity and support. When we are speaking right now in the context of OECD, so much beyond European Union's borders, we are thinking about a common goal in Asia and in Americas. And we have recent examples of declarations by Japanese government, by Korean government to reach climate neutrality by 2050. And I believe that it's an opportunity for all of us to put our forces together and to make sure that this climate transition could be at the heart also of the new recovery, which is so much needed in this unprecedented time of the COVID-19 pandemic.
Yes, so much needed. So I go back to the first point I was making. On what basis does Poland block this attempt by Europe to spend more money on climate-related investment? I mean, Poland and Hungary now standing in the way, threatening to veto the EU Recovery Fund. Do you think that's the right course of action?
Well, I think that the budgetary debate inside European Union is a very complicated discussion, and we have seen an example of this. I think all countries recognized 1 year ago the need to increase the Just Transition Fund, for example, and still in July this fund has been decreased. So it's a very complicated, complex discussion between solidarity and integrity of the European Union and interests of member states in these unprecedented, complicated times. So finding a solution is the role of heads of states, and European Council in December will be decisive in this regard.
When you're going for a role with such profile, Minister, the OECD role, does it make you uncomfortable to see the pro-choice, to see the way that your government has handled the pro-choice demonstrations that are taking place around the subject of abortion in Poland? It seems that Poland has settled on a near-total ban on abortion, ruled by Poland's top court. What would you say about that?
First of all, there is a lot going on in Polish politics, but there is a lot going on also all around the world. It's not an easy time for everybody. But I believe that within OECD, we can find a rules-based international economic order, and we can build together conditions under which the recovery process will happen smoothly. I have been myself during my career working relentlessly to build consensus among different parties. I have been COP24 president. I have also chaired IEA ministerial 2019 meetings. And we found compromises there. And I think that this spirit of finding compromise is something that I can bring to the table at OECD. And I hope that we can all together find solutions to crucial, urgent, needed economic, social and industrial and trade challenges which are ahead of us because of the pandemic.
Yeah, I know it's a little away from your remit, Minister, given your climate and environment, and we've talked a lot about that. But given the importance of this near-total ban on abortion and the aspirations you have with the OECD, do you think Poland should stand by this near-total ban on abortion, or should back away from it?
My role in the government is to assure a smooth and socially accepted transition. And this is the first ever created Ministry of Climate here in Poland. And I have presented for the first time an unprecedented also energy policy, which foresees that within the next 20 years we will build a new zero-emission energy system. That's an endeavor in itself. That's a huge task. That's a huge challenge which I'm facing and that I'm driving right now here in Poland. And of course, there are all issues of politics which you mentioned, which are around. But nevertheless, we have to also make sure that we are able to advance as the international community, as OECD, as European Union. And that is my job, and these are my strengths.
OK, Michał, thank you very much. Yes, and we've certainly heard a lot from you around the climate agenda. Thank you very much for bringing us your thoughts on that. Michał Korteka, who is Poland's Minister of Climate and Environment and also wants to lead the OECD, of course, which is why I had a slightly more wide-ranging conversation with him there. We'll be speaking to the current Secretary-General of the OECD, Angel Gurria, shortly here on Bloomberg TV. Don't miss that conversation at 9:30 a.m. UK time. Coming up on the programme, no silver bullets. The world's leading central bankers warn a vaccine won't solve the economic woes caused by the coronavirus. This is Bloomberg.
Give you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
Welcome back to the European Market Open. 55 minutes into your European trading session, and this is where we are. European equity markets on the back foot. US futures increasingly positive. Part of the underperformance in London driven by some strength in the pound attached to comings and goings at number 10 Downing Street. Interesting piece from my colleague Richard Jones on the Bloomberg. He's talking about how some of the selling of havens, the likes of the yen and the Swiss francs, some of that could be premature. And given we've been talking a lot over the last 24 hours or so about the extent to which we might need to see virus-fighting measures in the United States, worth certainly bearing in mind where havens have been going this week and indeed where they continue to go through the winter. That is it for the European Market Open. Stay with Bloomberg TV. Up next, you'll have surveillance. So we'll be speaking, as I mentioned, to the current Secretary General of the OECD, Angel Gurria. He'll be appearing on Bloomberg TV. Don't miss that conversation at 9:30 a.m. UK time. 15 years in the job. 15 years he's been talking about economic cooperation and development and commitment to democracy. We'll see what he thinks about his successor. This is Bloomberg.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
President Trump bans investments in firms controlled by China military. He calls them a national security threat. Beijing congratulates President-elect Biden on his election victory. The pandemic grows in the U.S. California joins Texas in reaching 1 million infections. The CDC says almost no part of the country has a virus under control. And Dominic Cummings is going. Boris Johnson's powerful aide will depart Downing Street. Another round of Brexit talks is likely to end today with little progress. Well, good morning, everyone, and welcome to Bloomberg Surveillance. I'm Francine Lacqua here in London. The focus firmly on the U.S., not only because of the infections, but, of course, because of the transition period and what we could expect over the weekend. Now, the market's looking at the number of infections, also looking at some of the caution we heard from central banks saying, look, the vaccine is not going to be a cure-all. If you look at, what investors are trying to assess, it's, of course, the prospects for additional government stimulus to help economies that have been battered by these coronavirus cases that just keep on going up and up. Treasuries also adding to some of the gains. And then if you look at some of the other things that we're watching out for, the pound edging higher after a report that Dominic Cummings will leave his role as the top aide to Boris Johnson. That would be by the end of the year. Now let's get straight to the Bloomberg. First Word News, here's Laura Wright. Hi, Laura.
Good morning, Francine. The world's top central bankers are warning the prospect of a vaccine isn't enough to end the economic challenges of the pandemic. Fed Chair Jerome Powell, ECB President Christine Lagarde and Bank of England Governor Andrew Bailey used a virtual conference to highlight the risks. Powell says the post-pandemic economy will be different in fundamental ways. State and federal officials say the 2020 election was the most secure in American history. They see no evidence of deleted or lost votes or that the election was compromised in any way. It comes as President Trump and his allies continue to make unfounded claims of fraud. Poland is joining Hungary in threatening to veto the EU's recovery fund. That's over the bloc's efforts to make sure funds only go to countries that uphold the rule of law. The EU needs unanimous approval to borrow for the stimulus package. If they manage to block the budget, Poland would lose about 23 billion euros. Hungary would lose about 6 billion. Prime Minister Boris Johnson's top aide, Dominic Cummings, is quitting. Sources tell Bloomberg he'll leave by the end of the year. He's the second key advisor to leave amid tensions over how the Prime Minister's inner circle operates. Cummings has long been a controversial figure in British politics. He was the mastermind of the Leave campaign in the Brexit referendum. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Francine.
Laura, thank you so much. Now, the U.S. is banning investments in firms it says are owned or controlled by the Chinese military. It's President Trump's latest bid to add pressure on Beijing over what he describes as abusive business practices. Now, relations between the U.S. and China have deteriorated, with the president vowing to punish Beijing over the coronavirus pandemic. Let's get straight to Enda Curran, Bloomberg Chief Asia Economics Correspondent. Enda, great to have you on a day like today. What's the significance of Trump's comments here?
Well, good morning, Francine. It does suggest that the current administration hasn't yet finished with its aggressive stance towards China. The executive order overnight said that China is increasingly exploiting American capital to develop its own military. And the order prohibits investment firms and pension funds from buying and selling shares in 20 Chinese companies that the Pentagon has considered to have military ties. And we saw a reaction in the markets today. We saw the shares of top Chinese firms, including China Mobile and China Telecom, sell off. China Mobile has dropped 6.3% in Hong Kong. That was the biggest intraday loss in almost 6 months. And some analysts said that China has options, of course, of its own to respond, but at the moment it appears to be playing something of a lie-low approach until the transition and President-elect Biden takes over.
And what's the significance of China today finally acknowledging that actually Biden won the U.S. presidential election?
Well, it's interesting because initially China was quite muted in its reaction, Francine. Early in the week, they weren't saying very much on it at all, other than that they had been observing the election like everyone else. And now, as you say, today they have been quite direct. The foreign ministry spokesperson at a briefing in Beijing earlier, they made the point that they respect the American people's choice and they extend the congratulations to Mr. Biden and Ms. Harris. And of course, this comes as President-elect Biden himself holds telephone conversations with leaders in this part of the world. He spoke with the leaders of Japan and South Korea and Australia this week, and now we have China publicly acknowledging his election too. I think there's a view in this part of the world that President Trump clearly remains in office till January 20th, and he hasn't finished with his China agenda. But there's a view that China might be trying to lie low in the hope that they can diffuse tensions a little bit and start something of a fresh slate with President-elect Biden. But of course, we know there's bipartisan support in the U.S. for a more aggressive stance. So it's a question of just how China does play President Biden and whether or not they can succeed in defusing some of the tensions that have played out over the last few years.
Thank you so much. Our Enda Curran there, Bloomberg Chief Asia Economics Correspondent. Now, coming up, COVID's latest wave continues to swell, with infections far surpassing official levels last winter and spring. But there are still glimmers of hope. We'll look at the latest European figures and speak to Italy's Deputy Health Minister. That's coming up shortly. And this is Bloomberg.
It came in better than expected, not only in terms of job creation, but also a sharp fall in the unemployment rate consistent with higher labor force participation. That's really good news.
Overall, the gain was solid, but even while this is a very robust pace of job gains, it's a lot slower than it has been in the summer months.
Great that we saw the job gains we did, but they still are diminished from what they were, of course, back in April and May. And the scarring, the sort of wounds that were created by COVID are beginning to fester.
I would caution people to look at the top line number because I don't think it tells the entire story. Employment relative to population is still well below where we were pre-crisis, and that's because I think that we're going to have some lasting damage.
Depending on what you look at, jobs creation or the unemployment rate, you have different views as to whether the improvement in the labor force is keeping up or slowing down.
Economics, finance, politics. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Let's go back to the markets and to investments. Stephen Bird, Standard Life Aberdeen's chief executive, says this is absolutely the time to show that active investing performs well. Well, he spoke to Bloomberg exclusively.
We've got Brexit uncertainty. We've got rising case numbers in COVID. But we know more this week, certainly, than we knew last week. We now know that there is a successful vaccine for this pandemic. And we also got significant clues as to how the market reacts to that news. You know, there was a short sort of flurry back into value stocks. There was a significant optimism, albeit beginning to fade right now. But if you cast your mind past this difficult short term, this quarter, and we see the vaccine being distributed successfully, then I think, and we see the transition of power in the US, I think what you're going to see is Biden is certainly going to be spending money. We think there's going to be fiscal stimulus. We do think that in the longer term, there's going to be a weaker dollar. That's going to be good for emerging markets. 85% of the time that has been the case. So we think that if you look past the short term, you can still have, there's a risk-on environment, central bank support, ample liquidity, and the search for yield. We're in a world of low numbers. So given that context, there's never really been a better time to be an investment manager because uncertainty is high and the need for guidance is high. But that's if you think about this year in the UK, 20% down in Q2, 15% up in Q3. But now a sort of difficult Q4. I think you really have got to, hold your nerve and see past the difficulty and maintain a risk-on environment, and that's certainly what we're doing.
Stephen, why is active having such a tough time? I would have thought if ever there was an environment in which active would be doing better, it would be now.
That's actually the case, Guy. Totally agree. In fact, 70% of our active equities are actually ahead of benchmark. I think a lot of this gets cast. I mean, I'm only here 2 months, so a lot of the credit for turning around the investment performance clearly goes to my predecessor. But as I sit with our fund managers and we go through the performance today, we've been seeing improving performance, and as a consequence, decreasing outflows from the business. We were about flat at the half year as we reported. So this is the time. My message to our team is this is absolutely the time to be able to show that active performs and can outperform simply index tracking.
Well, that was Stephen Bird, Standard Life Aberdeen's Chief Executive Officer. Now, as countries around Europe are dealing and reeling with the cases of ever more coronavirus, more people and more are infected, what does that mean for lockdowns and how politicians around Europe should deal with it? Well, I'm delighted to be joined right now by Pierpaolo Sileri. He's the Italian Deputy Health Minister. Deputy Health Minister, thank you for joining us. This is a crucial time because we get into the winter months and actually could make it much more difficult to contain lockdowns. How do you see this developing? Are we going to see a national lockdown in Italy, or will it be more regional lockdowns in and out?
I don't think we are going to meet a national lockdown, but I believe that the local lockdown we are performing now, starting the beginning of November with some regions, I think we will work. Obviously, we need to wait 2 weeks to see the results. So we did divide Italy in regions that are controlled every week. So we do check the ability to trace the virus in the territory up to the number of the beds that are used in the ICU care. And according to 21 parameters, we are able to say if there is a high risk of progression or lower risk. Thus, we give a color to these regions, and if it's a red region, then these regions has a lockdown that is less severe compared to the lockdown we experienced at first in Europe in March. So according to this, right now we have several regions that are red. Some others are orange, and the others are yellow. Yeah. The yellow regions have the light risk, and the red has the more severe risk. So I don't think we will see 21 regions red. Yeah.
Are there any regions that could actually change in the next couple of days? What would happen to the Lombardy region? What are you seeing right now in the case numbers that could give us an indication of what next week will bring?
Lombardy became red last week. So according to the rule, they will remain red for the next week. At the end of the next week, we'll check the numbers. And if the numbers are going down, then obviously the region will turn to be orange or why not, I hope, yellow. But we need to wait 1 more week. Obviously, when you become red on orange, you need to wait 2 weeks for check again the number. And then if the numbers goes better, then you'll be back to another color. So before 1 week, I think, will be very difficult to say if it's working or not. I can tell you that some friends, some doctors in Lombardy are telling me that they are seeing less people going to the hospital, and probably things are going better. But it's a perception of some hospital. We need to check the general number of the entire region.
Deputy Minister, how likely is it that the current decree for these regional lockdowns that is meant to last until December 3rd will continue beyond that and even well beyond that?
Obviously, yes, if it works. I mean, if we can prove that these regional and surgical local lockdowns works, then obviously they will go ahead. even because we need to fight against this virus for the next 6-7 months. So I believe it's much better if you close a region and you perform a local lockdown that maybe in 2 weeks you can remove than the entire national lockdown.
Give me a sense, Deputy Minister, of what Italy right now needs given these regional lockdowns. How much more support do companies need, and how quickly do Italians need access to a vaccine?
So first of all, the government is helping the economic COVID, because right now we have a health COVID that, you know, is the national health system is under pressure, but we have also an economic COVID. So we are providing direct compensation for companies and people that they need help, obviously. Regarding the vaccine, you know, I think the vaccine will be ready at the beginning of the next year, but I cannot give you a date because we need to wait for the official authorization. So after that, according to the type of the vaccine, we will be able to have available the vaccine, and we will start with the fragile people and the health workers with the vaccination. So probably this will happen during the first trimester or quadrimester of the 2021.
What's the biggest challenge, Deputy Minister, in getting the vaccines to all the right people? Is it refrigeration? When will you be satisfied that you'll be able to roll out the vaccine to all Italians that want it? How long will that take?
I think it depends from the vaccine, because everyone now is talking about the needs of refrigeration minus 60 for Pfizer vaccine, but not all the vaccines, they need refrigeration at that type. Anyway, I think we are ready, and the Minister of Health is already working with a group, and we have already a plan that is not different from the plan that every year we use for the flu vaccination. Probably Minister, we will need 4 to 6 weeks. 4 to 6 months.
And I just want to make sure that I understand, Deputy Minister, that you're not ruling out the extension of the decree for these lockdowns past December 3rd.
Oh, I think we will go ahead with that after December the 3rd. As I told you, we need to monitor these regions, and as I think the exposition to the virus will decrease, we will observe better numbers, I hope, in these regions. So I do see an extension of that for the entire winter. Obviously, this will avoid a national lockdown.
Thank you so much for joining us, Pierpaolo Sileri, their Italian Deputy Health Minister, joining us this morning on a very important update, of course, on what's happening in Italy. Now, coming up, a happier place. Disney shares gained after streaming subscribers jumped the last quarter. I know my household probably contributed to that significantly. That's coming up next, and this is Bloomberg.
So when you went to Baltimore, you went initially to be an anchor woman, and then it didn't quite work out.
Yeah, I got fired.
Well, you
Well, demoted.
He got demoted, but they didn't. They had a contract, so they didn't say goodbye. Yeah. And then, how did you work out to be on a afternoon show where you actually got to be an interviewer? How did that actually happen?
Well, what happened was this is what I now know with age and perspective, that many times getting demoted is an opportunity for something else to show up, or getting fired. You know, lots of people I've interviewed over the years who have these stories about the best thing that ever happened to you. It puts you in the next best place. I was not a good television reporter. I was too emotional. I was making $22,000 a year, and my best friend Gail, who I met there at the time, she was also working there. She said, "Oh my God, you're 22, making $22,000. Imagine when you're 25." Then you're 30. So I'd be making 60 about now. It'd be good, 62. Once I got demoted, they didn't want to pay out my contract. I was making $25,000 a year. They didn't want to pay me the $25,000. Right. So they kept me on and said, "We'll put you on this talk show just to run out your contract."
They have been here for quite a while. They have obtained the SVF license back in 2016. They've also been granted a license for the virtual bank. They will continue to play an important role in Hong Kong.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now let's get to one of our top stories. And Disney jumped in late trading as it reported a smaller than expected fourth quarter loss. Now the star was Disney Plus, smashing subscriber estimates. Now for more on this, let's get straight to Alex Webb, our Bloomberg opinion columnist who joins us now. Alex, first of all, can Disney Plus take away Netflix dominance of the streaming market?
I think that might be the wrong way to look at it, actually. That there is space absolutely for more than one streaming player here. The question is which 2, 3, maybe even 4 streaming services are a household likely to pick. And it certainly looks as though Disney Plus is one of them. I think particularly found households with children. They've racked up fairly staggering numbers, 74 million subscribers inside just a year. I think it took Netflix something like 8 years to reach a similar amount, although, of course, we're in a very different environment. So investors are very excited about it, understandably.
Okay, so is it a war of content? What can Disney Plus now do to become more, better and more viewed than Netflix?
I think that there's a question here of sustainability, that in terms of whether it can sustain the valuation, Disney can sustain the valuation that it has, and to do that, it needs to sustain the same pace of growth. To do that, it really needs to think about investing more in original content. At the moment, we've got, sort of every Disney film dating back since its creation on Disney Plus. We don't have many original shows. The only one really is The Mandalorian, which has been a hit, but one show isn't necessarily enough to keep attracting new subscribers. So the question is to what extent they invest heavily in new original content, whether they lean more heavily towards Disney Plus and away from theaters, which would, of course, be a dreadful shame for theaters, but is something that investors, particularly the activist Dan Loeb, who has taken a stake in Disney, seems to be agitating for. And that is, I think, going to be the really crucial trend over the next year or so.
How are the theme parks doing?
Not well, and for fairly understandable reasons. It's been a huge hit to the number of people that are able to go. They say at the moment they're running at 35% capacity. I would question whether even that is wise, given the surge in cases that we're seeing, particularly in the US. But frankly, investors don't seem to be worrying about that too much. Tara LaChapelle, our Bloomberg opinion colleague in the US, has written a very good column saying that, when Disney Plus was launched, it was exactly that. It was an addition to the rest of Disney. That perception is being flipped on its head, that increasingly Disney Plus is the core business and everything else comes on top of that. And investors certainly are rewarding it for that trend.
Alex, if you look at the streaming services out there, I mean, there's Amazon. Is there a space for, a fourth one? Are we going to see anything from China coming in?
We have seen so many services launching, particularly in the US, that haven't even arrived in Europe yet. You've got Peacock, which is the Comcast, NBC Universal product. We've got HBO Max, which is the Warner Media product. Disney is going to be, it has Hulu in the US, which is more sort of adult-focused content. I mean, just for grown-ups, not explicit content. And they're going to be launching a more sort of, grown-up content-focused platform in Europe as well. That could have some sort of discount if you get Disney Plus, and I think it's going to be called Stars or something. If those things are coming, and I think there is audience for a lot of them. In the UK, of course, we have Now TV, which is, very successful. There is space for a lot of these platforms. The question is, who can get the Amazon or Netflix style dominance?
Alex, thanks so much. Alex Webb there, our Bloomberg opinion columnist. Coming up, joining us on the final day of the Paris Peace Forum, we speak to Angel Gurria of the OECD. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
We explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe. Economics, finance, politics. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg First Word News. Here's Laura Wright. Hi, Laura.
Thanks, Francine. The US is banning investments in firms it says are owned or controlled by the Chinese military. It's President Trump's latest bid to add pressure on Beijing over what he describes as abusive business practices. Relations between the US and China have deteriorated, with the president vowing to punish Beijing over the coronavirus pandemic. Some Republicans in Congress are starting to back the initial steps of a presidential transition. Texas Senator John Cornyn says Joe Biden should start getting presidential-level classified briefings, but he and others are stopping short of recognizing Biden as the winner. President Trump is continuing to make unfounded claims of electoral fraud. Italy's government is asking for parliamentary approval for up to 20 billion euros in extra borrowing. Sources tell Bloomberg Rome wants the funds to cover measures to protect businesses from the new coronavirus restrictions. No official comment yet. Bloomberg earlier reported the monthly cost in Italy could be up to 10 billion euros. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg, Francine.
Thank you so much, Laura. Now let's get the latest on a turbulent week at Westminster. Sources tell Bloomberg that Boris Johnson's top aide, Dominic Cummings, will quit his job by the end of the year. Now, he's the second key advisor to leave amid tensions over how the Prime Minister's inner circle operates. Cummings masterminded the Leave campaign in the Brexit referendum and has been a controversial figure in UK politics. Now, let's get the details from our executive editor, Rosalind Matheson. Ros, first of all, how bad a week is Boris Johnson having?
Well, it actually is piling up for him a little bit. Of course, he's had a lot of criticism for his handling of the pandemic, and most of the UK is back in lockdown. There are big questions about whether it can come out on time and what is the level of economic assistance for companies. Of course, we've had some bad economic data out of the UK again just today. And now, of course, he's got the departure of two of his key advisors in quick succession. These are two very hardcore Brexiteers who've been alongside him for years in the Leave campaign. And we know, of course, that Dominic Cummings in particular is someone who he leans on for advice and guidance, and that's been very clear for some years now. And so his departure, of course, will be quite a shock if it does indeed happen before the end of the year.
Ros, is this linked to Brexit? I know, this is linked to a leak that happened because of the lockdown, which Prime Minister took really badly. But could it have implications on Brexit?
Well, it could. It could be good or it could be bad. It could mean that Cummings is confident enough that the UK will leave no matter what at the end of the year, even without a deal, that he's okay moving on, which means that no deal is still very much on the table in terms of a trade deal. But what it more likely means is that Johnson, recognising the poor state of the UK economy and the shocks that businesses have had, knows that some sort of systems of rules and regulation is crucial for business and economic confidence into next year. And so that flirting with that idea of a no-deal exit may now diminish, in fact, if Cummings is headed out the door. And you can see that in the pound reaction today, perhaps the hope that this may help clear the path, in fact, towards a deal.
Ros, thank you so much. Rosalind Matheson there with the very latest, of course, on what's going on in Downing Street. Now, 2021 begins with a new U.S. president about to enter the White House, but with 2020's problems still very much in focus. That's partly what the markets are looking at. The market's also looking at a couple of other things. So first of all, the number of infections are rising across the world. The number of things that we need to look out for, of course, is some kind of bond issuance. I don't know if we have the markets, but it seems like it would be a good time to actually have a look at exactly what we're seeing there, not least because pound has been on the move, and pound, as you know, was the story that Ros was trying to explain, not only with a bit of chaos at Downing Street, but what we're seeing also in Brexit negotiations. Now, European stocks at the moment dipping. U.S. equity futures actually edging higher, and investors are assessing that the prospects for additional government stimulus will help the economies battered by soaring coronavirus cases. Treasuries adding to gains, so we'll have plenty more on that shortly. Coming up, like every country in Europe, Italy has been forced to borrow heavily this year as it supports its coronavirus-battered economy. We'll be speaking to a minister on that. We also have Angel Gurria coming up. This is Bloomberg.
Every era presents its own unique set of challenges and opportunities. Trade CME Group futures with Interactive Brokers at low cost and seize the moment. Start investing today at interactivebrokers.com.hk.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
The question is, what is the storehold of wealth in the meantime?
This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now, 2021 begins with a new U.S. president about to enter the White House, but with 2020's problems very much still in focus. World leaders have been taking part this week in the Paris Peace Forum, which is being held online. The summit aims to discuss how to tackle the challenges from climate change, terrorism, and migration. Of course, top of the agenda will be the global health crisis and economic downturn from the coronavirus. Well, joining us this morning is Angel Gurria, OECD Secretary General, who's been one of the key participants at this Paris Peace Forum. Thank you so much, Mr. Gurria, for joining us. How would you describe the week we've had? There seems to be a big shift, of course, in U.S. politics that could go back to multilateralism, that could change foreign policy. And we had news of positive trials for a vaccine.
I think a very important week, a very promising week. And we also had the Paris Peace Forum, as you mentioned, where multilateralism just came back very strong. We had our own ministerial council meeting here at the OECD a few days ago. And in many ways, what we're coming to the conclusion is that just like trade, just like investment, just like climate change, biodiversity, the question of migration, the only way, not the best way, but the only way to effectively deal with this is multilateral.
But are we expecting too much of President-elect Joe Biden? This is not only President Trump, I imagine, that put a stop to this. It's coming from all factions. So what will happen with multilateralism in 2 years from now?
I think one should not put the burden on multilateralism or globalization as such, because they, for their success, depend on the policies that countries adopt. So let's focus on the policies, on the right policies, on the inclusive policies, on the sustainable policies, on the resilient policies. Those are the ones that are going to take us home.
What is the one thing, Mr. Gurria, that we need to change post-pandemic to make sure that this is a fairer society, a better society, that is more inclusive in terms of economic growth?
I would start by putting a big, fat price on carbon, because we must remember that our single most important intergenerational responsibility continues to be the protection of the planet.
Will countries come together and find real solutions? Do you worry that so far there's been a lot of progress on climate change and solutions towards finance, but also maybe a lot of greenwashing?
There's been a lot of national policies. Some countries have put in 5, 10, 15, even 30% of GDPs if you count the guarantees. But there's been very little coordination. There's been very little collaboration, and there's been very little cooperation. And that is absolutely indispensable. As I mentioned, you know, the way to deal with global problems is precisely by global cooperation. And this pandemic is the single most global phenomenon we've ever seen.
Central banks have been warning left, right, and center not to expect too much out of this vaccine. This is not a cure-all for the world economy. Would you agree?
Central banks are heroes of this, not only of the pandemic, but also of the 2008, 2009, and they should be given their justice. But the question is, they can't do it all. Now we need the consistent and prolonged support of governments. So that means that governments now have to take over. Governments now have to be flexible in terms of their fiscal policy. And, of course, just because we have made progress, 90% effectiveness with the Pfizer vaccine, sounds very, very promising. We hope others will follow, but that is not going to happen for the most of 2021. We're still going to have to be living with a virus.
How uneven will the recovery be? And what's the chance that actually in many parts of the world, in many parts of the countries that, of course, are part of the OECD, we're going to see a double-dip recession?
We believe that the second wave that we are seeing today, whether it's the second wave or the part of the first wave or whatever, increasing number of cases, increasing number of hospitalization, increasing number of deaths, that is going to put a dampener on the recovery. It's probably going to go into the fourth quarter. It's going to weaken the fourth quarter, but most importantly, it's going to weaken the way in which we come into 2021. So we're going to come out on the 1st of December with our economic outlook, and we believe that may be a little weaker on the 2021 outlook.
Mr. Gurrian, I know you're to step down from the OECD in May 2021. What's the most important attribute that your successor needs to have?
Well, you have to be a very good listener and then a very good leader. You need leadership, but leadership always is consistent of listening to everybody once you get it right and once you know what you have to do, you go forward. You also need to be a very great convener. You need to have, remember, you know, the international organizations, multilateral organizations will only go as far as the members want to go. So the question is to inspire, but to document why it is that you want to do certain policies or recommend certain policies. You really have to be evidence-based in order to convince them.
There are a number of contenders to get that job. Who do you think has the best shot?
10 contenders so far. So, well, actually not so far, because we have closed the period for registration. So now we have 10 contenders from different parts of the world. That will take place during November, December, and then the actual process of selection will take place during January, February. And the idea is that during March, April, and May, we will have an overlap, we'll have a layover, so it will be an efficient delivery of efficient transition period.
Okay, so one of the other attributes, of course, being diplomatic and not answering questions that are delicate. Mr. Gurria, as always, thank you so much for your time. Mr. Angel Gurria there, the OECD Secretary General. Now, coming up, like every country in Europe, Italy has been forced to borrow heavily this year as it supports its coronavirus-battered economy. Ahead of a dollar bond sale, the first in more than a year, we speak to the country's head of public debt. That's coming up next, and this is Italy.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
A market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Climate change is happening. It needs to be repeated over and over.
126 governments have now committed to net zero.
We also must harness the firepower of the financial sector.
The financial community has a critical role to play in driving this transition. We're going to lay out for our stakeholders how we intend to align with the Paris Accord. The investment industry now has the opportunity to further accelerate this phenomenon and demonstrate that we can be a catalyst for change.
The economic challenges of the climate transition are phenomenal. And then I ask myself, how much does it cost? A lot. But nothing that we cannot afford, because the cause is our survival.
So climate change is the defining story of our time. Don't miss our new show, Bloomberg Green, launching today, 8:30 p.m. New York time. Now, it has a debt of more than €2.5 trillion. Italy's government, like all of its neighbors, has been forced to borrow heavily this year as it supports its economy. Europe's second most indebted nation is now launching a debt sale in dollars. It's the first time that Italy has done this in more than a year and is a chance to diversify its investor base. Well, joining us now is Davide Iacovoni. He's Director General for Public Debt at the Italian Economy Ministry. Thank you so much, Mr. Iacovoni, for joining us. When you look at your underlying reason for going into dollar, why does it still make sense to you? It's actually cheaper to fund it in your home currency, euros.
First of all, thank you very much for your invitation. Well, our strategy in dollar is not new. Italy has been a dollar-denominated issuer for a long while, up to 2010. And then because of the sovereign debt crisis at that time, we were somehow forced to stop issuing because covering the FX risk, the exchange rate risk, was at the time too expensive. Now we are back into the market after having worked on a collateralization on our FX derivatives. And so now the whole cost of issuing in dollar is being brought down pretty significantly. It's now more or less in line with the cost that we have in our domestic market. So these instruments, dollar-denominated bonds, are very useful for us to diversify the base of investors, to engage with key investors in the US, but not only in the US. There's a lot of global investors in dollar-denominated products that like Italy. And so for us, it's a very important way to diversify our funding, diversify our base of investors, meet new investors, and maybe having them also jumping back in our domestic market.
But the difference, I think, is still 160 basis points in terms of difference. So the gap is still quite big. Is this definitely the right route?
No, the gap is much smaller. You are just looking at the rates in dollar and the rates in euro, but one use what is back into euro. The cost is very much similar. I mean, right now we just see a difference in the region of 15, 20 basis points in euro terms of a dollar-denominated bond. So there's no much difference in terms of cost. Of course, some of the difference is due to the fact that the dollar-denominated bonds are not under the quantitative easing measures and packages that the ECB use, but this is only referred to the domestic market. So this brings a premium, the dollar-denominated bond versus domestic market, but it's not a very wide premium. It's a small premium, which compares with the very large benefit that's coming from this issuance, as I said, in terms of engaging with several investors that normally are not present in our domestic market.
Would you also look to expand into new markets, such as yuan?
Well, this is something that we are evaluating, but I wouldn't say this is it's a very short-term project. I mean, we are always present in several other currencies with our private issuances. We have done this in the past. Also recently, as you know, we've done a yen-denominated issuance. So we can't exclude also to go in other currencies too, but we're not planning any, say, stable issuance in yuan for the time being.
When is Italy actually going to issue a green bond? Is a country a little bit late to that?
I wouldn't say it's late. It's a very complex mechanism to put in place. There's a total commitment from the Treasury to be in the green bond market. We are working hard on that. There's a lot of analysis that need to be carried out on our budget to, select the so-called green expenditures. But we are at a very good point now, and we are going to release our sovereign bond, green bond framework in a few weeks. And I'm confident that we'll be able to be in this market very soon.
Mr. Iacovoni, have you overall been satisfied with the push for the BTP Futura sold to Italians?
We're very satisfied. Actually, this second issuance went beyond our expectations. The very first one, it was in July. It collected more 6 billion euros. Now we are already well above 5 billion euros, and we are almost at the end of the year. So it's a very good result. I think retail like the product, despite being a long-dated product, but I think they like also these innovation that we introduced of a premium at the end for those who keep the bonds up until the maturity that is linked to the performance of our GDP in the medium term. So I think the product was a good choice. It's going well. And for sure, we will propose these also in the coming years.
If the ECB tones down its expansionary policy, do you still believe that Italian debt is sustainable long term?
Well, the Italian debt is absolutely sustainable. Of course, this year there will be a very large increase in terms of GDP, as we all know. But we have to consider that there is a very strong commitment by the government to bring the debt over GDP ratio down in the next few years. This will be carried out with a moderately expansionary fiscal stance for the next couple of years. And then the objective is to get to the 3% deficit in 2023, so with an almost zero primary surplus. So in this way, there is a commitment to reduce gradually this expansionary fiscal stance. But on the other side, there is this very strong commitment to the recovery, so to have a higher growth in the next few years. And of course, the key point there will be the use of the next generation EU package that, as you know, will be mainly devoted for public investments, which are absolutely needed in order to increase the average productivity of the Italian economy. In this way, I think that the affordability, the sustainability of that is will be achieved. And this is also being recognized, as you probably have seen, by the major rating agencies very recently.
Davide Iacovoni, thank you so much for joining us. He is, of course, Director General for Public Debt at the Italian Economy Ministry. In the meantime, when you look at the markets, a lot of the focus, of course, is on the number of increasing coronavirus cases. A lot of the figures also point to maybe a bit of concern about stimulus going forward. Bloomberg surveillance continues in the next hour. Tom Keene joins me out of New York. This is Bloomberg.
The big concern is climate change. We can see the global warming accelerating at the moment, and the goals that we must hit are so ambitious. It's 1.5 degrees by 2050, being climate neutral in terms of emissions by 2050. That's a huge challenge. We have to reduce emissions by 50%, 2030, 2040 again. It's very, very ambitious, and mobility plays such a crucial role in there. One thing is to do it in developed countries. I think we're going to get there by 2030, but then the rest of the world, and that's just as important. If you look at developing countries, emerging countries, that's where probably the biggest challenge we are going to face, to also deploy EVs there and make mobility greener in those countries. I know it's possible to move mobility forward fast enough to be able to do its part in this fundamental threat that we're facing.
give you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
President Trump bans investments in firms controlled by China's military. He calls them a national security threat. Meanwhile, Beijing congratulates President-elect Biden on his election victory. The pandemic grows in the U.S. California joins Texas in reaching 1 million infections. The CDC says almost no part of the country has a virus under control. And Dominic Cummings is going. Boris Johnson's powerful aide will depart Downing Street at the end of the year. Another round of Brexit talks is likely to end today with little progress. Well, good morning, everyone. This is Bloomberg Surveillance. I'm Francine Lack in London, Tom Keene in New York. Tom, a number of stories, as always, that we need to look at. We look at China. We look, of course, at China and the U.S., the relationship between Trump and President Xi and what Joe Biden's relationship with them could look like. It's actually, they finally acknowledged that he's the president-elect. And then, of course, we looked at the coronavirus, especially in Europe, with some of the pitfalls that we could see.
The pandemic is front and center. There's no question about that, Francine. The news flow in the United States and the pandemic, and I don't believe I've used this word ever before. It's just grim. Maybe I did in April. I can't remember. But the headline in America this morning is we have a president. There's just no question about it now. You see it across all the media. Arizona has gone for Joe Biden. And just as importantly, as you mentioned, the Chinese government has commented on this. It's going to be fascinating to see what President Trump does today and what he does into the Sunday talk programs.
Absolutely, and we'll look at, executive orders if they're coming. I was reading also about security briefings, which I know is something, Tom, that you want to talk about, and it's very significant at the moment, security briefings for the president-elect. Now, let's get straight to the Bloomberg First Word News. In New York City is Karina Mitchell. Hi, Karina.
Good morning. State and federal election officials are rejecting President Trump's claims of widespread voter fraud. In a statement, they say last week's election was the most secure in American history. They say there's no evidence that any voting system deleted or lost votes, changed votes, or was in any way compromised. Meanwhile, China has congratulated Joe Biden and Kamala Harris on the winning of the presidential election that ended days of speculation about when Beijing would formally acknowledge the victory. China was one of the few countries that had so far withheld comment. The reaction came after several television networks projected Biden would defeat Donald Trump in Arizona. And it's the latest move by the White House to pressure Beijing. President Trump has signed an executive order barring American investments in Chinese companies owned or controlled by the military. The order says that China is exploiting American capital to develop its military, intelligence, and other security apparatus. And in the UK, Prime Minister Boris Johnson's most powerful aide is quitting. Bloomberg has learned that Dominic Cummings will leave by the end of the year. Cummings was the second key advisor to Johnson to depart after tensions blew up over the way the inner circle operates. He was the mastermind of the successful Brexit campaign. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg. Tom.
Well, Karina, thanks so much. Equities, bonds, currencies, commodities, futures up 31. A nice lift and a persistency to futures. I'm going to call it mid-range of what we've seen since the great repricing. Dow level 29,205, up 214 points. At VIX 2423, right now 24.10, 10-year 0.89%. Not much else going on. I'll say dollar resilient. I don't know. Is that a word? That's not CFA Institute, but we'll go with it. Francine, the dollar resilient.
Yeah, I like that, Tom. Treasury yields actually dipping along with the dollar a touch. Equities a bit down when it came to the Asian markets. Now, it's interesting here in Europe, they're pretty much trading sideways, Tom. I think they're just trying to assess the prospects for additional government stimulus to help these economies that are battered by these soaring coronavirus cases. This was what we saw in the markets yesterday, and it continues to be so. I also wanted to show you what was happening with pound. Now, pound is significant not only only because the UK reported record infections despite a tightening lockdown, but because we had this power struggle at Downing Street, and we should have a bit more news on Brexit today. So you can see currently pound 131.79. Now, to talk about all these topics, let's get straight to Steen Jacobsen. He's Saxo Bank Chief Investment Officer. Steen, great to speak to you as always. A lot of focus on a president like Biden, a lot of focus on the vaccine from Pfizer, and then this rotation with, Treasury is really leading the way. What happens in the next 2 months?
I think the market increasingly will look away, unlike what the central bank's done over the last 24 hours, and look through into 2021. I think that science and the companies in the science and healthcare space has really showed up. The improvement that we see in the Pfizer's vaccine, but also this morning from Oxford, is very encouraging to me. So I'm beginning to plan the 2021 on the basis that we see a significant improvement in the actual underlying ability to move around and get the economy back on track. And I think in that circumstances, I think the central banks right now is doing a massive policy mistake by throwing everything at it. Apparently, I'm going to see a new version of an ECB bazooka by December. At a time where, of course, the data looks bad, but these data on the cases, and they are concerning, of course, on a person-to-person sort of perspective. But overall, I think science and healthcare will come in and start to really play a really big role. And I think market in the next 2 months seriously will start to reprice everything.
But, Steen, what if because we had this warning from the Bank of England governor, from the president of the European Central Bank, from the Fed president, that actually the vaccine is not going to be a cure-all? Is it better that, they're still cautious, or would it be a bigger mistake if they actually believe, like you, that, science will fix this mid-2021?
I think they have to play on the side of safety. Obviously, that's the way we've seen certainly the Bank of England also through the 2008-2009 crisis. I think the Federal Reserve learned from the mistakes of Bernanke, not seeing properly in the housing market, and then all of a sudden everything was falling apart. And I think, on a credibility sort of into the future in predicting the economy, I think the central banks probably have the worst record of all, including me, and I have a pretty bad record on that. So I don't really put a lot of policies that this is all the narrative that they're trying to create. And of course, the central banks loves to be part of the solution by being able to talk to the audience, being the markets and being the politicians. We will get more pretend and extend in the sense that we get more fiscal spending and more. But my point is that I'm not saying that data will not be worse for the next 2 months. I think the market looks through that, and I think it is a policy mistake because they can do whatever they want. They're not going to increase the solvency of the system. They're not going to take away the fact that COVID-19 accelerated a lot of trends, including that a number of people, a number like 2 billion people, is being put out by futurists that by 2030, that will be lost in the total workspace. I see, let's get started on that instead of trying to close holes.
Steen, so much of this is the microeconomics or the micro theory of ambiguities. What's your greatest ambiguity for 2021? Is it inflation and which way it cuts?
Yes, and that's a great question, because what is the biggest risk to this free ride that we have in equities right now? It is inflation, and I absolutely agree. And that's, what I forgot to say before. I think the main impact here is that we will see a massive amount of steepening in 2021, and that steepening will take out 1% in 10-year and 1.5%. And then we will really see why monetary policy endless infinite support through monetary stimulus is not going to work. Because if you take a company like Microsoft, if interest rate goes up by 100 basis points, Microsoft will lose over $500 billion in value simply because of the convexity of the discount rate embedded in technology stock. The fact that they have low debt, high cash flow, that cash flow being discounted with 1% higher rate will mean $500 billion being lost.
Why have we not seen this so far? The critics of people concerned of inflation say many times we've not gone there. Why is now different?
Now it's different because, one, because we know that we're going to have a massive impulse at a time where we should be standing still. But most importantly, of course, and you know this better than anyone, what we've seen in the U.S. is that at a time where we had 13 million people getting unemployed in the U.S., we had the highest ever disposable income increase in the U.S. In other words, the state has taken upon themselves to substitute all income brackets, but in particular the low-earning part of the income brackets. That translates into consumption. U.S. is 70% consumption. If you look at the CPI for consumer goods, durable goods in the U.S., they're rising 4.5%. So I will argue, if you're not seeing inflation, if you don't understand the mechanics of inflation, you're really just looking in the wrong place.
All right, Steen, thank you so much. We'll get back to that. Steen Jacobsen there of Saxo Bank stays with us. Coming up, Adam Posen, Peterson Institute president. That's at 5:30 a.m. in New York, 10:30 a.m. in London. We'll talk to him about inflation, too, and we'll touch on Brexit. This is Bloomberg.
This is Bloomberg Surveillance. I'm Karina Mitchell with the Bloomberg Business Flash. Shares of Disney jumped today. The world's largest entertainment company added more online subscribers than predicted last quarter. Disney is still reeling from the impact of the pandemic, but the growth of the Disney Plus streaming service has softened the blow, and gains at the ABC broadcast network contributed to a smaller than expected fourth quarter loss. The Trump administration has backed off from its threat to ban video sharing app TikTok in the U.S. The app's Chinese owner ByteDance faced the prospect of a ban starting yesterday, but judges have blocked the prohibition from taking effect, and now the Commerce Department says it will comply with the court rulings while the legal battle continues. And shares of Cisco Systems are rising today. The company's fiscal second quarter forecast indicated it will beat analyst projections. It also suggests that corporations and governments are starting to spend again on network gear. And that is the Bloomberg Business Flash. Tom.
Thanks so much. We are with Steen Jacobsen here on a Friday, getting ready for, the reading through the weekend and trying to reframe into the holidays, into December as well. Steen, I want to talk, we're talking about the ambiguities out there, and I do want to talk about how within all of our theories, and of course, I would say the Danes have really led on a careful analysis of this. The theories are all income statement. They're all dynamic. They're all to the moment, unless a balance sheet analysis. Can we affect what central banks are trying to do and not recalibrate our balance sheets for the losses over the last 14 or 15 years?
No, and I think that's one of the conclusions we have to take from the great financial crisis, and also now that the ability of the political system, but also the overall framework to take these losses is very, very difficult. I think the central banks are hoping we can get it through inflation, and that is needs to be seen. But overall, there's no appetite for doing this, and that is exactly why I keep coming back to the fact I think the only way to do this with the path of least resistance is that there will be a shocker in 2021, that interest rate starts to rise because of the inflationary pressures and because effectively, as you say very rightly, that we are not dealing with that balance sheets. I mean, we can't solve for solvency with liquidity. So unless central banks come in and actually buy in like what we did in the Swedish bank model and what we did in the US with the saving and loans, unless you start a plan where you amortize these debts over the next, or this inconsistency on the balance sheet over 100 years and actually have a forward-looking plan, I don't think we'll get it solved.
And the scary item there is 100 years. Francine, this is, of course, the commercial banks within the continent of Europe. And I would note in the United States, there's a new dawning awareness of the challenges of Wells Fargo as their management tries to do that work out.
Yeah, 100%, Tom, and we'll spend a lot more time actually looking at some of the pitfalls that we had here in Europe. But Steen, let's just go back, briefly to that very important inflation question. Where do you see it first if it suddenly takes hold, and could it simply be inflation being imported from China?
I think China certainly, historically, I have been looking at this inflation question before. It was really a big issue, and it's pretty clear that the export price out of China has a higher explanation value than a lot of other factors used domestically in the U.S. So the fact that what you buy at Walmart is whatever, 60-70% Chinese goods is clearly one link. And I think, for the record, I think China, who right now runs a very tight monetary condition, by Q2 next year, will be fully engaged in starting and starting the engine, both fiscally and monetarily, by easing monetary policy. I use credit impulses, which looks 9 months forward. It looks like Q1 and Q2 is going to be very, very strong for China. Yes, take that box. Tick the box that consumer spending through the durables is going up already. That is ticked. But overall, the way the market look at it, of course, is the 5-year, which is expectation relative to realized inflation. And what we need to know and need to realize, and a few of us remember this, but in the 1970s, no one really understood why inflation went from 3% to 12%. We all know about the energy crisis, but that was the first 3 to 4%. The rest was expectations. And let me make the final market argument. If you look at the world today, I think one of the asset classes with the lowest success potential over the next 10 years is government fixed income. If money was starting to flow out of government fixed income, it will flow into buckets of risk that are significantly smaller. One of the smallest buckets there is inflation-linked protection. So in other words, if you wanted to, whether there was inflation or not, to protect yourself against inflation, that bucket from which you should select your hedge will be way, way too small to take it. So we could see a phenomenon where inflation expectation starts to rise way ahead of the actual inflation, and through that forces financial investors to get on board on terms of hedging what is not it's either not materializing or materializing much smaller than the market thinks.
Steen, thank you so much for all of that. Steen Jacobsen there of Saxo Bank, where he's Chief Investment Officer. I'm actually going to ask Tom to make me a chart on that because it was really important. Inflation, 5-year. Now, coming up on Bloomberg Markets, the European close, David Miliband, the International Rescue Committee Chief Executive Officer. Of course, it's about refugees, but much more than that. It's also about Brexit and where the world goes. That's 11:30 a.m. in New York. That's 4:30 p.m. in London. And this is Bloomberg.
it came in better than expected, not only in terms of job creation, but also a sharp fall in the unemployment rate consistent with higher labor force participation. That's really good news.
Overall, the gain was solid, but even while this is a very robust pace of job gains, it's a lot slower than it has been in the summer months.
Great that we saw the job gains we did, but they still are diminished from what they were, of course, back in April and May. And the scarring, the sort of wounds that were created by COVID are beginning to fester.
I would caution people to look at the top line number because I don't think it tells the entire story. Employment relative to population is still well below where we were pre-crisis, and that's because I think that we're going to have some lasting damage.
Depending on what you look at, jobs creation or the unemployment rate, you have different views as to whether the improvement in the labor force is keeping up or slowing down.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg Surveillance. Tom and Francine from London and New York. Tom, I know you were talking about clearing the markets, and a question that we've been asking ourselves, and I have been also asking guests for the last 4 years, 5 years, is because Europe is overbanked, when will they finally consolidate? Well, I spoke with Thomas Gottstein, the Credit Suisse chief executive, earlier this week on acquisition opportunities, and he talked to me about private banking. Here he is.
Across Europe and also in Switzerland, there will be continued consolidation. And it's more domestic. I think cross-border consolidation is more difficult to actually execute, but there will also be cross-border consolidation, I'm sure. So I cannot give you an exact number, but what I'm convinced is that consolidation is needed and will happen.
Is everything you do in actually, managing the bank through that lens, through a wave of consolidation coming? Or do you try, do you want to be an acquirer? Or do you want to, do you want to defend yourself if you're an acquiree? Like, what does it mean for how you want to manage the bank, and in particular, how you want to manage wealth management?
Well, our strategy is principally based on organic growth, not inorganic growth. And I think we have a very strong private banking franchise globally that is growing about 5% per year. If you take the FX adjusted growth we had in the first 9 months, both in revenues as well as in AUM. So we have a nice balance between mature and emerging markets, strong exposure to Asia, where 20% of our revenues are coming out of Asia. So we have, I think, a very good platform to grow organically. But we also are always open and opportunistic to look at acquisition opportunities, especially in private banking, which is our main focus. So from that perspective, we will be open and we'll look at opportunities. But our key strategy is to really improve our return on tangible equity. We made very clear that our target is to get to 10 to 12%. We were at 10% in the first 9 months of this year. So I think we are very close to our midterm target in a very difficult year, 2020, with a significant amount of provision for credit losses. But we also had some tailwind in terms of transactional revenues and transactional volumes. But overall, I think we're on the right track. This is our strategy to grow organically in wealth management with strong investment banking capabilities, be a bank for entrepreneurs. This is our key differentiating positioning. We have very strong capabilities and broad capabilities for ultra-high net worth, family offices, entrepreneurs across private banking, corporate banking, investment banking capabilities. And that's where we really want to continue to grow.
And Mr. Gottstein of Credit Suisse managing the message. Right now what we'd like to do is there is silence at 1600 Pennsylvania Avenue. We won't talk about that now. Marty Schenker, maybe Kevin Cirilli will help us out there. Francine, we've got to talk to our international audience of the silence of the Prime Minister at 10 Downing Street. Do you expect Prime Minister Johnson to say something today into your afternoon about this soap opera that I'm observing?
But probably not, Tom. So there are two stories. He'll probably say something on Brexit because, we go through kind of deadlines and then they get extended, and we understand that the two sides are still negotiating. What you're referring to, Tom, is, of course, the rage of Prime Minister Boris Johnson after there was a leak last week about lockdown. And so, they've really cracked down on leaks. And after that, one of his top aides resigned because he didn't become chief of staff. And then we found out yesterday that actually his most famous aide, controversial aide, Dominic Cummings, will leave by December. And Tom, you don't usually have a prime minister kind of, going into the public eye talking about this in-house laundering about what exactly is going on. But through various reporting, we understand it's very fraught. And of course, there's a number of people for and against the people that surround the prime minister.
Is this normal? I mean, is this like occurred in other prime ministerships?
I mean, at the margins, yes, Tom. Nothing quite like this. But again, it's a little bit like what we saw in the White House. The personalities are a little more, bombastic, I would say, than in the past. So they also have stronger reactions by either side. So this is infighting in Downing Street. I'm sure we've seen it before, or maybe not in the last 20 years.
What's Lawrence the cat think? That's all I want to know.
I know. He's having tea with Palmerston, the cat of the foreign secretary. Coming up, we speak, of course, about the U.S. election with Bonnie Greer.
would love, at the right time and the right way to have a digital bank license. We would almost certainly do that in partnership with a strong local partner, and we would use the technology and the experience that we've gained from Mox in Hong Kong.
We explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe. This is Bloomberg Surveillance. Tom and Francine from London and New York. Now, Bloomberg has learned that Boris Johnson's top aide, Dominic Cummings, will quit his job by the end of the year. He's the second key advisor to leave amid tensions in the Prime Minister's inner circle. Joining us now is Rosalind Matheson, Bloomberg's international government executive editor. Ros, thank you so much for joining us. This is a very divisive figure. Some people liked him, others didn't. If he leaves, who will be the closest confidant of Prime Minister Johnson, and how does that change the dynamic on Brexit, on other things?
Well, it will be very interesting to see if he leaves, who in fact does replace him, because it's now two of the three of his possibly closest advisors, the key Brexiteer, the gang that helped push Brexit through since 2016, who will have left. And Cummings, as you say, has been highly controversial, none the least because he broke lockdown rules earlier this year. But Boris Johnson, of course, has been very loyal to him, and the sense has been that Cummings has had some outsized influence on his thinking, not just about Brexit, but about the pandemic and his management of other things in general. So if he does depart, it does leave a big hole in Johnson's inner circle. It could mean, in fact, that they are moving closer towards Brexit, though, because Cummings was a very, very hard Brexiteer, and there may be a hope that his departure would help clear the path towards a deal, a trade deal, of course, with the EU to start in 2021, because the economy in the UK really does need that sort of understanding of what the rules and regulations will be, given the hit to the economy and to business from the pandemic. So it will leave a hole, but it could, in fact, as well, also move a path forward to have Brexit done.
Rosalind, what does this mean for the certitude of the Johnson government? I believe my Civics 101 tells me he has a government in perpetuity, essentially. I'm making a joke, but, out years. Is his government threatened by this soap opera?
Well, he's not due for election for a while, but there are a lot of local elections next year, and including an election that could be particularly tricky in Scotland. And, of course, he's been under pressure in the polls. So what this could suggest in a way is that Boris Johnson is perhaps keen to assert himself a bit more, to take control of his own agenda and policies, perhaps clean the slate a bit into 2021, because, as I said, Cummings was quite controversial, quite divisive, and there was that controversy earlier this year. And so this might be Johnson saying, right, we're going to move away from that. We're going to move away from Brexit and look forward to some new policies for the economy and for the UK. So it could be chaotic after a pretty bad year for Boris Johnson, but this could be him saying and signaling that he's looking for some kind of reset, especially to sort of get his own popularity back on track.
Thank you so much, Rosalind Matheson there, Bloomberg's international government executive editor, joining us there. Now, what we'll do, of course, is focus also on the Bloomberg New Economy Forum. You can watch that live on Bloomberg.com, the terminal, and on Bloomberg New Economy social channels on Twitter and Facebook. We have a number of guests. I think we're keeping them secret for the moment, but in just a couple of hours, we'll give you a full roundup. It's going to be heads of state, it's going to be policymakers, including central bankers. This is Bloomberg.
I am David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Republican officials who clearly know better are going along with this, are humoring him in this fashion. It is one more step in delegitimizing not just the incoming Biden administration, but democracy generally. And that's a dangerous path.
The president with a well-timed book out. I'm sure it will be read by many. President Obama there with a book, and of course on 60 Minutes. Here in what was supposed to be a post-election, but it isn't. Martin Schenker has been watching this, herding together all of our election 2020 coverage. Marty, just to get to first principles, election 2020 is still on, isn't it?
Well, it's on as far as Donald Trump is concerned, but increasingly the GOP is coming to the realization that we have to move this transition forward in a formal way, and you see more voices coming out calling for that.
There was a ballet when Nixon was asked to resign of Barbara B. Conable and many others. I think Howard Baker was involved in that as well. Folks, this is a few years ago. Young Schenker and I remember this.
We do.
How do you presume the ballet to be to sit the president down and explain to him the realities of the popular and electoral vote?
Well, you know, it's interesting. We have a story out this morning about how Donald Trump has basically been invisible for the last 6 or 7 days. He hasn't made any public comments at all. He made an appearance at the Veterans Day ceremony, but didn't say a word. And you get the sense that maybe he is beginning to contemplate what his next move is in terms of acknowledging Joe Biden as the president-elect. And I suspect that that is beginning to happen and seep in as more Republicans call for intelligence briefings.
Marty, even if the president, doesn't come around to that, or I don't know, takes weeks or, even longer, what is the rest of the Republican Party going to do?
Well, I think, a number of people have made the point that they want Donald Trump's voters to come out for the Georgia Senate runoffs. So they definitely don't want to get on the wrong side of Donald Trump. At the same time, these states are going to begin to certify results in the next 10 to 14 days. When that happens, it's going to be very difficult for Republicans to resist congratulating Joe Biden and the country moving forward with the Biden administration.
Marty, I know this is a difficult question because we don't really have the polls yet, but how many people in the U.S. think something went wrong in the election? Or, how many people think that actually the president is right, that he was cheated?
Well, actually, there was a poll out just a couple of days ago that said single digits think that there was massive fraud in this election, and upwards of 70% believe Joe Biden is the president-elect. So the president is not on the right side of the public on this issue, and you just wonder how long it's going to take for him to realize that.
Mr. Schenker, what is the role of Vice President Pence here?
Well, he is also kind of invisible. He was up on the Hill at the Senate breakfast the other day, or lunch rather. His role has been to back the president unreservedly throughout the 3.5 years of his administration. Don't count on Mike Pence to be the key figure here. If there is anyone, it would be a family member. It would be Jared Kushner or Ivanka, who convinces the president to move on.
I mean, I know by reports that Mr. Kushner has been actively involved in this, and centered around that is fundraising. Marty, have you been able to translate with our Craig Gordon the urgency of the need to raise money by Mr. Trump?
Well, he was very challenged at the end of the campaign in terms of coming up with campaign funds, and there are pleas going out for defense funds. What's interesting about that is if these court cases, which don't look like they're going anywhere, end, that fundraising still continues, and he can use those funds basically any way he wants.
Marty Schenker, thank you so much. Our Chief Content Officer today. It's just an exhausting period here from November 3rd, and it still continues. Again, if you're just joining us worldwide, Arizona has gone for Biden. That is now essentially official, if not certified. And also the Chinese have said greetings to the president-elect. We say greetings to Bonnie Greer. She is the former chancellor of Kingston University. She is someone with an eclectic view of the special relationship, because she has lived the special relationship. Enjoying Broadway years ago, she said, forget about that. I'm going to London and be a star. And she joins us this morning as well. Bonnie, you've got such a twisted interpretation of this. I'm just going to go to it. Can you fathom the restoration of a special relationship as to be something of old with President Biden and Prime Minister Johnson?
Can I just say quickly, really great to be on with both of you. And just to say that, Tom, I remember the Nixon ballet too. The difference was that it was backstage, and the finale was in a helicopter on the South Lawn. That's all we saw. So this is a very, very different now. The special relationship is something I think for most Americans, a kind of gauzy, mythical thing. People don't actually know what it is, but it's a nice thing to have around, especially when you want to come for a visit. But as far as it being integral, I think, to most Americans' life, it doesn't exist. However, the British people are led to believe that it does, and this is where the clash is.
I look at the clash, and I look at the times that we are in. Bonnie, you have lived this so much, is the tension of race and the new redefinition of race. How should Prime Minister Biden address these sensitive issues with his heritage within the Democratic Party and also of trying to find something modern?
I think the great thing about Joe Biden is that he's been a member of the Senate Foreign Relations Committee for almost 100 years, basically. So he's a diplomat. He understands what needs to be done. He's also, and I've said this many times, he's very proud of his Irish ancestry and his Irish roots. So I think what the people of Britain have to understand is that Joe Biden, and this is true of the Congress and the Senate too, there are no votes in harming Ireland or the GFA in any way. So President-elect will be very, very conscious of that, very careful of that. And this present government better really get clear about this, that Ireland is very important to him. And whatever agreement comes up has to include Ireland in a good way.
Bonnie Greer, how will Kamala Harris actually change U.S. politics?
Well, she already has, Francine, by actually being elected. It's an incredible act, and it shows the dynamism. And I'm very proud of the United States, actually, and all this mayhem, that the American people were able to do this. What she's done is, of course, give a kind of sanction and also permission to young people, especially young people of color, and children of immigrants, to feel that the American dream is possible for them. Because America, as Tom knows, is an experiment. It is not anything set in stone. And what this president has done is bust the norms, which has really held us together. And Vice President-elect Harris is going to actually restore some of those by her very being, and restore the dream. And that's the thing that holds us together.
Bonnie Greer, and we all understand that representation matters. The vice president, is there usually someone to support the president? But can Kamala Harris actually forge her own path in pushing through reforms that will concretely help minorities in the U.S.?
Joe Biden, one of the things that he asked of Barack Obama when he was picked to be vice president, he said, Barack, make sure I'm the last person in the room. And Vice President-elect Harris will be the last person in the room. And that, on so many levels, is so important. She brings an enormous breadth of experience and also life experience. So she's going to change things, and she's going to change policy. Absolutely. I think she'll be co-president.
Just so as everybody understands here, and I think this is important, in the 1980s, it was cool to talk about going to the Edinburgh Festival. Bonnie Greer actually did this. She has a visceral understanding of Scotland and Britain because, well, she did it. Bonnie, is the Union really threatened? I mean, you are the outsider within the zeitgeist of the United Kingdom. From where you sit, is the Union actually threatened?
Yeah, I feel enormous respect for the independence movement in Scotland and for the people of Scotland. I feel a little strange about saying this to reply to you, Tom, because I am a naturalized citizen and I took an oath of allegiance, and I am a person.
Stop, Prince
Hang
Charles.
on, let me just say this.
Prince Charles blessed you. Stop it.
Wait a minute, hang on. Let me say it. So I need to. It's important for me not to say there's a breakup, but the people of Scotland, they want their independence, or many of them, and that has to be listened to. You have to listen to people's cries for independence.
Bonnie Greer, thank you so much for joining us.
Thank you, Tom.
Tumultuous
Thank you,
times for the
Francine.
United Kingdom, and of course, her thoughts on her Chicago and America as well. Futures up 32. Not a bad Friday here as we slide into the holiday season. Adam Posen will brief us on the outlook for December in 2021, the synthesis of our economics with all that we speak about each day. Adam Posen, we do that next. This is Bloomberg. Good morning.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
That is certainly good and welcome news for the medium term, although significant challenges and uncertainties remain about timing, production, distribution, and the efficacy for different groups. And from our standpoint, it's just too soon to assess with any confidence the implications of the news for the path of the economy, especially in the near term.
Gradually, as we get more news on the vaccine situation, I hope that not only will it obviously give encouragement and hope. It will also start to begin to reduce that level of uncertainty over the outlook for the future. Now, we're not really there yet, as Jay has said, but that is important, I think, for monetary policy, because we are having to make monetary policy in conditions of extreme uncertainty.
I don't want to, be exuberant about this vaccination. Because there are still uncertainty about the logistic, about the transportation, about the rolling out, about the fabrication, about the number of people that will be vaccinated in the course of 21, so that we can reach the herd immunity, which will then give us more certainty from the health point of view.
An interesting set of voices there as we really begin to consider on this Friday the path to 2021 and beyond. The perfect gentleman to do this is Adam Posen. Of course, Adam Posen with the Peterson Institute, working with the Bank of England over time, and also, of course, providing so much of the economic discourse in the United States. Dr. Posen, thank you so much for joining us today. Your global review for next year speaks of our existential threats. We all know that, but we have to prosecute or create a process to address those threats. How do we do that?
Thank you, Tom and Francine, for having me. The existential threats, which isn't a term we should toss around lightly, are real. It's climate change, it's the pandemic, and arguably it's the rising in international conflict and the mass unemployment that a pandemic has induced. These all matter greatly. And I think part of the roadmap forward, which we're arguing in a project at the Peterson Institute called Rebuilding the Global Economy, is to recognize that international cooperation isn't sufficient, but is certainly necessary for addressing any of these threats. If you're going to sustain a response to climate change, there has to be some accommodation for the different paces the different regions and countries are going to go in decarbonization, and yet somehow keep it moving forward in terms of the vaccine and the distribution of the vaccine and the limiting of disease that obviously is an international component, and so on. The key point is that we have to rebuild not institutions in some abstract way, but practical measures of international cooperation.
Right. Adam, I want to talk about this balance of the present president, more authoritarian, more go it alone in the United States, versus how we're redefining democracy, perhaps, with a new president as well. How does democracy act, given these existential threats, and get something done? The arch complaint is the wheels just spin and spin and spin. How does America get something done, given the inefficiencies of democracy?
The inefficiencies, and most importantly, Tom, in the U.S. case, the divisions. I mean, it's one thing to have an institution that deadlocks, but it's another thing to have a society that deadlocks. And it's that combination, I think, that has made the U.S. situation so dangerous and so anti-democratic or undermining of democracy. This is, of course, why the pseudo-fascists get in, is as when Mussolini got in the 1920s, a century ago. He made the trains run on time. So can democracies make the trains run on time? And people tend to focus on China doing well after the fact of the epidemic started, and they really have. But remember, there are vibrant democracies like Japan, like Taiwan, like New Zealand, like Australia, like Singapore, which have also done perfectly well by any standard in dealing with the disease. So we've got to stop focusing on these institutions and on these labels. We have to start focusing on getting practical agreements among particular government agencies and particular constituencies. And secondly, we have to focus on government capacity. That is, government, you're going to be hated no matter what you do if you're an elected official. You're going to be suspected no matter what you do. At some point, if you're going to do something, do it right and do it strong and not worry about it, because the mapping between how well you do something in the short term and how ambitious you are versus how you're going to be treated is very irregular. That's a very social sciencey way of saying you might as well go for it.
Adam, how should they go for it in terms of stimulus? Is stimulus, you deal with, of course, the infections and try to contain the virus, but what do you need to do economically?
Well, economically, Francine, as you've discussed, I know because I watch, as you've discussed several times yourselves and with guests, is first and foremost is you've got to get the virus under control as best you can. And that's not a question of lockdown versus not. It's increasingly a question of tracking, tracing, people having discipline, being very judicious in what you close and what you don't. And the second thing to go into stimulus, as my colleague Jason Furman has argued, as many people are arguing, you need to keep the bridge going until we get to the other side because of the vaccine news, but also because of what we've seen in East Asia Pacific. It is possible to get to the other side. It is a matter of months, God willing. And so in that case, one should be able to sustain the stimulus for small businesses and particularly for unemployed people until then. In the US and some other places, a key component of the stimulus is state and local government or whatever the subnational government support is, because so much of the first responders, the education, the human services depend on those budgets.
That's what we're going to come back with Adam Posen and talk about this, the austerity of the moment, the original austerity of the United Kingdom and what we see out of the U.S. Senate going forward. Dr. Posen with the Peterson Institute. Futures up 33, Dow futures up 285. VIX comes in a stick. We're at that 24-23 level off of the angst of yesterday. What were we, down 300? A nice rebound back here on a Friday. Dollar resilient, euro 118.22. In our next hour, Matthew Hornbach of Morgan Stanley. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here? It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
The outlook for the economy is extraordinarily uncertain and will depend in large part on the success of efforts to keep the virus in check.
They're torturing themselves to explain that they're there, ready, willing, and able.
The Fed has basically done all it can do, with the exception of extreme emergency measures.
This morning, from Phoenix to Beijing, Biden is president. Arizona adds 11 electoral votes to the blue column. Beijing hopes to, quote, move in the same direction. There is no direction from the White House on Mr. Trump's future. A perfect quiet to the markets. The dollar, it is resilient. And there is one direction for the virus, and that is exponential. Fauci says the nation must double down. New York City schools, well, they're likely to close. In the Ivy League, they cancel ice hockey. How will they survive in the Dartmouth bubble? Good morning, everyone. This is Bloomberg Surveillance from New York. Francine Lacroix in London. Francine, the pandemic's really hit in. And in sports-crazy America, I mean, we're really starting to shift into a whole nother round of cancellations. I really wonder, Francine, within media, the Disney earnings yesterday and all that, where will we be in 90 days or 180 days living this pandemic?
Yeah, I agree, Tom, and I think actually the sports angle is one that is extremely significant, and I hear more and more people saying, well, what does it mean also for the future of rights? If you have so much power, if you're able to broadcast it and bring so much pleasure to so many people, then that seems to be like, the future of where this is headed, unless we get a vaccine, Tom. And I was really looking forward to speak to Steen Jacobsen and Adam Posen about inflation and whether, the central banks are right in saying we shouldn't believe all the hype, or at least if we get a vaccine, even if it's quick, it's not a cure-all. So that's one of the things we'll explore further this hour.
The immovable force here, folks, and election 2020 is still ongoing. Thank you, Marty Schenker, for that observation, is to get into the weekend and somehow stagger through the holiday season. You really wonder, Francine, what the news flow will be about 8 p.m. tonight within the United States of America. In New York City, with our First Word News, here's Karina Mitchell.
Tom, state and federal election officials are rejecting President Trump's claims of widespread voting fraud. In a statement, they say last week's election was the most secure in American history. They say there's no evidence that any voting system deleted or lost votes, changed votes, or was in any way compromised. In other news, China has congratulated Joe Biden and Kamala Harris on winning the presidential election. That ended days of speculation about when Beijing would formally acknowledge the victory. China was one of the few countries that had so far withheld comment. The reaction came after several television networks projected Biden would defeat Donald Trump in Arizona. Meanwhile, it is the latest move by the White House to pressure Beijing. President Trump has signed an executive order barring American investments in Chinese companies owned or controlled by the military. The order says that China is exploiting American capital to develop its military, intelligence, and other security apparatuses. And in the UK, Prime Minister Boris Johnson's most powerful aide is quitting. Bloomberg has learned that Dominic Cummings will leave by the end of the year. Cummings was the second key advisor to Johnson to depart after tensions blew up over the way the inner circle operates. He was the mastermind of the successful Brexit campaign. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg. Tom.
Karina, thanks so much. Futures up 32, Dow futures up 260. The level on Dow, 29,251. The VIX, 24.07. Other than that, really a churn to the market. The 10-year, 0.89%, not giving me much information. Dollar resilient, that has been, I think, the surprise for the week. Francine, I want to note oil above $40 on American oil.
Yeah, Tom, I don't think there's that much going on in the markets, which I have to say is probably significant in itself. Investors got a further reminder late yesterday of the risks to the recovery after 3 of the world's top central bankers warned that the prospect of a vaccine isn't enough to put an end to the economic challenges created by the pandemic. And here in the UK, there was also reports of record infections despite the tightening lockdown. I would watch just maybe pound 131.78 just because of everything that's going around in Downing Street with resignations of 2 top aides to the Prime Minister Boris Johnson and infighting within his camp.
Adam Posen is with us. He's with the Peterson Institute. He's been just someone with such wisdom on fiscal and monetary matters. We've been looking at the more larger existential picture, as the fancy people say. Right now, we get down to earth. Adam, it's real simple. The unemployment rate published, the U3 statistic, is not grim, but it's really not quite good. But much more importantly, secondary, tertiary labor statistics are outright grim. We have 2 Americas. Can the Fed bring together those Americas, or is it just a PR stunt?
Definitely much more than a PR stunt, Tom, at least in terms of intent. Thirty, 40 years, an particularly women dropping out of the workforce or being forced out of the workforce by the pandemic is a global issue. So the central banks, starting with the Fed's very brave and right moves in September to restate their framework, that they're going to err on the side of seeing how tight labor markets can go before they start worrying about inflation, was absolutely the right move. But as I've said, monetary policy in this world that we're in fact, in the secular stagnation, low inflation, low interest rate world, monetary policy plays good defense, but it can't play offense well.
Adam, this is so important. Out of 08-09, we learned the wonders of austerity across continental Europe. We now have in the United States a Senate preaching austerity. I think of the senator from Texas, Mr. Cruz, is just one example of that, not the only voice on this. Where did the theology of austerity come from? Explain to us, is it like a Protestant Calvinist Detrius? How did we get to institutions so austere that they don't want to fund cities, towns under crisis?
Under crisis, when it's clear that funding them would have great multipliers in both human terms and economic terms, and when the cost is minimal because of interest rates being so low. I mean, let's make it as stark as it really is. The austerity repeated mistake is a combination of things. Right now, of course, Senator Cruz is completely playing hypocrisy because he was all for tax cuts that were unfunded when the Republicans had the presidency. With a President-elect Biden, suddenly he's found religion on austerity. So let's not look cynically at the Senate. The reason these kinds of moves have resonance is because, as you say, there is this moralistic tone and this fallacy that David Cameron engaged in 2010 in the UK, that the German leadership engaged in 2012, and 2010 through 2012 in the Euro crisis, that the household balance sheet is a perfect analogy to the country's balance sheet. And that's not true, because the country has both borrowing capacities that households never do, and the country has a spillover effect that is contained within the country, that when you remove the budget constraint or loosen the budget constraint, you can't remove it, but loosen the budget constraint for various people spending within the country, most of that money comes back in through the multiplier. It's not like if I go out and go into debt going to Panera or McDonald's, I don't capture the benefits to Panera, McDonald's, and their employees. That fundamental fallacy is there. My dissertation advisor, Ben Friedman, professor at Harvard, has a new book coming out at the end of January about these moral notions going back to Adam Smith and Jeremy Bentham in the late 18th century and how they persist to today.
Okay. Well, I don't mean to interrupt, but Francine, mark a note for January. We got to get Ben Friedman and Adam Posen on together on this issue at some point.
Yeah, Adam can also come back in December. Let's do it like a monthly catch-up. Adam, what can you tell us about inflation? How do you see inflation from now until, I guess, a vaccine distribution?
I mean, Francine, I think President Lagarde, Governor Bailey, Chair Powell, all of whom you had the clip, were speaking at the ECB's virtual annual conference yesterday, are rightly playing down the hopes. This is partly just the generic thing of a central banker doesn't want to get out on a limb and be overly optimistic, but it's partly because of the labor market slack we were just talking about. And when you have that much labor market slack, it's very hard to get inflation. It's very hard in an advanced economy without getting wage growth like we were finally starting to get at the end of 2019, start of 2020 in the US. Without that, it's almost impossible. Vaccine-oriented fields
still don't know exactly what will be signed on, but what kind of UK economy will we be left with, given also the number of infections rising significantly because of COVID?
Sure. And Francine, I appreciate your continuing to have the dialogue with me about Brexit. We started talking about this obviously in 2016. And what's sad is incentive to do more than a bare bones deal. An investment destination, you lose market share on services in the gears. Third, that there are things that can be done to avoid the short-term disruption. Yourself, you're putting up barriers with your largest, most significant trading partner, no matter what deal you make, WTO terms or something different. That's what 50% of your trade and a larger share of all your economic interconnections with Europe that have developed over centuries overnight.
The Newtonian Posen on a Friday. Thank you so much, Adam Posen, with the Peterson Institute. Greatly appreciate the thoughts.
Give you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
We don't have a sort of fixed order of use of tools, and I think that's appropriate. It would always be dependent upon the state of the world and the state of the economy that we found ourselves in.
This is Bloomberg Surveillance. I'm Karina Mitchell with the Bloomberg Business Flash. Shares of Disney jumped. The world's largest entertainment company added more online subscribers than predicted last quarter. Disney is still reeling from the impact of the pandemic, but the growth of the Disney Plus streaming service has softened the blow. And gains at the ABC broadcast network contributed to a smaller than expected fourth quarter loss. Meanwhile, shares of Cisco Systems are rising today. The company's fiscal second quarter forecast indicated it will beat analyst projections. It also suggested corporations and governments are starting to spend again on networking gear. And the Trump administration has backed off from its threat to ban the video sharing app TikTok in the U.S. The app's Chinese owner ByteDance faced the prospect of a ban starting yesterday, but judges have blocked the prohibition from taking effect. And now the Commerce Department says it will comply with those court rulings while the legal battle continues. And that's the Bloomberg Business Flash. Francine.
Thank you so much. Now let's look at the markets. The markets, of course, focusing maybe pricing in too much news, positive news that we had from Pfizer earlier today. Tom, I thought it was very telling yesterday to have three central bankers actually saying that, look, the vaccine, when it comes, is not a cure-all. So if you're a stock market picker, what do you do right now? It's very clear that investors are trying to assess the prospect for additional government stimulus to help economies battered by the coronavirus case. And maybe there has been too much, encouraging news priced in on this vaccine, Tom.
Well, it'll be interesting to see. I really want to go through the foreign exchange complex right now with the dollar resilient 92.79 on that DXY. The Bloomberg Dollar Index showing the EM strength, particularly the Pacific Rim strength that we've seen the last number of days. Euro 118.30, yen 104.97, really pretty resilient, stronger yen. You'd think 105, even 106, we're not there. Euro yen has done nothing all week. Euro Swissy shows a back up with a little weaker Swiss franc. Turkish lira off of Mr. Erdogan's change in policy really does better. Lira from an 840, 850 down to 7.66, almost one big figure on lira in a matter of days. Coming up on our simulcast on radio and television, without question, our conversation of the day on the pandemic. Peter Hotez will join us from the Baylor College of Medicine on low cost and global vaccines. This is Bloomberg. Good morning.
Every era presents its own unique set of challenges and opportunities. Trade CME Group futures with Interactive Brokers at low cost and seize the moment. Start investing today at interactivebrokers.com.hk.
So when you went to Baltimore, you went initially to be an anchor woman, and then it didn't quite work out.
Yeah, I got fired.
Well,
demoted.
You got demoted, but they didn't. They had a contract, so they didn't say goodbye. Yeah. And then, how did you work out to be on a afternoon show where you actually got to be an interviewer? How did that actually happen?
Well, what happened was this is what I now know with age and perspective, that many times getting demoted is an opportunity for something else to show up, or getting fired. You know, lots of people I've interviewed over the years who have these stories about the best thing that ever happened to you. It puts you in the next best place. I was not a good television reporter. I was too emotional. I was making $22,000 a year, and my best friend Gail, who I met there at the time, she was also working there. She said, "Oh my God, you're 22, making $22,000. Imagine when you're 25." Then you're 30. So I'd be making 60 about now. It'd be good, 62. Once I got demoted, they didn't want to pay out my contract. I was making $25,000 a year. They didn't want to pay me the $25,000. Right. So they kept me on and said, "We'll put you on this talk show just to run out your contract."
This is Bloomberg Surveillance. Tom and Francine from London and New York. Tom, let's, of course, talk about COVID and some of the vaccinations or treatments out there. GlaxoSmithKline Chief Executive Emma Walmsley says the lessons learned from collaborations between regulators, pharmaceutical companies, and emerging technologies during this pandemic are set to permanently accelerate drug discovery. Well, Walmsley discussed GlaxoSmithKline's COVID-19 vaccine efforts with Carlyle co-founder David Rubenstein.
So how many times a day do people ask you when your vaccine is going to be available?
Yes, well, that's definitely a very regular question, whether it's from employees, customers, governments, media, or my mother. So very frequently. And obviously, we've all been delighted to see the very recent news of some of the first results that's coming through on vaccines. Yesterday, I was just on a call last night with 10 of the global pharma CEOs who are all very heavily involved in bringing solutions to COVID. And we're really excited and optimistic to see some of the first data coming through and looking forward to seeing a lot more in the next 6 months or so. We have 3 vaccines in the clinic and 2 therapeutic treatments.
So some people are not willing to take a vaccination. Some people have said in surveys in the United States, only 25% or less of people say they want to take this vaccine because they think it's either been politicized and not sure it's safe, or some people just don't like vaccines anyway. Are you worried that people won't take the vaccine?
Well, yes, of course. I do think, and we remain concerned about vaccine hesitancy, but we also have to be incredibly respectful about why people have these questions. You know, have we been able to move fast? Have the companies put in the right kind of processes and scales of trials? What transparency are we going to bring to these processes? And why do you hear about things being stopped and started again? What does all of this mean? So I think our job is to make the commitments we have, and we have very publicly about that alongside other manufacturers, but also make sure we share data transparently and partner with governments who ultimately are those that guide in different countries around policies and distributions to reassure people.
Now, you're a member of the Microsoft board.
I am.
So I assume you have a fair degree of background now in technology and IT and other things like that. How have you been able to apply that to what you're doing at GSK?
Well, I would never describe myself as having a background in technology and IT, and I'm absolutely sure that was not why I was brought onto the Microsoft board. But it's an extraordinary company doing extraordinary things in an incredibly responsible way at a time when technology is changing the world and industries, and I believe can be an incredible force for good. It'll be interesting to see what we look back on the 2020s. As standing for and meaning and what evolved. No doubt 2020, loads of people will be writing books about how to lead through a COVID crisis. But I think most of us believe that there will be other, huge global issues that we'll have to address, like climate change and inclusive economic recovery, et cetera. But I also believe health resilience will be on the agenda, and the advances that the world has seen in biology, all of the genetics and genomics data that's coming through, at the same time as the advances the world has seen in AI and machine learning, combined together, have a real shot over the next decade to improve the productivity of R&D and science in my industry incredibly. It is really hard to discover new drugs and vaccines. 90% of them fail. It takes a long time. Obviously, the world is mobilized right now to get to faster solutions. And I hope we learn lessons in our way we partner with regulators and use new technologies to permanently accelerate some of these processes.
Emma Walmsley with GSK, GlaxoSmithKline, with David Rubenstein there and peer-to-peer as well. Let me look at the data check right now. It's a lift to the market. It's a nice Friday lift with some real persistence. I'm going to call it nicely mid-range on this new level, set off the election and set off the Pfizer vaccine comments. The VIX 24.26. What a difference from the 41 level that we saw 3-4 weeks ago. I do make note of oil now nicely above 40. American oil, $40.58. And Francine, Brent crude, $43.10.
Yeah, Tom, one of the things that we really need to try and figure out is that if we now have a vaccine and everything goes back to normal, do we actually avoid some of the biggest scarring in the economy that we've been talking about for the last 5 months? And I think that's what the market is also possibly positioned on. Overall, it's the focus, of course, on the U.S. It's also the focus on, some of these economies battered by these new cases of coronavirus and how much stimulus governments can put out there. The UK, for example, reported record infections despite a tightening lockdown. Then there's the Brexit chatter and, of course, a bit of mayhem with the political advisors of Boris Johnson and pound 131.70. Coming up, we'll have plenty more, of course, on the economy. We'll have plenty more on markets. And this is Bloomberg.
They have been here for quite a while. They have obtained the SPF license back in 2016. They've also been granted a license for the virtual bank. They will continue to play an important role in Hong Kong.
Well, it's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Good morning, everyone. Bloomberg Surveillance, a Friday as we begin to reset here into the holiday season with, as Adam Posen said, existential distractions in our politics and certainly in our pandemic as well. And one of the great mysteries is how all of this folds into economics, finance, investment, and, of course, the great international relations debate. Matthew Hornback is with Morgan Stanley. He's global head of macro strategy, which means no one, including James Gorman, reads more than he does of Morgan Stanley research. Matthew, the really sharp question here is the direction and the when of it. On inflation and on all of the Fisherian linkages of inflation into interest rates, et cetera, et cetera, et cetera, which way will it cut and when?
Thanks, Tom, for having me on. We think inflation is heading higher. I think what you need to remember is that the U.S. economy has a very kind of natural cadence to the way in which it operates over time. And that cadence typically generates around 1.75% core inflation. We don't think that the overall structure of the economy has changed so much so that you're going to see lower rates of inflation than that. Unfortunately, 1.75% core inflation is not what the Fed is trying to achieve. So we think the combination of the Fed's new monetary policy strategy and the natural cadence of the U.S. economy over cycles, it gives a real good chance for the U.S. economy to achieve that 2% inflation goal of the Fed's in the future.
Michael Zezas is in Washington for you. He's terrific on infrastructure and on municipal finance. What does Michael write, and how do you synthesize in the scope and scale of stimulus? We've got the great argument between the Senate and basically everyone else over size and scale. How do you feel that will play out?
Well, it's absolutely correct to bring this topic up because fiscal stimulus, that injection of aggregate demand, is a very important component of raising inflation. So we are looking for about an additional $1 trillion in fiscal stimulus next year in the U.S. Obviously, politics have an important role to play in getting that over the finish line. But we think that's probably about the number that it gets to next year if, of course, the Senate remains in Republican hands. That issue is outstanding, as you know. So once we get past January 5th, we'll have a better idea of how to fine-tune that fiscal stimulus outlook for 2021. But for now, we are expecting more stimulus, and that should help spread that demand around sufficiently enough to get inflation to move back towards 2%. That's the call of Ellen Zentner, our chief U.S. economist.
Matthew, what's your take on if we have a Pfizer vaccine or any other kind of vaccine actually in the next 5 to 6 months, how much will that limit scarring in the economy and how much can that spur inflation?
Well, we absolutely think that the distribution of the vaccine, not only in the United States, of course, Francine, but also around the world, is a very important factor in the 2021 outlook. My sense is that consensus sees this vaccine deployed around the United States, at least in the second quarter of next year. So any earlier time frame than that, of course, would be tremendous for the outlook in 2021. But we do think it's important to get this vaccine out there. In terms of how it will limit scarring in the economy, well, naturally, the faster we can get people back to work, the faster we can get that last person out to be the first person back in, it will naturally limit scarring. That is also a part of our economics forecast. So we definitely think that the distribution of the vaccine next year is an important contributor to the outlook.
Can we be importing inflation from China even if we don't have a significant stimulus from the U.S.?
Well, I think trade policy with China is going to be a very interesting issue in 2021. To what degree do tariffs come off, if at all? That will naturally be an important factor. What we saw in 2018, 2019, as those tariffs were going on, is we did see certain sectors of the U.S. inflation basket experience higher rates of inflation than you would normally see. But the overall picture, as you know, for inflation, was that it couldn't sustain that 2% level in the face of those tariffs. So to the extent that those tariffs are gradually withdrawn, that may, in fact, present a brighter outlook for inflation as we make our way into 2022 and beyond. Our economists, of course, don't have specific calls on the tariff outlook. That's the purview of Michael Zezas, our chief U.S. public policy strategist. But nevertheless, we do still have inflation making its way back to 2% as we make our way into 2022. And that's really the key focus for us.
Matthew Hornbach, thank you so much for joining us today. Morgan Stanley Global Head of Macro Strategy. You're too short a view there, but again, here in the mid of November, we're really coming up on a lot of views forward for 2021. I'm sure we'll hear much from Morgan Stanley. With our First Word News in New York City, here's Karina Mitchell.
Okay, Tom, thank you. Federal and state election officials couldn't disagree more with President Trump. The president has made baseless claims of widespread voting fraud, but officials who supervised the vote call it the most secure in U.S. history. They say there's no evidence the system lost or changed votes or was otherwise compromised. Meanwhile, some congressional Republicans are splitting with President Trump over his refusal to acknowledge the outcome of the election. They say Joe Biden should receive presidential-level intelligence briefings. President Trump started getting briefed a week after his election in 2016. So far, he's refused to allow Biden to get the same information. European Union officials say it's make-your-mind-up time for British Prime Minister Boris Johnson. Another week of Brexit negotiations end today with little progress. EU officials insist that reaching a deal will require Johnson to move first. That is a position their British counterparts reject. And the CEO of GlaxoSmithKline says the pandemic has been a huge learning experience for drug makers and regulators. Emma Walmsley spoke with David Rubenstein for the latest episode of the David Rubenstein Show Peer-to-Peer Conversations.
The world is mobilized right now to get to faster solutions. And I hope we learn lessons in our way we partner with regulators and use new technologies to permanently accelerate some of these processes.
And don't miss more of David Rubenstein's conversation with GSK CEO Emma Walmsley next Wednesday at 9 p.m. New York time. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg. Tom.
Karina, thank you so much. Greatly appreciate that this morning. We've got much more coming up. Futures up 27, Dow futures up 231 as well. Please stay with us through the morning on economics, finance, and yes, our continuing political coverage. David Weston, Balance of Power. Look for that at 12 noon. This is Bloomberg. Good morning.
It came in better than expected, not only in terms of job creation, but also a sharp fall in the unemployment rate consistent with higher labor force participation. That's really good news.
Overall, the gain was solid, but even while this is a very robust pace of job gains, it's a lot slower than it has been in the summer months.
Great that we saw the job gains we did, but they still are diminished from what they were, of course, back in April and May. And the scarring, the sort of wounds that were created by COVID are beginning to fester.
I would caution people to look at the top line number because I don't think it tells the entire story. Employment relative to population is still well below where we were pre-crisis, and that's because I think that we're going to have some lasting damage.
Depending on what you look at, jobs creation or the unemployment rate, you have different views as to whether the improvement in the labor force is keeping up or slowing down.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Despite the many challenges and hardships, I'm proud to say we have been steadfast in effectively managing our businesses under enormously difficult circumstances. We haven't just persevered during these tough times, we've also taken a number of deliberate steps and smart risks that have positioned our company for greater long-term growth.
It has been extraordinary. There, the Disney report from yesterday, Robert Chapek reporting. But if you look at the share price of Disney, it's like, well, wait a minute, that's the one stock that should have got hammered. And yet they have not. Michael Nathanson joins now with MoffettNathanson, a founder there with Craig Moffett, with acute research on all of this stuff we're living right now. Michael, did you predict that Disney would be so resilient?
No, Tom. I did not predict that Disney stock price would be so resilient. You know, I've been through 2 recessions with Disney, and usually, you know, the weakness in the parks and advertising pressures the stock for a while.
Right.
This is not that time.
Okay, so I watched the next episode of Mandalorian, and he's the hero, and they're doing all the Star Wars stuff, and they're paying Jon Favreau more money than God. I get it. Is anybody profiting off Mandalorian?
Jon Favreau is, yes. No, at this point, like Netflix, you're looking out a few years, and you're saying, I could see in 3 or 4 years how big this business is going to be. And that's what you need to do. You need to basically go out to 2024 and start discounting back once you see the profits in 2024.
Michael, I mean, I don't make predictions, but we use so much of the streaming service of Disney Plus that it's actually no wonder that they're doing so well. But at the moment, they're just chipping away at Netflix. You know, is this a trend that can continue? Does it stop if we have a vaccine and, you know, everybody goes back to work?
Well, it's a good question. You're seeing a pull forward, right? What happened in the early part of the pandemic was there's been a pull forward of subscribers. What Disney has, I think that's going to happen, right? Once things open up again, whenever that is, the streaming trends will slow, but they're inevitable, right? It's a more efficient way to watch television. It's just a better product than watching our old-fashioned, pay TV bundle at this point.
Well, I mean, but people are going here to vengeance. Michael, take it beyond Disney as well. Looking into 2021, is it a pricing that has occurred off pandemic, or can there actually be an acceleration up the income statement?
Well, Tom, you're gonna. It depends on when we open up, right? But in this last quarter, Disney's park business fell by 61%. They lost over $1 billion, right? So at some point, logically, when you start getting the economy open, Disney has a massive benefit in improving the parks, and then the studio as well, where they can't release films. And you would also argue live sports have been impacted because of all the cancellations, right? So they become a COVID-19 winner. I guess the opening of the economy, they become a winner, right? So they benefit from streaming when the economy is closed, and when the economy opens up, they have some natural places to win. For our view is that the stock is pretty much back to where it was even before the pandemic occurred, and the earnings have been crushed. It seems like we've just basically priced the recovery in right away, and that's been our challenge.
Dovetail it into Craig Moffitt's world as well. I mean, it is Moffett-Nathanson. It's rumored you don't speak to each other, but let's try it on a collegial Friday. I mean, the distribution world, the Comcast world, how does that dovetail into the pandemic and to the streaming success? Yeah,
that's a good question. We're much more bullish in our shop on Craig's coverage, so good for him. What we've observed, and you've observed too, is just the importance of broadband to anyone who is working from home. But to Francine's point about the growth of streaming, you can't stream without great broadband. So Craig's companies, his cable companies, Comcast and Charter, are benefiting, and they've benefited for a long time from rolling out faster and faster broadband speeds. They have pricing power. They have unit volume growth. We think that's where investors should be positioned. So we're very much overweight cables, Craig's companies, and we're neutral to negative on my view on my companies, because this trend of moving to broadband and streaming is bad for the video bundle, and my companies really don't have another way besides Disney to move away from their old model effectively. So Disney is the only company that has shown their ability to pivot. And the rest of the sector is going to have a hard time making this transition.
But Michael, what can challenge actually, the Disney Plus streaming service, especially in emerging markets? Are we going to see more Chinese streaming service companies coming online, and will that really, take the brunt of the market share?
Oh, Francine, what's interesting, the emerging market, we called this out in our note. Emerging markets, really, India has been a godsend for Disney. They bought a business from Fox called Star, and they have about 25% of their streaming customers are now in India. And they basically are leveraging their Disney content and some Indian content and sports rights. So at this point, developing markets, namely India and Indonesia, have been good for Disney. I don't see the Chinese services really, in India and Indonesia taking a lot of share. Disney has the secret sauce of their brands, their library. So developing markets are really good for Disney in the name of India, and that's one of the benefits of buying Fox, is they got a good position in India, and that's a nice part of the story right now for them.
All right, thank you so much, Michael Nathanson there, MoffettNathanson, founding partner and senior research analyst. Now, coming up, we'll have plenty more, of course, on some of these streaming services. We'll also talk about COVID-19 as we continue to track the virus. Coming up next, Dr. Andrew Pekos, Johns Hopkins University Bloomberg School of Public Health professor and virologist. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here? It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
We explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe. This is Bloomberg Surveillance. I'm Francine Lacqua here in London, Tom Keene in New York. Now, as we continue to track the virus, Bloomberg has developed a unique partnership with the leading authority on COVID-19, and Johns Hopkins has been at the forefront of the international response. And every day, at the same time, we bring you insight from experts in public health, infectious disease, and emergency preparedness. Well, joining us today is Andrew Pekosh. He's Johns Hopkins University Bloomberg School of Public Health professor and virologist. Dr. Pekosh, thank you for joining us. When you look at the Pfizer news this week, are we putting too much hope on this? What are the main concerns that you have? Is it how you distribute it, or actually just that the trial will mean a vaccine in the next 2 to 3 months?
Well, first, it's good to be optimistic, and certainly the press release gave us very good numbers for the initial vaccine efficacy studies with that vaccine. I think Pfizer is the first of several of the same kind of vaccines, so that also bodes well for some of the other clinical trials that are going on. I think it's always the granularity of the data. We have to realize that it's very different to vaccinate children versus adults versus the elderly. So we don't know any of that information in terms of how well different groups were responding and being protected. And I think the issue with Pfizer that really comes through is in terms of distribution, becomes the cold chain that's needed. That vaccine needs to be stored at very cold temperatures to ensure long-term stability, and that infrastructure may be a challenge in terms of distributing the vaccine eventually.
What do the mink farms in Denmark actually tell us about how this virus is changing?
Yeah, so it's another important question. We haven't seen the firm scientific data yet, but it seems like the virus has made a jump into the mink population from humans. That's actually occurred in multiple countries around the world. But the unique thing in Denmark is that they've had some transmission in the mink population, and the virus has then come out of minks and back into humans. So that's what we call a reverse zoonosis, an animal virus, a human virus going into animals and then coming back into humans. The important thing, though, is that virus has a couple of changes in its surface protein that appear to affect the ability of antibodies to bind to that. So it'll be very important for us to really keep monitoring that outbreak in Denmark to see if this virus really is something that's a little bit different. The analogy I use is influenza, where we have seasonal changes in the virus that force us to update the vaccine on an annual basis. So this may be an example of the virus changing in that way. Denmark is using culling of the animals to really control the outbreak, and we'll have to keep monitoring the virus to see how fit that virus is to spread in the human population and how much it really has affected its overall, what we call antigenic structure.
Andrew, can you give me a sense of, once we have the formula, the correct formula, and the vaccine starts being distributed, there will be a list of priorities, right? If you're at risk or a certain age group, when can it be widely available for everyone?
That's going to take some time. There are two things that limit that widespread distribution: the availability of vaccine. The vaccine manufacturers have gotten a head start in many cases in terms of generating their vaccine. But this vaccine requires 2 doses, and that, of course, makes a very big hit in terms of how many people can be effectively immunized. You'll see a scaling up of populations. We'll probably be focusing on frontline responders, healthcare workers, as well as some of the parts of the population that are very susceptible to the severe disease as the first group of individuals that are getting vaccinated. But you won't see widespread distribution of the vaccine to the general public until, I'm guessing, sometime in the middle of next year. Simply because right now we only have one vaccine that looks like it's going to get some approval soon, and it's going to be very limited in terms of the number of people that can be immunized for the first few months.
There are a number of questions, Andrew Pekosh, about testing and whether these are reliable. Positive tests, false positives, false negatives. Elon Musk tweeting about it a couple of hours ago. Does that, do these kind of debates undermine the credibility of what we know works?
Well, we know that a lot of tests have been rolled out under the emergency use authorization. And what that means is that there's signals that the test works well. but it certainly requires more testing to make sure that we have a broader sense of how well it works under very unique situations. So it's important to understand, number one, what test you're getting. Is it an antigen test? Is it a PCR test? And then it's also important to put that into context in that a test itself should never be relied on 100% in terms of providing you some protection. You've got to take the test in context. An antigen test may be borderline positive early in the infection, but by the time you start showing symptoms, it may be a really strong test at that point in time. So we have to understand that testing is not the be-all, end-all solution here. It's one part of our approach to this outbreak that can limit the spread of the virus, which, as everybody knows, particularly in the U.S. and in parts of Europe, is just incredibly widespread today.
Thank you so much, Dr. Andrew Pekosh there of Johns Hopkins. And be sure to check out VRUS Go on the Bloomberg for the latest information. You can also tune in every day, of course, for our exclusive conversations with Johns Hopkins experts for an inside look at battling COVID-19. It is the end of the week. We started off the week with the encouraging news from Pfizer. And as we keep on reading about it, I guess the question is, how long does protection last? This is Bloomberg.
This is Bloomberg Best, your weekly review.
For that mixture.
Growth is
from here. It's a huge market.
Stimulus is necessary in some form. The sooner the better.
The vaccine
is really the game changer here to bring us back to normalcy.
It will take time for the vaccine to be deployed. And in the meantime, and we still have many hurdles.
In the months ahead, we will see perhaps less volatility than we've seen so far this year.
The growth will pick up a lot in the second half of next year as people get back to normal.
We've been in a bull market. We remain in a bull market. If anything, patterns are just magnified.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
From New York and London for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance Live on Bloomberg TV and radio. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. With equity futures nicely positive. Tom Keene, we've got a bookend this week. The hope of Monday with the brutal reality of the COVID statistics in America this Friday morning.
Extraordinary to see how the market levels out after the Pfizer vaccine and, yes, the election on, and there's election news today. We'll do it. John, I love what Greg Villiers published 3 minutes ago with AGF, where he says, look, this is a humanitarian crisis. And another word he uses in his terse note is acceleration. It's not only acceleration of cases and the deaths as well, the tragic deaths. But, John, this is about the medical industry and the hospitalizations. Peter Hotez, scheduled to be with us later this morning.
Looking forward to that. In various places around the country, Tom Keene, as you know, the healthcare system is being overwhelmed. The caseload has gone from about 77,000 at the start of this month in just 11 days to double to in and around 150,000. And we look to policy, Tom. We look to policy. The White House is silent, one. And Congress, the Senate, isn't looking at a fiscal package right now. They're looking at nominating Judy Shelton to the Federal Reserve. Now, we can talk about that a little bit later, but for this market, the policy focus isn't there.
Well, the Beltway's checked out, and what's so interesting here is a congruence or incongruence between the president's seriously sick and the care and treatment he got at Walter Reed, where from sea to shining sea, John, it's just not happening. I can't convey enough to our international audience the strangeness of American media, election, and below the fold is, oh, yeah, here's the math of the pandemic.
We've got a crisis in the bond market. I talked about bookend in the week. Lisa Abramowitz, Monday, yields to the moon. By the time we get to Friday, yields back down to earth again, 88 basis points on a 10-year.
Yeah, and there's a tension right now. I mean, you guys are talking about how there isn't that much pressure in Washington to do anything, and there's a feeling of looking past this all. But markets are doing the exact same thing. They're not giving any pressure. They're saying, look, near term it looks bad, but long term it's great. And the question is scarring, which brings us some of the data that we've been getting, which is deflationary or disinflationary at least. Yesterday we got the CPI data that came in weaker than expected. Today at 8:30 a.m. we get the U.S. October producer price index data, also expected to show a deceleration, highlighting how perhaps demand isn't picking up to the degree that people had expected as the virus takes off and grows exponentially. 10 a.m., and this is going to be interesting, University of Michigan Sentiment Index, a question of how are consumers looking at the pandemic and adjusting their views of the economy as a result, their purchases, their confidence level, versus also looking past it all and looking to a time of a vaccine. And 11 a.m., Nancy Pelosi, the House Speaker, holding a weekly press conference. It'll be very interesting to see how much she emphasizes trying to pass some sort of fiscal package. Mitch McConnell, the Senate leader, really taking the helm here because the Trump administration has basically stepped away and said we want any part of this. So now they have to bridge this $1 trillion gap, with Mitch McConnell saying the economy is doing okay, coming in stronger than expected, which highlights the need for a less large stimulus package akin to what they were looking for in September or October, John.
Lisa, let's get to the markets straight away and talk about bridging that gap between the darkening near-term outlook and the forward outlook improving. That tug of war just continues, and the mood of this market is getting whipsawed by that Monday through Friday. Futures this morning up another 0.7%. We advanced 25 points on euro dollar, basically unchanged at 118.14. But the story, the mood of this market is in the bond market. Monday yields up, hoping for a better future in 2021, and then yields down again as we start to digest and process, Tom, the reality that many economies, many states across America have to introduce new restrictions. Your yield, 88 basis points.
Yeah, and part of that is the election. We're going to get to this later. I know Julian will talk on the markets here, but we should note that Arizona for Biden, that's important in election 2020. And also, John, the Chinese showed up and gave greetings to the president-elect.
Yeah, Tom, what did you make of that? I thought it was interesting that just after this government basically announced a ban on investing in certain Chinese companies, very specific Chinese companies, that China comes out the following morning and says, oh, yeah, congratulations, Mr. Biden.
I would say, John, it's going to be an eventful Friday. I'm uncertain how the president gets to the Sunday talk shows and how he positions himself for his future.
I'm not sure how interested the president is in the Sunday talk shows this coming weekend. Julian Emanuel joins us now of BTIG, the chief equity and derivatives strategist. Julian, let's just start with the week we've just had and just pause for a moment. Monday, positive vaccine news, this cyclical rotation that everyone was looking for. We all want to live in the back half of 2021. It sounds so good. Then we're confronted with the reality of the next few days. Can you walk me through how you're navigating it? I've asked every single guest we've had in this spot that question every single day. What's your response?
It's incredibly challenging, no doubt. And you know, I think to an outside observer or someone who landed from Mars, the idea that you could have profoundly great news on Monday and have a top in the market that looks to us like, you know, it could be the high for the year is very counterintuitive. But again, that's the world of the financial world. But the reality is that you have to get through this transition period from, you know, the hope of the vaccine, whenever that is, with the reality of the fact that, you know, honestly, the virus is really raging out of control. And that's the challenge. And the markets are just trying to digest it. And for now, it's really a standoff, which is not a bad result, to be perfectly frank, given the way the cases are spiking.
I mean, I look at this, Julian, and I think of the great Luis Yamada, who would talk about distribution. We've been distributing within this noise through September and October. What's wrong with going flat for a while?
Nothing's wrong with it, actually. And from our point of view, you know, bull markets correct in various ways. You can have, they correct in time, they correct in price. You know, literally, if you look at it, the NASDAQ topped on September 2nd. Although the other indices made new all-time highs on Monday, this consolidation process has gone on for a couple of months. And from our point of view, again, sideways, really, given the news, would not be a bad thing at all, because we do think the setup for 2021 is quite positive.
Okay, Julian, cautious short-term, long-term, quite positive. What does that mean as an investor? More cash now, looking for an entry point?
No, I think what it means is that if you, first of all, we do believe in the cyclical rotation. So we think you should be reducing some of your exposure to high multiple, high growth, you know, technology-centric, the work-from-home names, because honestly, when you get to a point where the vaccine becomes closer to reality, that will cause an acceleration in this cyclical theme. Rotate into financials. We think healthcare is an exceptionally interesting proposition here, having been battered because of politics, at trading at an extreme discount. If you've got gains, we think optionality is very inexpensive, downside protection, but in general, patience is what's required.
Well, let's talk about that optionality, Julian. I just wonder if a different strategy is the best approach here. It seems to me we've had a series of head fakes over the last 6 to 9 months. What you needed going into Monday was the optionality on a cyclical move and then cash out of it and go back to tech again. And it seems to me that that's worked repeatedly, not just over the last 6 to 9 months, but over the last several years. Every time we've had the rotation head fake, the people that have really benefited from that were the people that had the position going on into the head fake and then used everyone else to fade out of it. I caught up with Mike Collins of PGIM yesterday. He was doing exactly that in credit. He had the cyclical exposure going into this week, used the rally to sell it down. Julian, why is that not the better approach?
Because, again, from our point of view, the psychology factually began to change at the, you know, the parabolic high in the NASDAQ on September 2nd. And we think that the market is giving you information when you look back to Monday, with the NASDAQ being the only major index that didn't make a new all-time high. And when you look toward next year, the hope of a Washington that's going to be centrist, that's likely going to get stimulus over the line, even if it unfortunately does have to wait till a new session of Congress that might engage in infrastructure spending and really taking down the temperature of Washington. All of these things are going to backstop confidence, and we think you get this cyclical recovery that not only is in the U.S., but as we've seen, the monetary authorities in Europe, for one, are going to be as aggressive, if not more, than the U.S., and so you get the cyclical theme playing out in markets like Europe and Japan. It's just a change of psychology, and we've seen a massive momentum shift in the last week that we don't think investors should be ignoring.
Julian, how do you price in economic scarring that stems from what we're experiencing right now with the pandemic?
So that is really the challenge of the concept, and I think part of what that means is that, and this is typical coming out of recessions into recoveries, but it may be more exaggerated this time, is that you get a degree of multiple compression. Because if you get to a point where the next 3 to 6 months you have permanent business closures, an increase in permanent job losses, that means your long-run growth potential shifts in, and the long run, what used to be called NAIRU, shifts higher. And that's a different mindset, given the fact that there's an expectation that people think unemployment will eventually go back to 3.5% or 4%, and that's not going to be the reality if we get economic scarring.
Julian, Tom has been far too quiet for the past couple of minutes for my liking. Can we wind him up just a little bit? And can you give me your view on Judy Schauter potentially being confirmed to the Federal Reserve?
Really, John?
Well, John, I think it really just points to the fact that, Washington has been a bit too political and a bit too backward-looking these last several months. We, like Jay Powell, have been adamant in the need for more stimulus simply because I think...
So, like, backward-looking into the 19th century? Is that where you're heading, Julian?
Well, Williams Jennings Bryan didn't want to perish on the cross of gold. But, frankly, the gold window shut with Richard Nixon. And we need to look forward, and we need to get stimulus, and we need to talk about the issues that had in 2021, not 1963.
John, I can tell that Julian's dresser behind him there with a BTIG sign on it, he's got a stack of Krugerrands in that thing.
Julian, it's great to catch up. Julian Emmanuel there of BTIG. Thank you, sir. Tom, I knew that would get you just a little bit.
Don't even get me started.
The way to bring you back in.
Just
to pull you back in again.
I got no tots this weekend. The international acclaim, John, to brine or not to brine?
We're still on this, huh?
That is the question.
It's a big question.
Big one.
No doubt we'll focus on that all the way through to Thanksgiving. I know our audience can hardly wait. Coming up in the next hour, Dr. Peter Hodes of Baylor College of Medicine. Looking forward to that. Futures positive for our audience worldwide. This is Bloomberg.
With the First Word News, I'm Karina Mitchell. State and federal election officials are rejecting President Trump's claims of widespread voting fraud. In a statement, they say last week's election was the most secure in American history. They say there is no evidence that any voting system deleted or lost votes, changed votes, or was in any way compromised. China has congratulated Joe Biden and Kamala Harris on winning the presidential election. That ended days of speculation about when Beijing would formally acknowledge the victory. China was one of the few countries that had so far withheld comment. The reaction came after several television networks projected Biden would defeat Donald Trump in Arizona. Shares of Disney jumped today. The world's largest entertainment company added more online subscribers than predicted last quarter. Disney is still reeling from the impact of the pandemic, but the growth of the Disney Plus streaming service has softened the blow, and gains at ABC Broadcast Network contributed to a smaller than expected fourth quarter loss. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg.
I don't believe the renminbi will be a viable reserve currency quickly, but I do believe it'll happen much faster than anybody expects. The question is, what is the storehold of wealth in the meantime?
Republican officials who clearly know better are going along with this, are humoring him in this fashion. It is one more step in delegitimizing not just the incoming Biden administration, but democracy generally. And that's a dangerous path.
Former President Barack Obama on CBS's 60 Minutes with a book to sell and a message for Republicans. From New York and London this morning, good morning. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Here's the price action this Friday morning. Good morning to you all. What a week it has been. A week of several narratives. We've talked all week about the near-term risks, the long-term opportunities, the hopes, the tug-of-war between the two. The story in the market right now, equities up another 24 points on the S&P 500, up 0.7%. The bulls on the south side out big time through the week. We can talk about that a little bit later. Euro dollar 118.16, up 0.1%. There's your bond market bid. We bleed lower on 10-year yields, down about a basis point or so, not even, to 0.8783%. And in the commodity market, after a big rally, crude settling down and settling in and around $40 and about 50 cents, Tom.
Yeah, the note for me, John, this week is the dollar resiliency. I mean, of all this, it's been a blur and there's a lot of distractions, but I just look at 92.89 on DXY and go, geez, I don't think I knew it was going to be there. Let's take us forward as we do politics. We do it in our own way with smart voices. One of them is Emily Wilkins, Bloomberg government reporter and surveillance librarian. She joins us right now. Emily, John mentions that Mr. Obama is going to launch a book. I think it's 500, what is it, John, 200 pages? It's like, it's a doorstop, and it's volume
768.
There you go, volume 1, volume 2. Emily, does anybody, you all buy the book, but does anybody actually read it?
I think most people buy it, flip to the back to see if there's an index where their name is mentioned, and then go from there. But I'm sure there will be people in D.C. who are very interested to hear former President Obama's thoughts on his time in the White House.
I am sure you will read the book for us, and we thank you in advance. Emily, we've talked to you a lot this week. What's different about this Friday? What is the focal point on this election this Friday?
So one of the interesting things that we have seen in the last 24 hours is more Republican senators come out and say that Joe Biden needs to start getting intelligence briefings. They don't go as far to say that he's won the election. They're still trying to honor President Trump's push to get cases in the court. But they have started to say that it's important that Joe Biden gets these intelligence briefings that he would get when he does become president of the United States.
Can you talk to us about the latest counts in Arizona and where we are now in a range of states that the president is currently still challenging?
Sure. So Arizona was a little interesting because soon after election night, it got called for Biden by the AP and Fox News. However, several other major networks held out on that call, and we saw the margins in Arizona get pretty slim between Biden and Trump. However, last night, we did see those other networks we were waiting for call Arizona for Biden. This actually brings his number of votes in the Electoral College up to the same level that Trump won with back in 2016.
Meanwhile, Emily, the markets have basically shrugged this all off. They do not see this as a contested election. They see Joe Biden as the winner and going to be the president. Probably the people you speak with say that as well, even if perhaps not on the record. They are moving past that to the question of whether any fiscal support can get passed. So far, it seems like Mitch McConnell is holding on to a skinny deal. It looks like it's very difficult to bridge any gaps with Democrats. Do you expect anything to get done in the next couple of months on that front?
That is a fantastic question, and one I think that everyone is going to be turning to now that the election results are a little bit more decided. What we've seen there is Senator Mitch McConnell go ahead and take over some of the negotiating processes from the White House. Before, it was mostly Democratic Speaker Nancy Pelosi and White House's Steve Mnuchin talking together. Now it seems like Senator Mitch McConnell will have a larger role. And you're right, there is still that divide. We heard Pelosi say yesterday that she wants a big stimulus, that's important to her. And you've heard McConnell just say repeatedly that nothing more than narrow.
Emily, just to cut to the chase here, and I think I have the plot line right. The Republican Senate doesn't want to give money to evil New York, evil Detroit, evil blah, blah, blah. What do they say to Republican cities that are desperate for aid?
Well, Republicans have two arguments to make on that. Number one, they do point to a number of states that are controlled by Democrats who do have debt. But the other argument that they make is that they need to be fiscally responsible, that they've already poured a bunch of money into the economy and that they need to make sure that they're pouring more trillions into the economy. They need to be careful about how they do that. That's why we've seen smaller values for them on what they're proposing in these stimulus bills.
Emily, just a final question from me. The president coming under a lot of criticism over the last week for being silent, and not just silent on the election publicly, but silent on the issue of COVID-19. Hasn't faced the cameras now for a week. Now, Emily, the question that I still can't get an answer to is what the governors of these states that have been hit are asking for and aren't getting right now from the federal government. What are the requests on the table right now that aren't being answered?
I think it's a variety of things, and it does, of course, vary from state to state and governor to governor. More funding, more direction, sort of just more guidance. I think it's easier for a lot of Americans to not necessarily look at their governor, but look at the president and see what they're doing, how they're talking about this. I mean, obviously, COVID is happening, sort of playing out in its own way in every state, but it's also rising in every state. And so I think to a certain extent, there are some governors who are looking for Trump to be that national leader during this time of crisis and give some sort of message to the American people on how we need to move forward.
Not defending the president here, Emily. I'm just trying to work out still, for the governors, what can they do that they can't do without the president's help? For a mask mandate, for instance, I'm surprised that many of these governors still haven't issued statewide mask mandates. Are they waiting for the president to do that for them so they can go out there and enforce it?
Well, even Biden has said that he can't really do a federal mask mandate, even though he wants to, I think, more than Trump does. To be honest, I haven't seen a lot of very specific requests from state governors at this point to the president. I think a number of them have their eyes on Congress and that stimulus there to have something occur, because that's really, Congress is the one with the power of the purse. If you need funding to get things done, you don't look necessarily to the executive branch as much as you look to the legislative branch. And so I think there's a lot of hope there that something can potentially be done in Congress, and that can slow down and help the state.
Emily, thank you. It's great to catch up, as always. Emily Wilkins there, Bloomberg government reporter. I think this is the challenge right now, Tom, how reluctant governors may or may not be right now to issue stay-at-home orders without the fiscal help, without the extra federal aid coming from this government. What moves first? Do they just get desperate and have to do it because the numbers get so bad?
The numbers that are going to get bad is people laid off, and that's the only thing that's going to move Washington. They got to go out and they got to lay off 5,000, 9,000, 12,000, and then maybe, John, you'll get some action. Mr. Foy of the MTA in New York tells me he needs $12 billion into next year. That's a big number.
Alongside Tom Keene and Lisa Brabitz, I'm Jonathan Ferro. Coming up on this programme, Piotr Matis, Rubberbank emerging markets strategist on quite a year so far for emerging markets. And I have to say, pretty much every single cross-asset strategist we speak to wants that EM lean. Why the old, Tom?
The
City of London,
view
you miss
radio, the beautiful view radio of London. It's so beautiful.
It is.
John, it's like 12 degrees here. Slush, sleet.
Beautiful, too.
It's a great day to brine a turkey.
당신의 시간은 합격을 향해 흐르고 있나요? 0823 클래스
it came in better than expected, not only in terms of job creation, but also a sharp fall in the unemployment rate consistent with higher labor force participation. That's really good news.
Overall, the gain was solid, but even while this is a very robust pace of job gains, it's a lot slower than it has been in the summer months.
Great that we saw the job gains we did, but they still are diminished from what they were, of course, back in April and May. And the scarring, the sort of wounds that were created by COVID are beginning to fester.
I would caution people to look at the top line number because I don't think it tells the entire story. Employment relative to population is still well below where we were pre-crisis, and that's because I think that we're going to have some lasting damage.
Depending on what you look at, jobs creation or the unemployment rate, you have different views as to whether the improvement in the labor force is keeping up or slowing down.
From London and New York, this is Bloomberg Surveillance. Let me give you a quick flavour of the price action this Friday. What a week. We started Monday with a huge burst of cyclical appetite. What did that mean? Nasdaq lower, Russell to the moon. Small caps outperforming. Today, everything nicely bid. Get your head around that. The Nasdaq up by about 0.7%. Call it 8. The Russell, the E-mini contract there. Small caps advancing 0.75%. That's the story in the United States. At the start of the week, a bias to the small caps. The back end of the week, a bias to the big cap tech players. Here's Europe on the week. This is the trade that everybody wants to work. The trade into Europe, the cyclicals, deep value, the banks, all of that good stuff. The Euro Stoxx 50 this week up a little more than 7%. The best week since last week when we were up 8%. We have had a huge rally through November. Switch up the board. Let me get to the bond market quickly.
2 weeks.
Let me just wrap things up.
Please.
Top, let me just wrap things up quickly. We're going to get you to do this one day. In the bond market, yields come in down to 17 basis points on a 2-year. I know, the Zimmer frame. Let me get to the 30-year. I'm not sure that would work here to do that, to do the bond market check like that.
I do that, John. You look destined.
30-year yield, 164. I can't even complete this now. The story for me in the 10-year is we end the week basically where we start the week at 87 basis points. I'm going to take a while to get back to my position over there as I just shuttle away. Just a little bit.
That's very good, John. I'll teach you how to use that as well. Farrell just wants to do the Premier League thing. You know, Arsenal, they're doing this, and Chelsea. Lisa, I look at all this, and, you know, I loved what Adam Posen said, Lisa Abramowitz, here earlier this week, where he talked about existential distractions. It's amazing that the market even operates and maybe is our most important measurement now, given all these existential events.
Yeah, well, the market can't totally get its direction clear. I will say, when you talk about the cyclicals and you talk about the banks and the huge boon to them, you look at the yield curve and it's absolutely slammed in. People don't know what to make of long-term growth, which again, with these existential questions, how long-lasting can the conviction in markets, the bullish feel, continue?
It'll be interesting to see. Piotr Mattis joins us now with Rabobank on the one thing that's shown some real consistency here. This is an important conversation, we think, his colleague Jane Foley for giving us some wisdom here earlier in the week. On EM, Piotr, what's so important here is the distinction of the Pacific Rim versus everything else. Is EM doing better, or is it just an Asian story?
Hello, Tom. If you look from the perspective of containing the coronavirus pandemic, definitely Asia is doing much better than, for example, Central Eastern Europe, and this is reflected in the price action with Asian currencies outperforming other EM. But I think that there are lots of reasons to be cautiously optimistic looking into 2021, and I think that the likes of Polish zloty, Hungarian forint, the Czech koruna will be able to catch up with the EM peers in Asia next year.
That's a really important insight. What is the why of the catch-up? Is it aggregate demand turns? Is it something to do with a fiscal impulse? What's the why?
At the moment, those CE currencies are underperforming because the region is fighting with the second wave of the pandemic. But prospects are good. Governments are determined to save as many jobs as possible. We are going to have strong impulse from the EU Reconstruction Fund. Those funds should be redistributed at some stage next year. Interest rates in the region are also very low. So I think that there's going to be strong impulse from domestic demand once the pandemic is under control.
I mean, John, I think it's amazing to see Hungarian forint. It's a 14% depreciation off euro over the last 2 or 3 years. That's a much greater depreciation than I think people understand.
I'd like to bring the dollar into the conversation as well because it's been so resilient through this week, Piotr. We started the week, opened up on the dollar index at 92.72. Right now, 92.88. Can you explain that to me? Piotr, typically what happens, you know the story, cyclical appetite returns, that growth impulse comes back, the dollar gets weaker. Not this week. Why?
I think that the markets have realized after this outburst of optimism on Monday, when this positive news came out about coronavirus vaccine, that there are lots of thresholds that will have to be cleared until vaccine is widely available. So I would see this market tempering a little bit of its optimism. There's some pullback. If we add to that perhaps this transition of power from Trump to Biden could be turbulent, there are essentially some doubts, and the dollar is benefiting from those doubts. But I think that overall, it's going to be difficult for the dollar to resume its bullish momentum.
What are you telling fixed income desks at the moment, Piotr? Because so many of them are thinking about taking on more EM risk. Are you suggesting they take on the local currency risk as well?
Yields across EM are still substantially higher compared to DM. So there's still scope for those for capital inflows to accelerate into EM based on the assumption that 2021 is going to be much better year, a year when we'll be able to return to normality. So I think that capital inflows should accelerate next year.
In the meantime, some people are saying, well, if we do see a vaccine and we do have growth, Piotr, we're going to get more strength in commodities and oil prices, which will be good for commodity-producing emerging markets. Do you buy that argument, given the fact that the IEA has come out and downgraded its expectation for demand since we don't have the vaccine yet and it's going to take a while?
There's still lots of uncertainty, Lisa. Yes, if the global economy gains slightly better momentum, then that's going to push commodity prices higher, and various EM commodity producers, such as Russia, will benefit from that. But, we still have to wait until that uncertainty diminishes. We don't know how quickly vaccine will be redistributed, and until that uncertainty diminishes, I think that commodity prices will struggle to regain upside momentum.
So what's the narrative, Piotr, that you advise clients to use when they're deciding which emerging markets to go for?
I think that what's going to be crucial is that we'll have to differentiate between EM. And yes, at this stage, EM Asia has been outperforming, but there should be rotation towards other EM assets in 2021. I'm going to promote here Central Eastern Europe because this is my area of expertise. So I think that the zloty and other currencies from the region will prove attractive to foreign investors who are looking for opportunities across EM. the countries like Poland, Czech Republic, and Hungary should regain growth momentum much quicker than developed economies, and that makes them attractive.
Piotr, thank you so much. Greatly appreciate it, particularly that update on something I've ignored John Farrell way too much, was the Eastern Europe. John, I think just as one example of these linkages, there's a brutal linkage of euro and franc dynamics into Eastern Europe. It's completely different than America, how many of those nations' tangible asset transactions like housing are linked into euro dynamics.
You remember the story of a decade or so ago, Tom, when many of those countries, including Hungary, borrowed in Swiss francs for mortgages. What happened when the financial crisis came? Swiss franc to the moon. And that was the problem for them. I'm not sure how many people made the same mistake again, but certainly, Tom, it's been a real problem.
Well, it's good to see that here on a Friday. John, I want to take a minute or two here for you to translate for our primetime American audience what is going on at 10 Downing Street. Am I right, John, that it's interesting and it's a soap opera, but at the same time, this is not funny? Am I right on that?
OK, I don't think it's ever funny. I don't think the Brexit conversation is ever that engaging either. But when it comes to the team around the Prime Minister, let's put the names to one side and just think about this. The core group, the pro-Brexit names, are starting to fade away. Resigning, quitting, maybe even getting pushed out by some people. Some people believe that that means we're going down the path towards a deal in the next couple of weeks. That's the signal it sends for some people. Those people who have stepped away from this government to advise the Prime Minister are saying that isn't the case. Many other people, Tom, to complicate it further, a couple of weeks ago before we had the lockdown announcement, it leaked. Many people blame the Prime Minister's advisers for leaking that, and they think that's why they got pushed out. So there's a lot of confusion in the United Kingdom at the moment. The bottom line, Tom, you're right, it's not funny, because what you want is a team together, all pulling in the same direction as we work our way through a crisis in this country. In fact, we don't just have one. We've got potentially two.
John, I mean, in Washington, I would suggest that even the president's most ardent supporters would suggest he's sequestered away. Is Prime Minister Johnson sequestered away?
No, the Prime Minister's got to deal with two issues, Tom. One, he has to deal with the shutdown that we're working our way through. Early December, people think that we might come out of that. I've got my doubts, many others do as well. On top of that, they've got to have a deal done with the European Union before year-end. This government's still working, still functioning, maybe not in the way people would like, but there's two big issues on the table, and I think we all want to see the Prime Minister have a team around him that can execute. And right now, unfortunately, that's not the case.
Sterling, 131.57, really quiescent this week through all of the social uproar and political uproar in the United Kingdom. John, what do you see on the screen? Save me here with a data check on a Friday.
I just think we had a lot of dovishness out of the central bankers yesterday, Tom. Chairman Powell, President Lagarde, Governor Bailey. This from Kit Jukes this morning. They warn against vaccine euphoria but promise easy money. Isn't that the catch-22 right now in the market? That you've got central bankers telling you, don't get carried away here, but at the same time, we're here for you. What do you do if you're a market participant in that environment?
I'm going to note renminbi breaking down as well. I mean, there's a social message here from central bankers as they beg for fiscal relief. But, John, let me know. Lisa, let me know. Where do you see the fiscal relief? I don't see it.
I would agree. John.
Lisa agrees. I agree.
I mean, we've been talking about this all day.
You know, exclusive.
Lisa, Tom knows this. When there's three people in different locations, if you say both of their names and they don't want to step on each other, that's the end result. Come on, Tom. Basics. Coming up, Timothy Nolan, Macquarie Senior Media Analyst. Looking forward to that on the Walt Disney Company. This is Bloomberg.
With the First Word News, I'm Karina Mitchell. Federal and state election officials couldn't disagree more with President Trump. The president has made baseless claims of widespread voting fraud, but officials who supervise the vote call it the most secure in U.S. history. They say there's no evidence the system lost or changed votes or was otherwise compromised. In other news, some congressional Republicans are splitting with President Trump over his refusal to acknowledge the outcome of the election. They say Joe Biden should receive presidential-level intelligence briefings. President Trump started getting briefed a week after his election in 2016. So far, he's refused to allow Biden to get the information. A grim milestone in California. The state has now had more than 1 million coronavirus infections. The CDC says that almost no part of the country has been spared in the disease's latest surge. A new study, however, says the fatality rate of infected people in the U.S. has fallen 30% since April. Still, researchers forecast the deaths could hit 2,200 a day by mid-January. Tesla's billionaire CEO Elon Musk says he's tested positive for the coronavirus. Musk tweeted that he is experiencing symptoms of a, quote, typical cold, nothing unusual so far. Still, Musk was skeptical of the testing process, saying that of 4 tests using the same machine, 2 came back negative. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Path forward is going to be challenging for a number of reasons, and I'm sure we'll get into some of them. And that my sense is that we will need to do more, and that Congress may need to do more as well in fiscal policy. The actual particulars of that are up to Congress and not up to us. but I do think it's likely that more will need to be done in time.
Chairman Powell looking for a dance partner, doesn't have one right now. Alongside President Lagarde, Governor Bailey, really interesting panel in the last 24 hours. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Here's the price action this Friday. Really offensive early this week into the cyclicals, became a little bit more defensive as the trading week grew a little bit older. This morning, we advanced 24 on the S&P 500, up 0.7%. In the bond market, much talk about breaching that 1% level on a US 10-year. We got close at 97, then we pulled all the way back to 88 basis points on a 10-year yield, pretty much flat in this morning's trade. And Tom, as you've pointed out continually through this week, and I think it's one of the more interesting features of this week and perhaps one of the more complex and confusing appetite, that dollar did not.
The president of the pandemic and what it means for the media business is Timothy Nolan. He's at Macquarie Bank, a wonderful career, including with Alan Schwartz over at Bear Stearns a million years ago. Tim Nolan, okay, Disney out, I get it, they're a juggernaut, but even the juggernaut's EBITDA has been cut in half. They've gone from a 29% margin on down to the middle teens as well. How long can the industry sustain where it is given a worsening pandemic?
Sure. Well, first, thanks for having me. You know, Disney is such a large, sprawling organization with so many different parts to the business, including, very importantly now, the direct-to-consumer subscription business, which is kind of carrying it through this downturn here. Certainly Disney can withstand a few years. In our, post-results yesterday, it became even more evident, as we've seen with other cyclical media companies, that things like parks and movie theaters will remain closed for some time, and the recovery will be further drawn out and slower than we had hoped. So we don't have box office and parks revenues getting back to their former levels until 2023, 2024, which is unfortunate. But Disney's done a very good job with the cost cutting. And like I said, and we may want to get into some more here, the direct-to-consumer businesses are flying high.
Well, before we get to the direct-to-consumer, sort of the sexiest part of their business has been the Disney Plus offering. Some people saying they were going to be the Netflix killer. Netflix shares up more than 50% year-to-date. I'm looking at Disney shares down more than 6% year-to-date, although they are up ahead of the market today with more than 3%. Is there justification to this concept that Disney Plus could be a Netflix killer at some point in the future?
I don't view it as a Netflix killer. I view it as another very, very strong direct-to-consumer subscription service. In fact, Disney is now at 75 million subscribers globally. That's going to jump next quarter, actually starting next week when they launch in Latin America. Netflix will be at around 200 million global subscribers end of this year, so next quarter. We have Disney getting to that level in a couple of years on Disney Plus. So I think they are, just different, very popular services. And as we've seen for some time, Amazon Prime has done very well while Netflix has grown. So I think there's room certainly for, let's say, 3, sometimes more in people's wallets of these types of services, and Disney Plus is absolutely one of those. So I see still strong growth for both. The reason Disney stock is down this year, of course, is, as you referenced before, the parks and the studio businesses have just been decimated on the revenue side by the pandemic.
So when do you see, Tim, Disney Plus providing enough of a profit cushion to cushion perhaps the slow recovery of these other businesses?
Mm-hmm. Well, again, some of that depends on the scope of the bounce back. I mean, in the June quarter coming up in fiscal 21, so 2 quarters from now, we'll be cycling against the sharp drop down already from parks and studio. So we have those businesses actually growing again, just because the year-over-year comparison gets much, much easier. And let's hope that we're getting, parks visitation and box offices back up again. But like I said, it's a few years until you get back to the revenue levels of before in those businesses, even assuming that they do get back to where they once were. Box office is another question, whether there's another direct-to-consumer wave coming, for movies, as opposed to pushing the box office as much. Direct-to-consumer, meanwhile, we'll find out a lot more on December 10th when Disney has its investor day. There may well be a big announcement of a lot more investment to come. They've got the Star International launch. Disney Plus has done so well, you would think they might want to invest more into that to grow it even further. So there may still be, a few years of downside in terms of earnings, in terms of the direct-to-consumer services. I just think in terms of the stock, it doesn't really matter that much. We know now that Disney is a direct-to-consumer, powerful player, and that is what matters in people's minds, and that will keep things going.
Tim Nolan, thank you so much. Greatly appreciate it with Macquarie Bank on Disney. Coming up, we're going to talk with James Bevan of CCLA, their Chief Investment Officer. I'm really looking forward to that, John. I mean, I think Bevan has a whole scope and scale of growthiness and value in big cap, which we haven't talked enough about this week.
Well, Tom, something we've got to add to is something you mentioned earlier this week, is how companies have responded. They faced a really big stress test earlier this year. Are they in a better position to deal with any potential restrictions, maybe even shutdowns around the corner in the United States in the coming months as well? Take the Walt Disney Company. About 30-odd% of that business is the resorts business, Tom. Parks, experiences, products, all of that. Talked about it just then. Now we're starting to build up the direct-to-consumer side of things, the streaming business as well. That's going to give it a nice little hedge in the years to come in situations like this, which we all hope we don't have to face again. But I thought it was interesting hearing from the Starbucks chief executive in the last couple of weeks too, Tom, basically saying we know how to live and work in this environment now. Some of these companies, they've been stress tested once. Let's hope they fare better this time around as we work our way through a very cold winter.
Well, we're going to go through a cold winter, but, and again, this goes to the pandemic as well as the perfect weather, John, that we've had here in New York drifts away. I think there's no other way to put it. November is finally here, and you really what that means. And, John, I'll be honest, I'm listening for the mayor of New York or the governor of this Empire State to speak today on schools. I'm not predicting that, but my ears are up for that. And again, as we saw the market react yesterday, you wonder how the market will take it on this Friday.
Reacting to the mayor of Chicago issuing that stay-at-home advisory. Alongside Tom Keene and Lisa Bravitz, I'm Jonathan Ferro. Much more still to come on this. The near-term risks are clear. We all understand them. The direction of travel of the pandemic, not great. The restrictions, there are more of them coming through the United States of America. You pair that with the tug of war on the other side, the pull of the hope of the back half of 2021. And that's the challenge in this market. A big challenge. Futures higher, up 24. We advanced 0.7%. Up next on this program, James Bevan of CCLA from London and New York this morning. Good morning. This is Bloomberg.
The big concern is climate change. We can see the global warming accelerating at the moment, and the goals that we must hit are so ambitious. It's 1.5 degrees by 2050, being climate neutral in terms of emissions by 2050. That's a huge challenge. We have to reduce emissions by 50%, 2030, 2040 again. It's very, very ambitious, and mobility plays such a crucial role in there. One thing is to do it in developed countries. I think we're going to get there by 2030, but then the rest of the world, and that's just as important. If you look at developing countries, emerging countries, that's where probably the biggest challenge we are going to face, to also deploy EVs there and make mobility greener in those countries. I know it's possible to move mobility forward fast enough to be able to do its part in this fundamental threat that we're facing.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
We would love, at the right time and the right way to have a digital bank license. We would almost certainly do that in partnership with a strong local partner, and we would use the technology and the experience that we've gained from Mox in Hong Kong.
Give you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
Stimulus is necessary in some form. The sooner the better.
The vaccine is really the game changer here to bring us back to normalcy.
It will take time for the vaccine to be deployed, and in the meantime, we still have many hurdles.
In the months ahead, we will see perhaps less volatility than we've seen so far this year.
The growth will pick up a lot in the second half of next year as people get back to normal.
We've been in a bull market. We remain in a bull market. If anything, patterns are just magnified.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. This is Bloomberg Surveillance, a simulcast. Good morning on Bloomberg Radio from coast to coast. Good morning on Bloomberg Television. It is extraordinary to be mid-November, John Farrow. It is the beginning on Global Wall Street of the holiday season, and I can never think, even the tragedy of September 11th, I can't imagine how non-holiday season this will be. This pandemic is out of control.
It's a blessing, Tom, that it's not as cold as it typically is in the northeast of the United States at the moment, particularly in New York, as you've experienced over the last couple of weeks. But the numbers are terrible. We talked about it an hour ago. We started this month with daily infections of in and around 75, 80,000. That's doubled in 11 days. And as healthcare capacity gets tested, governors, mayors start to introduce more restrictions. What happens? Consumers disengage, and the economic momentum that we still have, luckily, going into the fourth quarter in the United States, starts to fade. Here's the critical issue. Who's going to step in? Where's the fiscal policymaker? Bob Prince of Bridgewater said this several months ago. Tom, we've got a duration mismatch between the length of the pandemic and the willingness of fiscal policymakers to do something in equal length.
And since Mr. Prince said that, it has widened out. That mismatch, without question, folks, is widened. Lisa, what is so important here is to gauge the pandemic, and we're all doing that on a local basis. You and I, we hear more sirens now once again in New York City, and we're all dealing with the announcements to come and widely expected in Manhattan and the 5 boroughs.
Okay, I'm not going to be gloom and doom because Vet Bill went and got a turkey for you yesterday in Central Park. So I will tell you this. I am not going to go gloom and doom. People feel optimistic this week, even though we are seeing this. And the reason why is because there's a feeling it will end. You have even Anthony Fauci coming out and saying the pandemic will end. The vaccine is effective. My question, Tom, is how much do companies ramp up spending? How much do consumers feel freer to spend, even if it looks pretty bleak on a near-term basis, because they do believe that the jobs will come back? How much will the hope carry out into actuality during a very bleak time?
John, what are we going to see in the weekend notes on that theme. I mean, the arch issue here is monetary authorities begging for fiscal, a great debate nation to nation, state to state on what fiscal means, and yet some of the data shows a supportive economy.
We had a shock to incomes 8 months ago, Tom. We didn't have an income crisis. In fact, disposable income went up in America because fiscal policy responded.
No question.
The last thing we want to see in 4Q in the United States is a shock to income without that income replacement coming from the federal government. That's the huge risk to this market. For market participants, you want to know about the notes for the next 12 months. Where do you want to live? Back end of 2021? Or in the here and now? And if you're living in the back end of 21, you've got a different outlook. If you're living in the here and now, you've got a very, very different outlook going the other way.
Let me get through the data quickly here. Oil elevated above 40, the dollar resilient this morning, yen 104.86. And in the equity markets, green on the screen up 23 on SPX, Dow up 202. And the VIX is really remarkable, from a 41 down to 24. And there's only one person buying at 41, and that was James Bevan, who was long with CCLA. He is one of our most acute voices on conservative, more long-term investment, and he has been right in this bull market. James Bevan, can you maintain your optimism with the changed pandemic?
I certainly can, Tom. When I think about fiscal policy, the big question, as you have correctly articulated, is whether or not we would see more spending to get us out of the other side of the current economic downturn. And I believe, interestingly, the government will now be prepared to spend more precisely because the vaccine gives them confidence that there really will be an end to the COVID-19 crisis in due course. That, to me, suggests that we will see genuine economic recovery, we will see corporate earnings growth, we will see investors prepared to pay more. Because if I am correct that the central bank will continue to buy bonds, yields will stay low, well below the rate of inflation. That's great for mathematics for equities, it's excellent for company balance sheets, and quite clearly it's very supportive for consumers that in due course will want to be able to spend a lot more money.
James, what you describe is working here in the United Kingdom, that beautiful choreography between the Treasury and the Bank of England. Can you say the same thing about the US right now?
Well, you know, very interestingly, I think there was a broad expectation that had there been a blue sweep, we would have seen Mr. Biden asking and getting perhaps $2.5 trillion to spend on new fiscal measures. And I equally anticipate that the Biden presidency, coupled with a Republican Senate, would have been far more tricky in terms of what could be spent, and perhaps no more than $500 billion. However, now that we have clarity that there is a vaccine and therefore an end, I think that Mr. Biden will get an extra $1 trillion, and that will make all the difference.
$1 trillion, James. What gives you that confidence?
Well, I would say two things, John. I would say, first off, there is, I think, a broad cross-party acceptance in the states that the government has to do more to end the challenge. And I don't believe that the Republicans will wish to kill the US economy because it will play very badly for their future chances of election. I think the second issue is that there is a subtle change in the conversations that Jerome Powell is having about Federal Reserve policy. He's made it clear that he supports greater equality within the US economy, and he's been very targeted in terms of his support of the bond market. So this is quantitative easing that is focused, that is challenging, that absolutely, I think, is going to be providing the base plate for continued low yields and therefore low-cost fiscal expansion.
How much do your market calls hinge on this expectation of fiscal support? I believe you're calling for the S&P to reach 3,800 by mid-2021 and 4,000 by the end of the year.
Yeah, I'm not overly dependent on fiscal support to get there because the sorts of companies that I think that we should be investing in are high-quality companies. I mean, you were talking prior to the break about the prospects for Disney. Disney, for me, is a world-class company, and I would take the recent share price weakness as an excellent entry opportunity for the long haul. Equally, if I were to think about some of the great companies in medical technology, I'm still a fabulous fan of Medtronic and Stryker, because these are companies that I think will rise from the ashes of share price markdowns to positively surprise shareholders.
James, this is incredibly important insight, folks. We haven't discussed this, I'm going to say 10 or 15 days because of election 2020. On the healthcare play, Everybody, it's simple. Buy Johnson & Johnson, and there's like 3 other names, Dow Components, etc. Take us beneath that. Tell us about not the specifics of Medtronic or Stryker, but the thematic play of those stocks given a Biden administration.
The first key issue is that as people get older, so medical care becomes more complex.
Really?
We are into issues like parts replacement for hips operations. We're into dialysis for people who have challenges with their kidneys. These are all issues where we will see an increasing spend in the years ahead. Now, in the wake of the COVID-19 crisis, so-called elective operations, those where people can choose if and when they have such operations, were essentially shelved. And inevitably, there was a big hit short-term earnings of people providing parts and facilities that could be described as elective. If I am correct, the vaccine leads to the gradual reopening of elective surgery and medicine in the States. So I think companies will benefit hugely.
James, will there be a roll-up of the industry? There's been roll-ups in other industries. What are we waiting for in the health space?
I certainly think there will be mergers and acquisitions activity because cash is cheap. I find it very interesting. People talk about the extraordinary performance of Alphabet, for example, and the FANGs. Actually, in recent years, Domino's Pizza, that came to the market at the same time in 2004, has thoroughly outperformed Alphabet, and the reason it has done so is it has spent cash and issued debt to buy back its own shares, so it has magnified its earnings per share. The market has been pleased. If Alphabet had played the same game and had geared its balance sheet, it would really be reporting earnings per share twice the current level. And I think this issue of using cheap debt to fund M&A, to fund financial engineering, is going to continue so long as we have ample credit and low-cost debt.
James, I've got to jump in quickly because you sound so constructive. Just a final question from me on where you're playing things right now. You sound optimistic, yet you're not playing it through the European banks. Earlier this week, when the optimism returned, where did people go? The European banks. Why aren't you doing the same thing?
I think that European banks remain an accident waiting to happen. Negative interest rates mean that we have higher savings rates rather than more spending. It's extraordinarily difficult for a bank to make money in a climate of negative interest rates. And I see no expectation that the European Central Bank will come to the rescue.
James Bevan of CCLA, just laying it into the European banks at the end there. James, thank you. Great to catch up. Been a really bullish story through this week. James Bevan is not on board with that whatsoever. This coming from Secretary Alex Azar, the House Secretary in the United States, in an interview with Fox Business in the previous 10 minutes or so. Enough of the COVID vaccine for all US seniors by January. Tom, that's the headline that comes from Azar. Enough of the COVID vaccine for all US seniors by January. Goes on to say that schools, workplaces and airlines are not vectors of the spread. So that's the position of the Health Secretary in the last minute.
I think it will be, to be polite, analyzed through the day. Maybe we can talk to Peter Hotez about that. But, John, to me, the timing of vaccines, it's sort of like, Goldilocks and the Three Bears or Snow White, not Snow White, Red Riding Hood. There I am. I've got my nursery rhymes correct. I mean, how many times are we going to hear this? I mean, how many times does it go on? There's going to be a vaccine for old people by January?
Red Riding Hood?
Hopefully.
I can't remember.
I don't know, Lisa.
I'm
know.
lost. I'm trying to understand
Sometimes
this
you
and
just
failing.
Have to let it go.
I can't let
maybe,
go.
No, I'm sorry. It was frozen. It was frozen.
No.
Frozen.
Well, yeah,
Okay.
the vaccine
Up next
has
on
been
the programme.
frozen.
Luckily, an expert, Dr. Peter Hotez, Baylor College of
Yeah,
Medicine, will
that'd
be
be good.
joining us so we can put these questions to him.
Frozen?
Up next on this programme
Yeah.
on Bloomberg.
Let it go. Let it go.
With the First Word News, I'm Karina Mitchell. State and federal election officials are rejecting President Trump's claims of widespread voting fraud. In a statement, they say last week's election was the most secure in American history, adding there's no evidence that any voting system deleted or lost votes, changed votes, or was in any way compromised. China has congratulated Joe Biden and Kamala Harris on winning the presidential election. That ended days of speculation about when Beijing would formally acknowledge the victory. China was one of the few countries that had so far withheld comment. The reaction came after several television networks projected Biden would defeat Donald Trump in Arizona. Meanwhile, it is the latest move by the White House to pressure Beijing. President Trump has signed an executive order barring American investments in Chinese companies owned or controlled by the military. The order says China is exploiting American capital to develop its military, intelligence, and other security apparatuses. And in the UK, Prime Minister Boris Johnson's most powerful aide is quitting. Bloomberg has learned that Dominic Cummings will leave by the end of the year. Cummings was a second key advisor to Johnson to depart after tensions blew up over the way the inner circle operates. He was the mastermind of the successful Brexit campaign. And shares of Disney are jumping. The world's largest entertainment company added more online subscribers than predicted last quarter. Disney is still reeling from the impact of the pandemic, but the growth of the Disney Plus streaming service has softened the blow, and gains at ABC Broadcast Network contributed to a smaller than expected fourth quarter loss. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg.
I am David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
I was just on a call last night with 10 of the global pharma CEOs who are all very heavily involved in bringing solutions to COVID, and looking forward to seeing a lot more in the next 6 months or so. We have 3 vaccines in the clinic and 2 therapeutic treatments.
The wonderful Emma Walmsley there of GlaxoSmithKline, the CEO from London and New York this morning. Good morning. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Price action shaping up as follows. 1 hour and about 12 minutes out from the opening bell in New York. What a trading week it's been for all of us. Equity futures up another 25, 24. We had some weight to the S&P 500, up 0.7%. The foreign exchange market story of the week, resilient dollar. Even as cyclical appetite returns. That's got to be the story for me anyway. And I know it is for Tom too. Euro dollar 118.13. And the bond market, 97 basis points, the new high of the 10-year trading range of the last 5 months or so. Yields come back in. Your yield on a 10-year, 0.88%. Moments ago, we brought you some headlines from House Secretary Alex Azar. He went on to say that he urges caution during the Thanksgiving indoor gatherings. And like markets, also in the healthcare world, we've got to think about the spread between reality and hope. Secretary Azar going on to say enough of the COVID vaccine for all US seniors by January. I'm not sure if that's the reality, Tom, or the hope, but we need to try and understand the spread between the two.
You went viral on Twitter, John, with hopium the other day. Peter Hotez of Baylor College of Medicine is the push back against hopium. He's in the reality of finding a vaccine. We'll look at that in a minute. Peter Hotez, can we have any vaccine for anybody in America within the vicinity of January?
Yeah, I think so. We certainly won't have all seniors vaccinated by January. What's going to happen now is, first of all, the phase 3 trial has to be completed for that Pfizer vaccine. There are other vaccines following. The Pfizer one will get the full spectrum of safety data and also the level of protection. Right now, we haven't seen whether this vaccine protects against serious infection or not. I hope that's the case. And also, we haven't seen the protection level in different groups, so we don't even know if it protects seniors yet. So we'll have to, all that information will come out towards the end of the year. Pfizer will likely request an emergency use authorization with the FDA. The FDA will take a couple of weeks to review it and certify that everything looks good. And then starting in January, if everything looks good, they could start potentially releasing vaccine. Pfizer says they'll have 50 million doses by the end of the year. But remember, in the U.S., only half of that's for the U.S. That's 25 million doses. And you require 2 doses of the vaccine. So in theory, you could start vaccinating around 12 million Americans. Starting around January.
Peter, Hotez and Bottazi, 8 months ago, a year ago, was talking up low-cost vaccines that don't need to be frozen to negative 94 degrees Fahrenheit. We use Fahrenheit, John, in America. Thank you. Dr. Hotez, where are we on a low-cost vaccine?
Well, thanks for asking. So we're hopefully we'll announce we're starting clinical trials in India in 5 sites, and then we can move pretty quickly on that. And then right now, Biological BioE in Hyderabad is producing 1 billion doses. So that's extraordinary. We've never made 1 billion of anything before. So we're very excited. This is a simple technology that's been around for almost 40 years. It uses the same technology used to make the recombinant hepatitis B vaccine, made locally in many countries. And hopefully it could be made for around $1 a dose or less. So we're very excited about it. It's looking really good. And hopefully that can fill up the areas where it's going to be hard to get that Pfizer vaccine out, because it does require that deep freeze, which limits our ability to use that to vaccinate around the world, and also some of the production issues. So what you're going to see is a pretty complex ecosystem of at least half a dozen different vaccines used all around the world.
And there definitely is a lot more hope as some of these vaccines are shown to be effective, and yet we are seeing the pandemic worsen dramatically in some places in the United States, and timing really matters. What is the time frame for you, if it's not January for all seniors in the U.S., as Alex Azar says? What's the time frame for us to get a critical mass of people in the United States vaccinated?
I hope by Q2 we'll really move in that direction. So certainly by the summer, we'll be in much better shape than we are now. And it assumes that there are no bumps in the road, but of course there are always bumps in the road, and there are other vaccines coming behind it. So by the middle of next year, we're going to be in a much better position, and that's why I've been telling people to do everything you can to be careful now for the next few months, because things are going to get better. We're not asking for social distancing and masks in perpetuity. We'll eventually get to a better place, but just hang on and don't do things that are reckless and be careful and look after your loved ones for the next few months.
Doctor, many people share that view. Many people also who watch and listen to this programme followed a panel yesterday with ECB President Christine Lagarde, the Chairman of the Federal Reserve, Jay Powell, and also the Governor of the Bank of England, Mr. Bailey. And at the end of that panel, they were asked what they think are the biggest risks right now. President Lagarde brought up the mink mutation in Denmark. Can you walk us through what you've learned from that in the past week or so, Doctor, and how concerned we should be, or shouldn't for that matter?
Well, remember, our RNA viruses, this is an RNA virus, they mutate. And so far, those mutate, we've not seen any evidence that those mutations are affecting transmissibility or severity of illness or the ability for those vaccines to cross-protect. So, you know, this is a fast-moving train. Things could change, and things I'm saying today may look very different 3 or 4 months from now. But right now, I would say that the mutations that this virus undergoes on a regular basis are not my top flight concern. I'm more concerned that we can get some vaccine out to the population because, you know, in the U.S., we haven't really had a national control program. So there's a complete reliance on biotechnology solutions. Let's get the U.S. population vaccinated. We have the virologists working on constantly looking at the evolution of the virus. Hopefully, those vaccines will still be effective. You know, one of the things that we're working on, have been trying to get funding on for more than a decade, but the world has not been interested, is creating a universal coronavirus vaccine. So, you know, just like there's work towards a universal flu vaccine, we've seen now SARS-1 in 2003, we've seen MERS in 2012, now we're seeing COVID-19, but guess what? We're going to see COVID-25, we're going to see COVID-28, we're going to see COVID-34. This is a new normal. So if we don't have to rush like a little kid's soccer game towards the ball every time a new coronavirus emerges, it would be great to develop a universal coronavirus vaccine. And we're putting a lot of energy now into that goal.
Sobering words at the end there, Doctor. Appreciate your time this morning. Thank you. Dr. Peter Hotez there of Baylor College of Medicine, the Dean. Tom Keene, some really sobering words about the future and the fact that I think now, surely, that the funding's got to be there for the kind of programs that the doctor describes.
You know, as a complete amateur, and I think, John, you, I, and Lisa have done a real good job of partitioning out our non-expertise. I'm just looking at the math, and the math is exponential. It is, as Greg Valliere said this morning, accelerating, and that's what we got to pay attention to. The numbers into this weekend are just flat out not good.
And only just now, trying to correct course a little bit more aggressively in America. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. 1 hour and 5 minutes away from the opening bell in New York City. To Washington, D.C. we go, very briefly in just a moment, to talk about the economy and the lack of extra fiscal stimulus. That's next on Bloomberg.
the outlook for the economy is extraordinarily uncertain and will depend in large part on the success of efforts to keep the virus in check.
They're torturing themselves to explain that they're there, ready, willing, and able.
The Fed has basically done all it can do, with the exception of extreme emergency measures.
We don't have a sort of fixed order of use of tools, and I think that's appropriate. It would always be dependent upon the state of the world and the state of the economy that we found ourselves in.
Getting ready to wind down the trading week. Good morning to you all. Alongside Tom Keene and Lisa Abramovich, I'm Jonathan Ferro. This is Bloomberg Surveillance Live on Bloomberg TV and radio. Going into the economic data, futures positive by about 0.75% on the S&P 500. The economic data dropping across the Bloomberg. Here's Mike McKee. Michael McKee, we have not got your mic track, sir, so we're going to fix that for you. And as you pour through the data and think about it, I'll bring that to our audience right now. PPI coming in, month on month, final demand, October, 0.3%, the survey 0.2%. Excluding food and energy, month on month, we come in at 0.1%, the median estimate 0.2%, the previous number 0.4%. Looking at the final demand year on year, we come in upside surprise again at 0.5%. 0.4% was the previous number, excluding food and energy year on year, 1.1%. The previous read was 1.2. The estimate was 1.2 as well. So that's the data. Let's get through the markets for you very quickly. If we can get cross-asset worldwide, I want to run you through things for the week so far. This week started out with concern about a contested election and what it would mean for big tech and to get more defensive, and then bang, the headline dropped. And what was the headline about? Vaccine hopes. And very quickly, this market started living in the back end of 2021. The back end of 2021 and the hopes and dreams that we would have an established vaccine. That's the story for the back end of the year. In the here and now, it's about the concerns about the next 3 months. The concerns being we're going deeper into winter in America and the data is not getting better. And I'm not talking about the economic data, and that's the issue here. I'm talking about the data on COVID-19. We started the month of November 1st, with COVID cases at 77,000, just south of that. By November 11th, that was just short of 150,000. That's the problem. And what happens when the numbers start moving exponentially like that is that the governors have to respond. The mayors of cities have to respond. And that's what we started to see in the last week. From Massachusetts, Utah, the likes of New York and New Jersey as well. And then in Chicago yesterday, the stay-at-home advisory came. Now, here's the issue for these restrictions from these governors, from these mayors. What we don't have this time around is the fiscal help. If you want to tell people they have to stay at home, surely you have to offset that with some fiscal assistance. And that's the issue going forward from here. 8-9 months ago, we had the stay-at-home orders. What we didn't get this time around was a stay-at-home order and advisory without the fiscal help. Last time around, we didn't get an income crisis. Disposable income actually went up even as unemployment exploded, which meant the United States economy was in a much, much better place when things slowly started reopening. And that's what we need to see this time around going into 2021. Going into the new year, we need to be in a position where this economy is on a firmer footing, even as we work through some really difficult pandemic data, and then we can reopen, Tom, and things can start picking up again. And that's the spread right now. It's the hope of the future and the tug of war between that and what's happening in the here and now.
Well, the here and now, there's no question about that, John. And again, the existential theories that we've got here on the pandemic and such, what I would suggest is certainly the markets are looking out. Remember, John, back to March or April, we had this bridge thing going where we were taking the bridge out to April 15th, and then magically the bridge went out to August. Do we have even a clue, John, where the bridge is right now? I don't think we do.
Hey, Tom, the bridge has got to be longer. That's the issue. And we've talked about that duration mismatch.
Yeah, I mean, no question about it.
Huge duration mismatch. The appetite to do more just is not there down in Washington, D.C. at the moment, and yet we see the appetite to introduce more restrictions into this economy. Let's bring in Michael McKee. I understand the mic is tracked, and Mike can talk about the data. Hey, Mike.
I hope so here. And we can talk about the data a little bit. I mean, the biggest thing that we have been watching in terms of the producer price index is inflation in services, and it rose just 0.2 after 0.4 the prior month. So we're not seeing the kind of inflation that you would get if the service industries were firing on all cylinders. There does seem to be excess capacity there, and that's something of a worry to central banks as we move along. And you look at the overall PPI on a year-over-year basis, while final demand is up 0.1 to 0.5, that's still way, way, way below where you'd want to see it if you were the Fed trying to get some inflation generated. John Williams, the New York Fed president, speaking this morning at a Financial Times conference, says there is a lot of downward pressure on inflation right now. So disinflation is still a concern for the Fed. They're not worried about deflation, John, but we are worried. And Williams also saying that because of the recent virus surge you were just outlining, we may see economic activity start to slow.
Mike, look, we don't do clinics on Friday. We're not going to do an R-Start clinic right now. Mr. Williams' a claim at San Francisco and now over to New York. But we can look at, I'm going to make it up, inflation star. And the fact is, Mike, when I look at inflation, I see on the Bloomberg screen no indications of it. I see disinflation. And critically, Michael McKee, I see service sector disinflation. Is that transitory or is that here to stay?
Well, the Fed hopes it's transitory. Service inflation had been rising while the economy was growing as we transitioned more to a service economy. And then we shut down a lot of the service industries, the restaurants, the bars, and the retail stores. So service industry inflation has dropped off as not only companies are closed, but others cut prices to try to keep people going. And we've seen from the spending data that it's shifted a lot into goods. So you can see a reason for some inflation there, also shortages of goods and slowing in delivery. But at this point, we're hoping it's transitory on the service side, and the Fed is hoping we get back to a path towards 2% relatively soon. The virus outbreak not going to help with that.
Disinflation and the PPI, and of course, we'll have other inflation statistics through November. Michael McKee running all of our economics coverage. Right now, Neil Schering with us with Capital Economics. They write exceptionally acute essays, and particularly weekend essays. Neil, an open question. What will you write about this weekend?
There's only one thing to write about, I think, isn't there, at the moment, which is vaccines. I mean, actually, I sat down to think about it this morning, what I'm going to write about. There's the contested election in the U.S. There's the fact that in the U.S. and in Europe, we've got new restrictions now, and the fact that the economies there will stall or perhaps even contract in Q4. Another Brexit deadline in the U.K. has passed. We seem to be heading towards a no-deal exit, perhaps. But I think the only thing you can write about right now is the hope of vaccines. Let's look on the positive side for once.
And everyone is looking on that positive side. If you look at the general trajectory of markets this week, Neil, there is a question, though, of scarring. How do you game out scarring at a time when the pandemic is worsening and people are going to get laid off? And as Tom mentioned, that service sector has gotten decimated. Everyone's doing everything for themselves because they can't afford to be close to anybody because they don't want to get the virus. How much scarring are we going to experience, and what does that mean?
Well, I think the answer comes down to what you've just been discussing, which is the extent to which policymakers can help bridge the gap between now and the point at which vaccines and treatments mean that we can lift these restrictions. So really, I think there's nothing here that is a foregone conclusion. It's all about the extent to which policymakers bridge that gap. In the UK, there's been more fiscal support. In parts of Europe, there's been more fiscal support. The exception in this regard is, of course, the US, where we were perhaps less concerned about that up until this week because it didn't look like there would be new restrictions and the economy was doing reasonably well. With new restrictions, there's need for policy support. Otherwise, as you say, you're going to get more people losing their jobs. Those unemployment numbers, which have been on the right trajectory, will start going in the wrong direction, and therefore the greater risk of scarring.
And Neil, you talked about exceptions. When you compare the United States to Europe, the other exception is that the United States was in a much better position coming into 4Q. There was real momentum. You saw it being lost in Europe as soon as early September in the PMIs that were posted for that month. That was the concern for Europe going into these lockdowns, is that the economy was already losing momentum. The United States still has it with these restrictions coming into effect. Now, Neil, I wonder from your perspective, the savings rate in America has been so high through this year off the back of that extra fiscal effort and consumers holding back. How much do you think is in the tank going into 4Q?
I think there's a bit left in the tank. As you said, you made the point earlier that despite the big surge in unemployment, we actually saw incomes going up, and that's because of that huge fiscal support. A lot of that was saved. I think there's been this schism in the labour market. If you found yourself on the wrong side of the divide during the pandemic, you were either furloughed, you lost your job, you lost income, you were reliant on the fiscal support. If, on the other hand, you retained your job, you work from home, the chances are your savings have gone up, partly because you got a bit of fiscal support from the government in the case of the US, but also because you've simply not been able to spend on going out to restaurants and theatres and bars and restaurants and so on. So I think that there is a bit left in the tank. There's a bit left in the consumer tank. Corporate savings have increased too. So I think we're not quite at crisis point, but if this doesn't kind of start to get under control by kind of Q1, Q2, and there's no fiscal support coming in January, then I think that's the point at which I would start to become really concerned.
Neil, great to catch up, as always. Neil Shearing there, Capital Economics Group Chief Economist. And Tom, what Neil's alluding to at the end there is that we're discussing the aggregate numbers, not the disparity beneath. So when you see that savings rate, we're not talking about low-income individuals and the people that lost their jobs. And that's the issue going forward from here as well, Tom, over the next several months. When you have that fiscal aid, that fiscal help, where do you want the help to go? Whose hands do you want that to fall into? And ideally, you want that in the hands of people with a higher propensity to spend. And that typically is the low-income worker in the United States.
There's no question of multiplier effects there, but I do think, John, that there's a dawning awareness, and we'll probably see this literally in the next 15 days into the December report, of the two Americas that are out there. And without question, it's never been this disparate in my lifetime. Where's the policy out of Washington for the so many that Lisa and I observe in New York that are really struggling? I don't see it.
Well, we got some policy in the last 24 hours on China, and I think we have to talk about that next on this program. We had a policy from the government to basically ban investments in some companies tied to the Chinese military. And Tom, is it a coincidence that we wake up on Friday morning with the foreign wing of the Chinese Communist Party basically coming out and saying we acknowledge Joe Biden's election win, Tom?
Well, they're there. You know, I'll agree. It's a script into their early weekend. There's no question about that. And they'll wake up our Sunday evening and begin another week. But the whole process hinges on the present president. And through the morning here, you know, on radio and television, we don't see information flow from the White House. That's a fact.
Silence. For the last week's silence on COVID-19. Coming up on this program, we'll get into the policy in Washington with Henrietta Trays, Veda Partners Director of Economic Policy Research, as the Foreign Ministry in China recognizes and acknowledges a Joe Biden election win. We'll do that next. From New York and London this morning, good morning. Futures up 26. We advance 0.75%. This is Bloomberg.
With the First Word News, I'm Karina Mitchell. Federal and state election officials couldn't disagree more with President Trump. The president has made baseless claims of widespread voting fraud, but officials who supervise the vote call it the most secure in U.S. history. They say there's no evidence the system lost or changed votes or was otherwise compromised. Meanwhile, some congressional Republicans are splitting with President Trump over his refusal to acknowledge the outcome of the election. They say Joe Biden should receive presidential-level intelligence briefings. President Trump started getting briefed a week after his election in 2016. So far, he's refused to allow Biden to get the information. And a grim milestone in California. The state has now had more than 1 million coronavirus infections. The CDC says that's almost no part of the country has been spared in the disease's latest surge. A new study says the fatality rate of infected people in the U.S. has fallen 30% since April. Still, researchers forecast the deaths could hit 2,200 a day by mid-January. European Union officials say it's make-your-mind-up time for British Prime Minister Boris Johnson. Another week of Brexit negotiations end today with little progress. EU officials insist that reaching a deal will require Johnson to move first. That's a position their British counterparts reject. And Tesla's billionaire CEO Elon Musk says he's tested positive for coronavirus. Musk tweeted he's experiencing symptoms, quote, typical cold, nothing unusual so far. So Musk was skeptical of the testing processing, saying that of the 4 tests using the same machine, 2 came back negative. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg.
It came in better than expected, not only in terms of job creation, but also a sharp fall in the unemployment rate consistent with higher labor force participation. That's really good news.
Overall, the gain was solid, but even while this is a very robust pace of job gains, it's a lot slower than it has been in the summer months.
Great that we saw the job gains we did, but they still are diminished from what they were, of course, back in April and May. And the scarring, the sort of wounds that were created by COVID are beginning to fester.
I would caution people to look at the top line number because I don't think it tells the entire story. Employment relative to population is still well below where we were pre-crisis, and that's because I think that we're going to have some lasting damage.
Depending on what you look at, jobs creation or the unemployment rate, you have different views as to whether the improvement in the labor force is keeping up or slowing down.
We explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe.
Central banks are heroes of this, not only of the pandemic, but also of the 2008, 2009, and they should be given their justice. Governments now have to take over. Governments now have to be flexible in terms of their fiscal policy.
Angel Guri there, the OECD Secretary General. They are heroes of all of this. I'm sure they are for you if you were long going into some of this mess and you got bailed out by a central banker. I won't go there. Lisa might, though, several times over the next several months, I'm sure. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Coming up a little bit later on Bloomberg TV, I'll catch up with Mike Powell from BlackRock. We'll do that in just a little bit, Tom.
John, Robert from Deluxebury just emails in. He's on an oyster boat off Duxbury in Massachusetts. And he says, why haven't we talked about Bitcoin? You got any idea why you and I are ignoring Bitcoin?
I ignore Bitcoin and have done for the last several years,
Thank
Tom,
you.
for good reason.
Just so everybody understands, this is the only thing Farrow and I are on the same page on. He brines, I'm not brining, but we both agree. BitDog, we're just not going there right now. What is it, like 15,000 or...
Look, I feel like every time I talk about Bitcoin, I get criticised one way or the other.
Yeah.
So I'm just sort of leaving it out there. I'll let the professionals deal with the cryptocurrency stuff.
Yeah, Lisa, what do you think? Bitcoin?
I would go there. I would go there, and not with respect to Bitcoin, but with respect to cryptocurrencies and their role. Sure,
Okay.
but not right now, Tom. Let's switch gears.
We'd go Washington policy on BitDog, but we can't do that with Henrietta Trey. She's not up to speed on Bitcoin, but she is with Veda Partners on the path forward. I look, Henrietta, at where we are now. Everybody wants to hear from their president, his supporters, his not supporters, et cetera. Is there any optimism of policy towards this pandemic and towards a government shutdown December 12th?
I see very small pockets of optimism. Unfortunately, we have to keep talking about elections, namely the 2 Senate races in Georgia, that could be a driver for conversations around a very small package of stimulus in the lame duck session. As you just pointed out, the continuing resolution to fund the government needs to pass by December 11th. And the 2 senators in Georgia are going to need to show that they're making some sort of progress on the coronavirus, especially as everybody heads home or tries to engage with their family members on Thanksgiving and the cases continue to skyrocket. I wonder, and I've heard directly from some folks in the various senators' offices in Georgia, that they'd like to take some votes on particularly extending the PPP program and potentially providing airline aid, given that Atlanta obviously is a huge airline hub.
Okay, so they got to win. They got to win the vote in Hartsfield. I get it. What are we going to do about what is clearly the negotiated stumbling block, which is the big cities, the big towns across this nation?
Nothing until the first quarter of next year. I don't see a state and local aid package happening. I don't see aid to mass transit or public rail or anything like that. I think that's a first quarter 2021 event. I think it needs to be done before March. We saw the 2009 Recovery Act get passed. I think it was February 17th. That's exactly the kind of momentum that President Biden will need to bring to the table in order to get 60 votes out of the Senate in the first quarter of next year. But no big aid package is passing before the next Congress is sworn in.
So that's the side in the domestic sphere when we talk about the fiscal backdrop for the United States. Let's talk international. Let's talk China coming out and congratulating Joe Biden for being the next president of the United States. They had actually restrained themselves from doing so. How coincidental is it that this comes right after President Trump announces some further restrictions on investments in Chinese entities?
Not at all. I mean, you guys nailed it in your last segment. I don't think it's remotely coincidental that the acknowledgement of President-elect Biden having won the election came and coincided almost exactly in the same process, 12 to 24 hours later from every phase in the U.S.-China trade war, whether it was tariffs or announcements around Huawei or export control restrictions. Every time the president did anything there, about 12 hours later, we'd get a response from China. And that's exactly what we got last night. I think the most important cabinet official to watch in 2021, people are concentrating on Treasury and commerce and state, and I respect that. I get it. I think the most exciting is who's going to be the next U.S. trade representative. That person is going to inherit, over $300 billion worth of tariffs on China, and that's going to be, as soon as we get past the stimulus conversation, I think probably the only topic in D.C., aside from regulatory changes, that we have for the next 3.5 years.
That's where I wanted to go. How does Joe Biden respond to this? Because, frankly, there's bipartisan agreement on taking a harder line with China. Does he embrace this, or does he push back and try to indicate that he's going to take a similarly hard line as President Trump?
There was a line that I heard from the chief of staff in the Ways and Means Committee on the Trade Subcommittee a couple months back, and effectively she said, when we see the president imposing tariffs on China, we think, well, great, he's doing the hard work for us. Now, when President Biden comes in, he is in a position to offer the carrots and not necessarily need to impose more sticks. So as China and the U.S. engage and start to talk about real fundamental forms, not buying more soybeans or more pork bellies, but actually instituting intellectual property theft changes and forced tech transfer, they can walk down the tariffs eventually. We've heard from the Biden transition team repeatedly now that they're going to first focus on domestic priorities. So stimulus all day in the first quarter. But as we get beyond that and we start to, re-engage with China or the EU or Japan or the UK and hash out these trade agreements, there needs to be a substantive discussion that I think will dominate the next 3 years.
Henrietta, thank you so much. Henrietta Trey is a policy briefing. She's with Veda Partners this morning. Futures up 26, Dow futures up 240, and the VIX 24.28 gives back a little bit here right now. Lisa, I want to go to one of the great undersaid things this week, which is spread narrowing, how the credit space, IG and high yield, went price up big, didn't they?
Well, here's the thing. I was actually thinking about this because you guys were teasing me about being Miss Bear when I said, look at this, we have record low yields on high yield debt. Basically, the companies closest to default have record low borrowing costs at a time when we are entering a season of discontent with a pandemic that is raging. And yet, since that moment, you have seen yields spike back up because people are skeptical of whether they are getting basically no pay for a lot of risk. And this is sort of the conundrum. How much is this entire backdrop backstopped by the Federal Reserve, by the ECB? The Fed's balance sheet now equals to a third of the U.S. GDP. Just throwing that out there, Tom.
When you sell credit, when you sell IG, when you sell high yield, don't you just go to cash? I mean, what's the alternative once you're addicted to that higher yield?
You're absolutely right, which is the reason why people are going into some of these instruments and justifying it based on what else are you going to get. The distinction here, Tom, is that what people might end up getting is when these companies go bankrupt, if they go bankrupt, their return is that much lower. right? So sort of, it's a very binary outcome. They can perhaps get that coupon that's higher, but at the end of the day, their returns might go to zero if there is a problem, Tom. And this is the question. That said, it doesn't seem like the default cycle is going to be nearly as bad as people had expected. And where are you going to go, especially with a Fed backstop?
Well, that is the conundrum here into November, into December, one of our great themes on this Friday. Futures up 25. Coming up on Bloomberg Television, just be kind, this is a timely conversation on any number of ways. David Miliband of IRC, but much more David Miliband on the politics, the ferment of the United Kingdom. Stay with us on Bloomberg Radio and Bloomberg Television. Good morning.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
They have been here for quite a while. They have obtained the SVF license back in 2016. They've also been granted a license for the virtual bank. They will continue to play an important role in Hong Kong.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
From New York and London, for our audience worldwide, good morning, good morning. The countdown to the open starts right now with 30 minutes until the open in Bow. Futures advancing 25 points. We begin with the big issue, the pandemic surging across the United States. Major cities introducing curfews, imposing restrictions on everything from family gatherings to restaurants, with infections setting new milestones across the country. Chicago taking action following 3 days of record daily cases. The mayor, Lori Lightfoot, issuing a 30-day stay-at-home advisory, making exceptions for school, work and essentials only. The Illinois governor, J.B. Pritzker, warning the measures could intensify.
If things don't take a turn in the coming days, we will quickly reach the point when some form of a mandatory stay-at-home order is all that will be left.
All this as prospects for a stimulus package continue to fade. The White House reportedly stepping away, leaving it to Congress to revive negotiations, which appear to be right where we left them last. Majority Leader Mitch McConnell telling reporters, quote, Democrats are still looking at something dramatically larger. That's not a place I think we're willing to go. The Minority Leader, Chuck Schumer, showing that the Democrats aren't ready to budge yet either.
McConnell is sticking to his emaciated bill, which he's tried twice and didn't get a Republican vote. That's sort of a non-starter. We think there has been change. It should move things in our direction. We're willing to sit down and talk. They haven't wanted to talk. They seem to have stuck to their position.
Let's bring in the Bloomberg team. Bloomberg's Greg Giraud and Sarah Ponczek as well. Greg, let's start down in Washington, D.C. Just where are these fiscal negotiations at the moment? Are they anywhere to be seen, Greg?
They've stalled. Yeah, Democrats and Republicans remain far apart in their negotiating positions on a new tranche of coronavirus relief legislation. Democrats have long sought a multi-trillion-dollar sweeping relief package, including aid for state and local governments. They passed that through the Democratic-led House earlier this year, but the Republican-led Senate resisted that. They proposed their own legislation, a slimmed-down, more targeted relief of about $500 billion. The Democrats resisted that. So $2.4 trillion and $500 billion, that's a very large gap for the two sides to bridge. It did seem like before the election that Speaker Pelosi and Treasury Secretary Mnuchin would come to an agreement on a new tranche of aid, but those negotiations stalled and failed. And the White House, as Bloomberg News has reported, is not actively negotiating right now, so it's up to House Speaker Pelosi and Majority Leader McConnell to try and come up with an agreement, but they remain pretty dug in right now. They have to give a lot to come to an agreement.
Greg, dug in as restrictions are implemented by various governors and mayors across the country now, from cities like Chicago to states like New Jersey and New York, the one that many of our audience are sitting in right now watching this program. Greg, going forward from here, if we're going to see more restrictions from governors, from mayors, what kind of support do they need from the federal government right now that they're not getting?
Well, they need aid for state and local governments. They need aid for hospital workers who are extremely strained right now. Those the strains on the workers is really exacerbated by this crisis. We've got more than 140,000 cases. Hospitalizations are at a high, and deaths are going to increase in that lagging indicator. So yeah, they resources for healthcare workers. There's also aid for the unemployed as well, and for businesses. There's talk of a new round of relief for small businesses under the Paycheck Protection Program. But hospitals and hospital workers are under enormous strain right now. They're going to need help from the government. And as long as they're at loggerheads, the two parties, it's going to make it all the more difficult.
A difficult moment for this country. Greg, great to catch up. Thank you. 27 minutes away from the opening bell. Here's the picture of things. Equity futures marching to that pretty tune of just higher, higher, higher. That's the drumbeat in this equity market. Sometimes it's the small caps, other times it's big cap tech. Futures, nicely bid. Sarah Ponczek, even after the conversation that Greg and I just had about COVID numbers, the lack of fiscal stimulus, and here we are talking about an equity market that is rallying into the cash open.
It really is remarkable, but this is a market that just continues to focus on the positive news, the positive being positive vaccine news, and disregard the bad being your lack of fiscal stimulus, rising COVID-19 cases, and more restrictions across the country. As you mentioned, equity futures broadly higher today. We don't see as much dispersion today, a broad-based gain. You see S&P, Dow Jones, NASDAQ futures all up about the same amount. The Russell 2000 small caps ever slightly a little bit higher than those. But on the week, that has not been the story. Rather, it has been a case of dispersion with cyclicality, value, small caps leading the way. You see the Russell 2000 up more than 4.5%. S&P futures, Dow futures higher as well. But on the flip side of that, you have big tech turning to the downside. The NASDAQ lower on the week. It's also been a pretty wild ride in the bonds markets. Cannot forget, at one point when we were talking about the reflation trade trade. After that positive Pfizer vaccine news, we saw a benchmark 10-year yield shoot higher towards 10%, above 97 basis points. Well, yesterday, we got softer than expected CPI data. At the same time, we are looking at these risks from COVID-19 and restrictions. BMO Capital Markets pointing out today, this morning, that it seems like we are establishing an equilibrium that is higher than the range that we had established prior to the Pfizer news and prior to the presidential election. So still, we have seen a bid for bonds come back in, now around that 90 basis point mark or so, John.
Just can't break 1% on the 10-year at the moment. Sarah, great to catch up. We do have a new upper end of the trading range, though. 97 basis points, as Sarah Ponzek points out. Headline coming across the Bloomberg terminal. It comes from Santander. We caught up with the CFO just a couple of weeks back. Myself and Anne-Marie Hordern did in the European programming here out of London. And he suggested that this would be coming at some point, just in the conversation we had. And here it is, planning to cut up to 4,000 jobs in Spain. That won't be a big surprise for people who follow the bank. But that's the theme at the moment still. These companies just trying to right-size, a word I hate, resize for the environment around them right now, and the environment around them right now is really difficult. BNP Paribas, Daniel Morris on the lookout for opportunities following the latest vaccine developments, writing the following. Markets are evaluating how far the vaccine reflation can go. While the situation is clearly not going to improve immediately, look for any dips in vaccine beneficiaries as buying opportunities. Given the medium outlook, it's much more positive now. I'll clear my voice and bring in Dan Morris. Dan, excuse me, sir. Why so constructive?
Well, I think back to how the market has reacted over the last couple of months. We've heard this story about the supposed disconnect between equity markets and the real economy. And this was before we either had the election result or we had the vaccine news. So to be surprised now that markets are still going higher when on the margin things are more optimistic than they were a month ago shouldn't surprise us too much. I mean, certainly in the near term, it's going to be a hard winter. I don't think anyone is anticipating much better at this point, but we've had a huge step change with the announcement of the availability of the vaccine. I mean, we've had discussions since all of this started. Would a vaccine be feasible, and would it be this year? Would it be next year? Or more pessimistic views, or it would be even further out into the future. So we've gotten over that first hurdle that we can get a vaccine in the relative near term. Now, of course, we have to discuss efficacy and delivery and everything else. But that first hurdle was huge. And so the markets are thinking further out, which is what they're supposed to do, and saying 6 months from now, things are going to be better.
So, Dan, my question would be, why not have that cyclical position and sell the rallies? Why buy the dips? Why just not sell the rallies? Because what we've seen is just a series of head fakes again and again when this rotation starts to emerge. Why is this different?
Well, I guess we're trying to look at investment opportunities with a longer-term horizon, so we're not trying to trade every swing in the market. And if I take a position today and I want to hold that position, say, for 6 months, if my view is the market's going to be higher 6 months from now, I don't think we want to be selling into the rallies. We think fundamentally it's a reasonably supportive environment for risk assets. Don't forget all the central bank support. We still expect to get some sort of fiscal stimulus. The vaccine will come. So all these things are saying in 6 months, in a year, really things should be better. And I think that's the perspective you should have when you think about when you want to enter the market.
It's been a fascinating week in the United States. The start of the week, it was all about the cyclical parts of the market, the small caps, the Russell. The back end of the week was about big tech again. Dan, a feature of this week has just been the immense outperformance in the European equity market, going to 7-8% again in the Euro Stoxx 50. When you look at Europe at the moment, Dan, do you have the appetite to take that regional exposure on top of that cyclical exposure as well?
We don't have an overweight to Europe right now. Actually, our overweights are more to the U.S. and to emerging markets. So I think we have seen certainly a bigger bump in Europe over the last week, really since the vaccine news came out. And so that's all well and good. Clearly, when this happened, Europe being the most depressed because it was the most in the midst of the lockdowns and the biggest concerns about economic activity. So on the margin, it's going to see the bigger benefit. I think we're a little bit more concerned, again, about that medium-term outlook. And you mentioned the layoffs that may take place in Spain. In a sense, that's a bit unusual insofar as many governments have been trying to do just the opposite, preventing any kind of companies letting workers go, extended furlough programs, worker support, unemployment support, and so on. All very good, certainly, for the economy in the short term. But when you think about the dynamism of the economy, really what the governments maybe inadvertently are doing is are preventing the labor markets from adjusting to what we all appreciate is going to be a quite different economic and business landscape in the future because of the pandemic. So that's where the medium-term growth questions come into play. And then we're probably a little bit less optimistic about the prospects for Europe.
Dan, just a final question then on the United States. We've had some really constructive language used on this market, maybe even euphoria, roaring 20s, market nirvana. Can we get to the kind of levels that have been thrown out there in the past week, 4,300 year-end 21? Can you get there without tech leading?
Well, I'm sure we'll get there at some point in the future. Of course, the challenge is trying to put a date and a number at the same time. Without question, the tech dynamic is going to be critical. And I think it really gets back to what we're talking about more broadly about the rotation back into value and how sustainable is it? How far can that go? And it's really going to come down to the stimulus as we've been discussing, and then what's going to happen potentially on the tax and regulatory front. So without that driver, I agree it's going to be challenging. And if anything, without that rotation, I could see appreciation of equities. That's our base view. But we're not necessarily looking at it, real strong appreciation the way we've seen at times over the last couple of years.
Still bullish. Dan, great to catch up. Appreciate your time this morning. Dan Morris there of BNP Paribas. Let's get back to this equity market. We start to rally into the cash open. It stays there, those positions. That move holds. At the market desk for the first time this hour, here's Abigail.
Hi there, John. Well, we do have lots of big-name earnings movers to take a look at, and three of them are popping to the upside, helping to explain why we do have a bit of a rebound on the day. Starting off with Disney. Some analysts are saying they put up a blowout quarter. That, of course, though, against the backdrop of a low bar expectation. So they did put up a loss for a second quarter in a row on the pandemic, their parks and the cinema business really struggling. But the loss was much narrower. And on the other hand, the streaming business, the Disney Plus, really knocking it out of the park. They have nearly 74 million subscribers at this point. They're all in on the streaming plan. They have an investor day in December to outline it more. Investors like this. The stock is sharply higher. Applied Materials, the world's largest semi-cap equipment company. They beat, they boost, price targets up across the street. Cisco, they finally got a breather. They've had a number of difficult quarters, but this time, even against the backdrop of a difficult enterprise environment, they put up a big quarter. They also provided a better forecast, and CEO Chuck Robbins is saying they are seeing signs of improvement. Not so much, though, for Palantir, the first quarter that they're reporting as a publicly traded company. They are learning how difficult it can be. They beat, they boosted, but the stock is down. Morgan Stanley cut the stock down to an equal weight, saying valuation after that huge rally after they went public back in September. It's time for the stock to cool off just a little bit.
Abigail, thank you. This market not cool enough, up 22 points on the S&P 500. Coming up on the programme, Chairman Powell, President Lagarde, Governor Bailey, all warning that the prospect of a vaccine is not enough to meet the economic challenges still ahead. That conversation up next with Invesco's Rob Waldner from London and New York this morning. Good morning. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen.
And that is certainly something that has served me well.
Ankiti, where do you go from here? It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Give you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
The main risk we see of that is clearly the further spread of the disease here in the United States. With the virus now spreading, the next few months could be challenging.
Critically important going forward is that the policies that have been in place, which have been extremely helpful, bridge over to the other side of the river and continue to support the economy.
We've seen a very uneven recovery so far, and that reflects the fact that obviously those parts of the economy and those sectors that involve close human interaction are much more heavily affected, and that's very troubling.
The world's top central bankers, Fed Chair Jay Powell, ECB President Christine Lagarde and Bank of England Governor Andrew Bailey all warning that the prospect of a vaccine won't be enough to clear the economic hurdles stemming from the coronavirus pandemic. For more, I want to bring in Bloomberg's international economics and policy correspondent, Michael McKee. Mike, none of those three getting carried away with the hopes of what could happen, what might not happen in 2021, and really focused on the challenges in the near term.
Well, I got one word for you, John: minks. I mean, they were optimistic that 2021 would be a better year economically because of a vaccine, but they did warn, as you heard, that they can't be complacent and they can't assume a vaccine is a magic bullet. Madame Lagarde noting that Denmark culling its entire mink herd because of a mutation of the virus was a warning that they can't take for granted that a vaccine is going to work. In the meantime, take a look at what's happening to the European economies after they shut down to stop this latest round of the virus. When an economy rolls over, it rolls over, and that's what's happening there. And so far, we haven't seen that happen in the United States, but Chairman Powell warned we should expect it and we should be prepared. In particular, that means more fiscal support from Congress and an administration that doesn't seem interested in providing it right now. Powell went on to say that we are recovering, but to a different economy. There's going to be a substantial number of workers who are going to need support. And that gets along with what Christine Lagarde was saying about bridging the gap here. As for monetary policy, investors are already pricing in that the central banks will act in December. New QE from the ECB is expected and the Bank of England. The Fed may move the maturities it buys out to the longer end of the curve. And of course, we're going to get new economic forecasts from all of them in December. So a big month to watch for. I'll leave you with one warning. For those of you who remember Ben Bernanke in the early years of the 10s and the things he was saying about coming out of it, we heard from the IMF Managing Director Kristalina Georgieva today. She said, we are seeing some green shoots of recovery, words that maybe should terrify investors.
They certainly terrify investors in Europe. We heard that many times coming out of the second crisis, the Eurozone debt crisis. Mike, great to catch up. Invesco's Rob Waldner recommending investors diversify from the credit trade, writing the following: the pickup in COVID cases and hospitalizations are negative for growth, plus we remain in a policy pothole. Valuations in credit are just too tight to provide any cushion for these negative potential outcomes. Rob joins us now for more. Rob, this was a line from Kit Jukes this morning in his morning note. He said they warn against vaccine euphoria, but they promise easy money. Now, what should I be worried about here if this Fed, this ECB, this Bank of England, the BOJ, going to be right there if things go wrong?
Well, I think you should expect the central banks to be there if things go wrong. But, you know, we're not priced for anything to go wrong right now, Jonathan. So I think that's our point, which is we've been very positive on credit as we've come out of this original, pandemic shutdown. You've had growth outperform expectations. You had a very stimulative policy. And, growth and policy drive markets. And we're now pretty close to our tights in credit. So just, valuations matter in the end. And we have now, I think Mike McKee put it very well just a moment ago, we have the likelihood of a double dip in the fourth quarter in Europe, slowdown likely in the U.S. based on this virus pickup, and policymakers are taking a bit of a break, both fiscal and monetary policy. They may be there if we have a big correction, but right now we're in a period of a bit of a break.
Rob, I really want to get into this with you. It's been a sweet spot for this market. It's been the comfort trade, not just the consensus trade, the comfort trade, the follow the Fed strategy. You sit in IG, or maybe you venture out and you go to the double Bs just outside of IG and you sit there as well. Are you saying that consensus trade is vulnerable, Rob?
What I'm saying is that in the long term, we do think that the benefit of the vaccine will be supported for risky assets, but valuations matter, and where we are now for the next several months or quarters, we're in a period between the time where we're going to get the slowdown in growth and then and potentially get a vaccine to come and boost growth again. But in that period where we have growth headwinds, we have this vaccine headwind, and we have policymakers on the sidelines, it's going to be more volatile for credit. And I don't need to remind you, Jonathan, that valuations are very tight. We have both. You were talking earlier in the program about IG and high yield. Pretty tight valuations relative to history.
So why do you like emerging markets, Rob?
Well, we like emerging markets because a couple of reasons. One, let's go back to valuations. I think I've talked with you about this before about China. Well, in China, local interest rates are the same level they were at the beginning of the year. So from a relative perspective to the U.S., China looks much more attractive than it did at the beginning of the year. And it's actually one of the better performing countries and currencies over the year, and probably can perform well in either environment, one where we get the growth in the U.S. slows a bit, or one where we get a pickup. And
Rob, what we've seen this year, though, is relative outperformance, bursts of relative outperformance. What I'm trying to understand, can you imagine a market where high yield spread starts to widen, credit spreads in America start to widen, but EM still performs? Can you imagine that dynamic playing out?
So if we're talking here about local currency, Jonathan, I think you do have a period where you could see, particularly in the current situation where we have this growth slowdown in the U.S., you could see some relative outperformance of local EM relative to dollar credit, and the valuations are much more attractive. So it's about weighing all the outcomes. So there's several different potential outcomes here. EM seems well to set up to perform through most of those. Credit has certainly some outcomes where it will be a bit more negative.
Rob, great to catch you up. Always great to get your thoughts and dig into how you're thinking about this market at the moment. Rob Walden there of Invesco. Thank you, sir. Coming up on this programme, the analyst action you need to know. That'll be next in our morning calls. Then later, BlackRock's Mike Powell weighing in on the big trade of the week. It's value versus growth. It's the Nasdaq versus the small caps. We'll do that at the opening bell. That's coming up shortly. From London and New York, this is Bloomberg.
I don't believe the renminbi will be a
5 minutes out from the opening bell in New York City. Good morning to you all from the City of London, from New York and London. Equities advance up 23 on the S&P 500. We're up nicely, a tiny move higher by 0.6%. The opening bell just around the corner. Let's get you some morning calls. A look at some of the analyst recommendations on Wall Street this morning. We begin with Deutsche Bank downgrading Dow to a hold with a $56 price target. The analyst citing a more balanced valuation with little near-term upside ahead. Stock's negative about 1% in the early part of trading. Elsewhere, Barclays raising its price target on GE, $11 price target. Overweight rating. The analysts seeing little room for additional downside with improving balance sheet and free cash flow. That stock inching higher by another 0.8%. And finally, your third call, it comes from the team at RBC Capital, upgrading Disney to an outperform following its quarterly results. The analysts calling it a unique recovery trade with a number of compelling COVID hedges. Theme parks reopening, the hedges, of course, being the streaming business. Coming up, more on Disney's big earnings beat. Plus, we'll catch up with BlackRock's Mike Pyle. He joins us at the opening bow to weigh in on this week's big monster rotation trade debate. That's up next. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This equity market just can't settle on a story. The narratives from one to the next, the pendulum swinging. Last week we went into an election thinking about a blue wave, coming out of it, a happy talk about gridlock, a divided government. Now we came into this week defensive. And what happened? Vaccine news. The hopes and dreams of the cyclical trade followed up by the reality that things are not going well in the United States as we get deeper into winter. Here are the scores. Futures positive going into the opening bell. What a week it has been for the small caps. The Russell coming into Friday up about 4%. The Nasdaq down a little more than 2%. The S&P 500 somewhere in between, positive 0.8%. In the bond market, 10-year Treasuries 88 basis points, opening up Monday at about 83 basis points, as high as 97. 0.9753 is the new upper end of the trading range. Right now, we are unchanged. In the FX market, a stubborn trade for you. The dollar just has not participated. DXY unchanged on the week, euro dollar 118.17. And in the commodity market, crude up. And then we roll over, $40.82. We are down about 0.75%. That is the cross-asset price action at a market desk with the movers. Here's Abigail.
John, well, what a difference a day makes after the worst day in the month of November. We are now looking at a nice rebound for stocks, starting out with some of the big earnings movers. Cisco Systems is really popping sharply higher. They put up their first good quarter in about 6 quarters. They beat, and they also boost the outlook. CEO Chuck Robbins saying that they're really seeing signs of improvement. DraftKings, the online gaming company, really soaring. They also beat revenues. They missed earnings, but they boosted the full year revenue guidance, and investors clearly like that. Disney, the big name, marquee earnings mover on the morning, up about 3.7%. They posted a narrower loss. They also really posted very impressive numbers around Disney Plus and their streaming business. Folks clearly like that. As for the difficulty yesterday, all 11 sectors were lower. We are seeing a bit of a rebound, though, for some of the names within those beaten down sectors. Now, energy right now is the only down sector. Nonetheless, Marathon Oil, which had been down 5% yesterday, today is rebounding. A similar story for Freeport-McMoRan. Materials, the second worst sector. Today, we have Freeport-McMoRan at least rebounding. We have some strength for the banks. Goldman Sachs is getting a bid. Microsoft, the top sector, actually industrials right now. Tech had been a moment ago. Microsoft, though, seeing a little bit of a bid. It's going to be interesting to see how all of this shakes out, all of this shuffling this week with these rotations, John. But right now, it looks like actually all 11 sectors are higher as we come out of the open.
Just about. Abigail, thank you. Up 0.9, call it 1% on the industrials, as Abigail points out. Financials, top of the pile as well, up 0.8%. IT doing OK. Bit of an everything trade in this equity market. IT up about 0.75%. All securities, the S&P advancing 0.66%. Let's get back to Disney, shall we? The CEO, Bob Chapek, pointing to the recent success of Disney Plus, telling investors, quote, "The real bright spot has been our direct-to-consumer business. It has quickly exceeded our highest expectations." For more, let's bring in Bloomberg's Scarlett Fu. Hey, Scarlett.
Hi, John. Well, the problem is there's only so much streaming can do for Disney's bottom line right now. For a second straight quarter, Disney reported a loss, and it closed out fiscal 2020 with an almost 60% drop in adjusted net income. The decline is expected to moderate next year before returning to growth in 2022. So what happened? A lot of pandemic pain. Disneyland in California is still closed. It'll stay that way through the end of the year. Attendance is capped at other locations, and there's not much of a U.S. box office to speak of right now, with revenue falling by half in that business. Chapek's savior is streaming, which is housed in the direct-to-consumer division. You can see revenue there jumping 41%. And although it's still unprofitable, the losses there are narrowing. Now, within streaming, Disney Plus is the star. It's a one-year-old service, and it ended the quarter with 73.7 million paid subscribers. So that is 13% above analyst estimates, and it's led by growth in India. By contrast, Netflix is expected to end the year with about 200 million subscribers. Meantime, ESPN Plus had its best month ever in September, and Hulu has almost 37 million users. Now, growth in streaming does raise an interesting question for investors. Should they treat Disney like a tech stock, like a Netflix, or an entertainment stock? Activist investor Dan Loeb has been pushing for that tech angle. He's told Disney that he wants it to suspend its dividend and reinvest it in streaming, and Disney kind of went along with that, in so far as it is skipping its next dividend payment, but it is looking to, at some point, restore dividends once again. John?
Scarlett, thank you. Disney, the stock up by a little more than 3%. Let's turn to the debate of the week. Where would you like to live? In the back half of 2021, where things are great and we might have a vaccine, or in the near term, where you are getting whacked around by data that is just screaming ugly, ugly, ugly on the COVID-19 front. I think we can all agree we want to live in the back half of 2021. At the start of the week, that's exactly where this market was living. And then things started to change. This comes down to the rotation for this market, at least, away from growth and into value. We've seen this a couple of times over the last 9 months, and then it's stalled and it's faded away. Was this another head fake? This is what BTIG's Julian Emmanuel had to say.
The psychology began to transition away from technology, high multiple, high growth. The vaccine news on Monday is accelerating that transition. We've obviously seen that in the market. From our point of view, that's where the risk lies, because the positioning is still very much in these high growth names.
On this story, Bloomberg's Sarah Ponczek. Hey, Sarah.
Hey, John. A rotation for the record books this week. But as you pointed out, much of it really did come on Monday. Then it faded. Still, though, on a weekly basis, value did outperform growth. If you take a look at the S&P indexes, the value and growth indexes, just as a proxy, there you see growth and value on the week. This is the largest weekly gap in favor of value since 2009, to give you some perspective here. Ned Davis Research says that they are neutralizing their growth and value rates. Another question here is, if value is going to take the lead, is this a tactical trade or is this a true secular trade? On our What Goes Up podcast this week, New York Life Investments' Lauren Goodwin said she believes this is just a tactical trade playing the vaccine. But let's rewind a bit, get a sense of just how historic Monday really was. If you take a look at the momentum factor, essentially betting that the winners are going to keep on winning. We saw the largest single-day momentum crash in history. Quantitative investors say that the standard deviation on this move was so large that it virtually never should have happened. But to be fair, this is a rotation that has been in the early stages, not just this week, but over the past month, really since September, even when we saw the NASDAQ peak. If you look over the last month, for example, the Russell 2000 was shyly taking the lead over the NASDAQ 100, as you can see here. But we really saw that divergence take form and shoot higher, shoot wider this week. But the question still remains, is this a head fake or is this a true either tactical or secular change, John?
Sarah Ponczek plugging her podcast on this show. Is that the trade now, Sarah? What is the podcast? Can you walk us through it just quickly? You've got 5 seconds. Tell me why we should listen to the podcast.
Weekly macro trends in markets. We do it every week. It's a lot of fun. We mix some jokes in there, too. It's lighthearted. Good for the weekend, John.
I look forward to it. I will listen to it. Sarah Ponczek, thank you very much. I appreciate it. I think that's the deal with my producers and Sarah right now. We have to plug the podcast to get her to come back a little bit more often. BlackRock's Mike Pyle. He's not doing that. He's expecting more headwinds still to come for the recovery. He writes the following: portfolio resilience has to go beyond broad asset classes, diversification alone. We prefer sustainable assets, private markets, and deliberate country diversification on a strategic basis. Mike Powell, that sounds like some McKinsey talk. Let's get down to basics. What do you think people should do?
So I think to the debate you were just having, we really think that the important thing is to be barbelled and how you're taking on risks going into 2021. As you said, the first half of the year is going to be choppy. Being in a place where you're still capitalizing on those secular tailwinds around quality, around some of the technology names, that's going to be important. But we also think that being selective around cyclicals is also going to be an important part of a barbelled risk strategy going into 2021. So being selective around U.S. small cap, emerging market equities on one hand, while in our judgment still being cautious around value, around Europe and Japan, some of the more structurally challenged areas of the market that are going to have headwinds regardless of what we see in 2021 is the right approach.
Mike, that's where the biggest move has been this week in the European part of the market. Just walk me through why there specifically you'd be a little bit more reluctant.
Yeah, so we would say, it's still a market that's heavily concentrated in the financial ways of exposure than that. So we'd point again to places like emerging market equities, perhaps especially in Asia. We'd point to places like U.S. small cap that we think could really benefit in the back half of 2021 from a significant kind of cyclical reacceleration. So it's all about being selective around your cyclicals and figuring out the places that can outperform and the places that still face structural headwinds.
Embedded in that call on EM, Mike, which keeps coming up on this programme again and again and again, is there a dollar weaker call just as the base case at the epicenter of that view?
Yeah, so I think we would take the view that the dollar is broadly stable to a little weaker going into 2021. Certainly, a world where we see kind of rates pretty contained in the U.S., where if anything, maybe inflation break-evens widen out a bit and push real rates lower. That's a position, that's a posture that's probably slightly dollar weakening. But stability to weaker is, as you said, a kind of good environment for emerging markets, especially equities. Those easier financial conditions allow activity to bounce back or have an additional tailwind. So, yeah.
Mike, I want to follow on from a question I asked a little bit earlier and I've asked repeatedly through this week. It's the near-term risk versus the long-term issues. The long-term issues now become opportunities for many people because they're hopeful we have a vaccine. The near-term risks, they're becoming more pronounced and to the downside. Mike, I want to understand from your perspective how to trade this. And please just give me your honest response, as I would always expect from you. It's clear to me that when the numbers get worse, people get a little bit more risk averse. That's just to state the obvious. But what is interesting, when you start to see countries correct course, when the lockdowns start to be implemented, you start to see risk assets move up again. We saw that back in March into April, and we're seeing that in Europe. And once the lockdowns started to come, initially knee-jerk, stocks lower. Over the last 2 weeks, we have ripped in Europe, even with lockdowns in Germany, France, and the UK. Mike, is there something to that story as you look at the United States?
Yeah, so I guess we would say two things. One, the two big drivers that we see kind of going into 2021 are going to be ultimately, how much policy support do we get from Washington around fiscal? And what is the ultimate timeline to normalization on the back of a vaccine? Totally agree with your points that there, over the very near term, is a lot of choppiness and ultimately inflection points around these kind of new waves of infection and the sort of deep challenges economically that result from that. But to us, kind of keeping an eye on those kind of two really important drivers for the overall 2020 environment, fiscal policy and the timeline to a vaccine is going to tell us more about, in 2021, which is going to outperform.
Not much on a fiscal policy response right now. Mike, great to catch up. Mike Parler, BlackRock, thank you. Coming up on this programme, China recognising the Biden election victory just as President Trump bans American investments in some Chinese companies. That conversation is up next with Monica DeCenso of JP Morgan Private Bank. This is Bloomberg.
U.S. is in a Cold War of sorts with China, a very mini Cold War, we all hope, of course. But rather than an arms race like the Soviet Union and the United States from 1946 to 1991, this is a tech race.
PIMCO's Tony Crescenzi weighing in on the tensions between the United States and China. The Trump administration unveiling an executive order barring U.S. investments in Chinese firms owned or controlled by the country's military in the White House's latest bid to ramp up pressure on Beijing. The Chinese Foreign Ministry accusing the United States of vicious slander before joining other nations in congratulating President-elect Joe Biden on winning the U.S. presidential election, saying the following: "We respect the American people's choice and extend congratulations to Mr. Biden and Ms. Harris." Let's bring back in Bloomberg's Michael McKee for more. Mike, the sequencing is interesting. It's not for me to decide whether it's just a coincidence, but please, give me your thoughts.
Well, you know, the Chinese have finally joined the parade of countries that are congratulating the president-elect. They've been walking a bit of a tightrope between acknowledging the future and concern about the present because Donald Trump is still president. Notably, the message today came from not the president of China, Xi Jinping, but just from the foreign ministry. Analysts say the Chinese do not want to antagonize Trump while he's still in office and can do damage. They point to yesterday's executive order, the president signing an order that bars pension funds and investment companies from investing in Chinese firms that are owned or controlled by the military, 31 of them. They can't buy shares or sell shares designated by the Pentagon as having military ties, and they did have an impact on the Chinese market. Several of the top Chinese firms who were on the list or their owning firms on the list, China Mobile, China Telecom, both dropping significantly overnight. Trump administration also faces a mid-December deadline to name any banks that have conducted transactions with the Chinese and Hong Kong officials who were singled out for undermining the territory's autonomy. There's concern that could be further destabilizing at this point. The Chinese nodding towards the new president-elect, but still concerned about the man in the Oval Office for the next month and a half.
Mike, thank you. The political tension not going anywhere. Amazing, this market, how quickly it's moved on from the politics of the last week or so to focus almost exclusively once again on COVID-19. Some headlines that will be of great importance to many of us in our audience. The following from New York City, the 7-day positivity rate of 3%. That would trigger a school shutdown, if you're familiar with that rule. The average positivity rate has climbed to 2.83% from 2.68%. So the bad news for New York City right now is the positive COVID test percentage continues to climb and may trigger a school shutdown for New York City. That's the concern at the moment for this market. It's the near-term risk. They're becoming more pronounced to the downside. Keep going back to it. I know. I keep going over and over again on the same issue. It's the near-term risk, more pronounced to the downside, against the long-term hope with the vaccine news. JP Morgan's Monica DeCenso saying navigating volatility will be key to early cycle investing, writing the following: building goal-aligned portfolios and being thoughtful about diversifying exposures is critical to investing success. We still see value in traditional diversifiers such as core fixed income, but also think investors should focus on high-quality growth exposures. Monica joins us now over the phone. So, Monica, let's talk about that barbell approach that so many people have mentioned on this programme. Seems to resonate with you as well.
It does, but I think to your point earlier about volatility upcoming, there were a lot of people who feel like they might have missed some of this rally around the election. And this is a good time, if we do see more volatility in the coming quarter or two, as we figure out what a vaccine and distribution looks like, for people to add to their equity exposure. Because I got to say, when I look intermediate, long term, the equity outlook remains very bullish, in my opinion.
What do you use to fund that equity exposure? What do you pare back on?
You know, we've seen some parts of the fixed income market rally. So we've seen some rotation out of parts of high yield on this rally, and people just paring back a little bit of risk there. Because, again, if you worry about volatility in some pockets of the market, I've seen people rotate some exposure from there. Also, keep in mind, people still sitting on a lot of cash. I see that across the board with the clients that we work with. And so that's money coming from the sidelines that was there because people were so worried about the election, about what could a new administration do, would we see tax hikes? And so I'm seeing a lot of cash come in from the sidelines, and that's funding that long equity exposure.
Monica, let's talk about that cash. $5 trillion, that's the number that's been thrown around for months now, sitting in money market funds. Monica, can you talk to me about the objectives behind that cash? What I'm trying to understand, whether that is just risk aversion, that people don't want to put that cash to work in risk assets, or whether that was money that may have been previously held in a 10-year treasury with a bit of duration, pick up some yield that isn't going there now because of other concerns. What is it, Monica?
What I've seen is more risk aversion. And what happened was really interesting. You know, over the summer, we saw that rally when COVID numbers started to abate a bit. And a lot of people I work with said, you know what, I'm still worried going into the election. I'm okay taking some gains on this. I want to sit in the sidelines and wait. Now the challenge is if you're on the sidelines, you've seen the market march ahead without you. And so people are trying to find that opportunity to get back in. But I do think versus where we were 6 months ago, the 6, 12, 18-month outlook for equities, you can get your arms around that a bit more than you could previously because of the vaccine and because that gives you some comfort that earnings growth should pick up in 21 and into 22. And you can put a multiple on that now, whereas I think that was a little tougher to do back in the summer.
What will be through your threshold for whether you think things get too euphoric? Do you have a line in the sand? I mean, I listen to the language. I keep bringing that up on this programme. When I hear things like roaring 20s, market nirvana, those kind of things, you know, you look around, you start thinking, have things gone too far? Monica, what's your threshold? What are the numbers?
You know, when you look, and let's focus a little bit on earnings, which got lost a bit in the election shuffle. Q3 earnings were really good, right? You had over 85% of companies, I think, beat on earnings, more than 3/4 beat on revenue. You know, we see earnings growth looking pretty solid, double digits, 21 and 22. And just to put a multiple on that, you put a 20 times multiple on our 22 earnings, that gives you an S&P at the end of next year, high 3,000s. You're talking over 10% growth or 10% returns in equities. That is a bullish outlook. I will say, though, as a New Yorker who looks at these COVID numbers and who lived through the spring, you have to acknowledge there will be volatility. And I do think if you see more lockdowns, it is normal that the market would sell off near term. But the intermediate outlook, again, is what looks more positive with the vaccine on the horizon. And so that gives me comfort applying a multiple like the one I mentioned to that longer-term earnings number that we have.
Monica, wonderful to catch up. Don't leave it so long next time. Come back soon, please. Monica DeCenso there of JP Morgan Private Bank. Want to check in on some of the sector price action this morning. What a week we've had. I said that on Tuesday, Wednesday, Thursday. Said it again as we round out the week. Here's Abigail.
What a week it's been indeed, John. And folks have got the Friday feeling today because we have a risk-on sector composition matching the S&P 500's very solid gain, a nice up week. If we go into the Bloomberg terminal and use the IMAP, all 11 sectors are higher. Most are higher by more than 1%, led by energy, industrials, materials, and consumer discretionary. On the week, John, the big question is the rotation on or off. It is on towards cyclicals. The best sectors on the week, energy and financials. Energy up about 14%. Not its best week ever, but a strong week. On bottom, tech and discretionary.
Abigail, thank you. Up next on this programme, the Trading Diary from London and New York this morning. Good morning. This is Bloomberg. 25 minutes into the session, we advance, we add to the weekly gains. On the S&P 500, up another 0.8%. We erased the weekly loss on the Nasdaq, up 0.8%. Still a little bit lower on the week, but the back half much, much stronger than the front half. That's the story in the equity market. The week ahead, at the top of the hour, we get the University of Michigan Sentiment Survey. That's the story for the next hour. Then, House Speaker Nancy Pelosi holding her weekly news conference at 10:45. Fed Vice Chairman Richard Clarida speaking on Monday, followed by Fed Presidents Bostic, Daly, Kashkari and Rosengren on Tuesday. Plus, we get U.S. retail sales. Williams and Kaplan speaking on Wednesday. On Thursday, we get initial jobless claims. And the Fed's Esther George will be speaking on Friday. From London and New York this morning, good morning. As a good friend of mine always says, I know you have choices. Thank you for choosing Gus. This was the Countdown to the Open. This is Bloomberg TV.
It came in better than expected, not only in terms of job creation, but also a sharp fall in the unemployment rate consistent with higher labor force participation. That's really good news.
Overall, the gain was solid, but even while this is a very robust pace of job gains, it's a lot slower than it has been in the summer months.
Great that we saw the job gains we did, but they still are diminished from what they were, of course, back in April and May. And the scarring, the sort of wounds that were created by COVID are beginning to fester.
I would caution people to look at the top line number because I don't think it tells the entire story. Employment relative to population is still well below where we were pre-crisis, and that's because I think that we're going to have some lasting damage.
Depending on what you look at, jobs creation or the unemployment rate, you have different views as to whether the improvement in the labor force is keeping up or slowing down.
Friday the 13th, 3 p.m. in London, 10 a.m. in New York, 30 minutes into the trading day in the United States. From London, I'm Guy Johnson with my co-host in New York, Alex Steele. Welcome to Bloomberg Markets, everyone. Alex, we started off the week talking about vaccines. We finished the week talking about the virus.
Yeah, and what a week it was. Honestly, TGIF, there were some seriously whippy actions, particularly if you're a momentum or quant investor. This week really hurt. Here's where we're stacking up here. It does feel to be a little bit of a buy everything-ish Friday. You have the Nasdaq up by 0.7%, but in the S&P, it's the materials, industrial, energy sector that are leading the way higher. Dollar pretty much goes nowhere. particularly against the euro. I did want to highlight, though, the 210 spread widening out, steepening again a little bit at 71 basis points. There was a big gap up steepener. Then we came off that, and now we're steepening a little bit again. What all of that means for rotation in on the markets, Guy.
Getting some data relating to the consumer. Let's talk about what we're getting from the University of Michigan Sentiment Survey. The headline number, way weaker than anticipated. That number coming in at 77. That's down from 81.8 last time round. Remember, when things are really good, we're well north of 100. The expectation was for 82. Current conditions, 85.8. So that's actually ahead of expectations. But it's the expectation number, the forward-looking number here, that is really sharply lower, coming through at 71.3, Alex, versus 79.1 in terms of where the market, the economists, had forecast that number, and down from 79.2. So a much more gloomy outlook for the U.S. consumer, from the U.S. consumer right now.
And no doubt, as COVID cases are spiking everywhere here in the New York, it really feels like we're headed for a school shutdown as well. Well, let's get the read on what that means for the consumer with Ajay Banga, a MasterCard chairman and CEO, joining us now. Ajay, it's always good to get your read. You have this more pessimistic expectation outlook from the consumer. Then you have rising COVID cases, and you have targeted regional shutdowns in the U.S. What does that mean for your business?
Well, what's going on, you can see, is that there's clearly an impact on consumer spending. Obviously, nobody's traveling the way they used to. Nobody's going to the theater. Nobody's out in public entertainment events. We've been managing our company through 4 stages, as we've said. And the first one was containment. That is kind of the March-April period when everything began to shut down. And the second one was stabilization, kind of near the bottom of the shutdown. And then normalization, which is a big word for better than stabilization, but not really normal, our new normal. We're all kind of living through some stages of that. It goes back and forth depending on looming shutdowns, increase in cases and the like. And then finally, when you get back with vaccines and travel and the like, maybe sometime towards the second half of next year, we would be looking at getting back to a pre-COVID phase. That's what we're seeing. So consumer spending domestically, Alex, is in pretty good shape. I mean, most countries have been growing on consumer spending domestically. Now, the second wave that's passing through Europe and the US will probably crimp some of that. But travel is certainly challenged. And in our case, we get 2 other tailwinds. One is that everything's going digital. So, people who were using cash earlier are now using some form of a contactless card or e-commerce online, all of which helps run through our rails. And the second part is that our data analytics, cybersecurity businesses, these are doing very well in the environment where everybody is going digital. So it's kind of a mixed bag over there.
AJ, plenty to unpack within that, so let's kind of segment it a little bit. Let's talk first of all about what is happening with travel. You talk about the weakness that we are seeing with travel. I talked to a number of CEOs and asked them the question, how much are they traveling? And they say a lot less. I talked to the Swiss Re CEO this week, and he told me his budget next year is going to be down by 30%. He thinks it's probably going to be more than that in terms of what they ultimately come into. What do you think, when does travel come back? When does business travel come back? And how different do you think business travel will be when it comes back?
Yeah, so I think personal travel will come back before business travel. If you look at the trends out of countries like China and Japan, where there is a greater degree of normalization in their environment than we have today here in the US or in Europe, it looks like personal travel will come back quicker than business travel. I do believe that travel per se requires not just a vaccine that's out there sometime, but it also requires the degree of testing and cross-border possibilities by corridors maybe for travel. So you can see Singapore is experimenting with corridors with countries, as is China, as is Japan, and Australia is beginning to talk about it. So I think travel will begin, this is cross-border I'm talking about, not domestic. Domestic travel already has commenced. I mean, look at the US. The TSA is clearing more than 1 million passengers a day. At the bottom of the crisis in that stabilization phase, they were down to 100,000. Pre-COVID, it was 3 million, so we're not back to where we used to be. But domestic travel is up there. This is really cross-border that I'm referring to when I talk about the trends.
One thing that we're seeing that's different this time around is, at least in the U.S., the lack of stimulus. I mean, part of the reason why consumer spending and people's bank accounts held up so well was because governments were just cutting checks in the spring. That doesn't look like it's going to happen. It may be a different story over in Europe. So I want to get your perspective on sort of the urgency. Like, when is the drop-dead date for when your customers are like, I can't pay my bill anymore?
Well, so look, I don't actually see payback because I'm not an issuing institution. Banks do the issuing. We're the rail on which all these payment flows work. So I'm not the best one to give you the perspective of an exact date. But I can tell you that when the stimulus checks were flowing into fiscal stimulus into the United States consumer or other consumers overseas, you could see bank accounts beginning to grow in size, and you could see spending in the kind of stores that even people who were lower in the income strata, the stores they would go to, you could see them benefiting. I can certainly see a slowdown on some of that as the stimulus checks have dried up here in the US and elsewhere. So clearly, we do need to think again about when and how to provide that fiscal stimulus. I don't think it's monetary stimulus, Alex, that we need. There's enough liquidity in the markets. The central banks and finance ministers around the world learned really well from the last crisis. I think they stepped in very early and very well to keep the markets fluid and flowing. It's really fiscal stimulus that we need, checks in people's pockets, for small businesses even more than others. You know that the impact on small businesses, minorities, and women of the last 6 months is disproportionate to that of others.
What would you do if you were part of this administration? What would you do if you were at the Treasury in terms of making sure that the US government delivers what the US economy needs? There have been rumors, AJ, that you are interested in serving. Is that true? And what would you do if you were there?
I mean, the rumors are wrong, so let's get that out of the way. I'm here at MasterCard. I'm going to become the exec chair on the 1st of January, and I have no intention of going anywhere from this role. But back to your bigger question, the question about what we could be doing in the US. Like I said, I think fiscal stimulus is really important. Monetary stimulus, we're in great shape. We just need to make sure that we can get the right kind of stimulus for small businesses. I think the PPP program, while people can say it wasn't executed perfectly in the heat of the moment, remember, it did a great job. And I think we need to think about how to keep the inputs coming for small businesses. If you're a zipline operator in Hawaii with 7 employees, there's nothing wrong with your business. You probably run a great business with terrific employees. There's just no flow of tourism coming in. So we've got to help you tide over this period with your employees and your rent so you can come out the next few months. If you believe that the vaccine will be widely available sometime in the second half of next year, we need to find a way to tide over these next 6-8 months in a constructive way for small businesses and minorities and women-owned businesses as well.
All right, definitely squashing that administration position there. So let me get your take then on what you think is going to happen to financial regulation, maybe more M&A scrutiny. The fear and the narrative in the market is that that's going to come under a much brighter spotlight under a President-elect Biden. What does that mean for MasterCard that's trying to expand into business-to-business payments and trying to grow their business into different areas?
But you've got to remember that our business has changed a great deal over this past decade. While earlier we were principally in the business of enabling payments for credit cards, we've gone way beyond that. Today, we've got about 1/3 of our revenue coming from data, from analytics, from cybersecurity, artificial intelligence, those spaces. We have another big chunk coming from multi-rail payments. We are the only true player who connects into instant payment rails. We just announced yesterday that we won the contract for Payments Canada to do their clearing and settlement on their rails. We do VocaLink in the UK. We are in P27 in the Nordics, in Saudi, and parts of Southeast Asia and Latin America. So I think we get a lot of revenue from that. And we do get a substantial amount of revenue out of commercial payments and prepaid cards and debit cards. So a card, we have card in our name, but that doesn't make the company. We're only interested actually in the account and the flows through that. So my general opinion about regulation is regulation done right is actually to create a level playing field and transparency for all players to come and win. I am happy with that kind of regulation. And in fact, I would want to constructively participate in dialogues around that topic. And I want to embrace that in many ways. What worries me is if the regulation creates unequal playing fields, benefits one over the other. I don't believe government should be choosing winners or losers in business. You can certainly look after citizens, but businesses should be allowed to compete. In the same way, I believe that regulation that creates protectionism is a bad idea. But other than that, I think regulation creates guide rails and creates level playing fields for businesses to run and win, and may the best one win.
Digital is going to be an area that regulation is going to take a very, very keen look at. I genuinely can't remember, AJ, the last time I used money, real money, pounds and pence. That's the world we now live in. Let's talk a bit about digital currencies. Jay Powell, Andrew Bailey over at the Bank of England, and Christine Lagarde were on a panel yesterday, and they were talking about digital currencies. And Christine Lagarde sounded really quite kind of on the front foot when she was talking about kind of where we go next with digital currency. In fact, she said this: if it's cheaper, faster, more secure for users, then we should explore it. If it's going to contribute to better monetary sovereignty, a better autonomy for the euro area, I think we should explore it. AJ, how far away do you think we are from digital currencies in the US and in Europe, and what impact would they have on your business?
So I think digital currency spans a lot of space. And so what you're now discussing is central bank digital currencies, fiat currencies, which are converted into digital, which is what Christine's referring to, which is what the Chinese government recently launched. And a number of countries around the world, Sweden, Canada, Singapore, the UK, have looked and thought about this at various levels, as is the US Federal Reserve. I'm actually a believer in the fact that if we are going to go to digital currencies for all the right reasons, then we should be going there because they're central bank supported fiat currencies. I am less confident about currencies that are not done so, because I believe that a currency is a social contract between a government and its citizens, and it needs a lot of careful management in that process. Now, having said that, stable coins are much better than cryptocurrencies per se, because stable coins take away the volatility angle. They don't solve for all the other topics, but I'm a fan of central bank digital currencies. MasterCard's been investing in this space for a while. You know, my general view is that whether we clear, settle, and authorize 200 different currencies in the world, or we clear, settle, and authorize 200 different digital currencies, these people still need to connect into the systems of acceptance and clearing and authorizing. And we believe we can provide that. We are among the largest owners of patents in the space of central bank digital currencies. We've launched a sandbox to enable commercial banks and central banks to innovate together in the space. So it depends where the CBDCs go. If they go in the form where it's only wholesale settlement between banks, that's a relatively easy one. If it's a form where there's a double tier, meaning the central bank issues a digital currency, commercial banks play a role, we need to find a way to connect into consumers and businesses. That's one kind of CBDC. If it's one where the central bank goes directly to the consumer, that's a whole different game with a whole different risk profile of what the central bank is exposed to. Economy. And I don't think that's the one that Christine and others are referring to. They're referring to that double tier one in the middle or the wholesale one. And I'm a fan of those. I'm a believer that those will come and we should participate in them.
AJ, a great pleasure speaking with you. Thanks for your time today. We really appreciate it. AJ Banga, MasterCard CEO. It's worth pointing out that AJ also a founding partner of the Bloomberg New Economy Forum. And beginning Monday, the New Economy Forum will be bringing together global leaders to discuss building an inclusive and sustainable economy in the post-COVID world. You can watch it on Bloomberg.com, on the terminal via LiveGo, and on Bloomberg New Economy social channels on Twitter and Facebook. This is Bloomberg.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
We would love, at the right time and the right way to have a digital bank license. We would almost certainly do that in partnership with a strong local partner, and we would use the technology and the experience that we've gained from Mox in Hong Kong.
Let's check in on the Bloomberg First Word News. I'm Karina Mitchell. Well, it is the latest move by the White House to pressure Beijing. President Trump has signed an executive order barring American investments in Chinese companies owned or controlled by the military. The order says that China is exploiting American capital to develop its military, intelligence, and other security apparatuses. Meanwhile, China has congratulated Joe Biden and Kamala Harris on winning the presidential election. That ended days of speculation about when Beijing would formally acknowledge the victory. China was one of the few countries that had so far withheld comment. The reaction came after several television networks projected Biden would defeat Donald Trump in Arizona. State and federal election officials are rejecting President Trump's claims of widespread voting fraud. In a statement, they say that last week's election was the most secure in American history, adding there is no evidence that any voting system deleted or lost votes, changed votes, or was in any way compromised. And some congressional Republicans are splitting with President Trump over his refusal to acknowledge the outcome of the election. They say Joe Biden should receive presidential-level intelligence briefings. President Trump started getting briefed a week after his election in 2016. So far, he's refused to allow Biden to get that information. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg. Alex.
Okay, let's pick up and talk a bit about what's happening in these markets. This week started off with everybody getting very excited about the Pfizer vaccine. And we saw this huge shift to the other side of the boat as everybody went into the value trade. The week is kind of wrapping up with everybody refocusing on what is happening with the virus and the fact that it's picking up aggressively in Europe and in the United States. So what are investors to do? What do you make of this narrative? Which one do you invest in, the now or the back half of next year? Tobias Levkovich of Citi joining us now to give us his take on all of this. Tobias, talk me through your thoughts on this week, what we've learned and what does it mean for investors?
So look, we've been on the mindset that investors really need to think about the value trade over the growth trade already prior to this. So, for instance, we were focused on a number of issues like bond yields moving up since kind of early September and showing some pressure on the stocks, and as a result, really having some impact here. We started to see kind of the loss of leadership of a number of the big mega cap tech names over the past couple of months. And the vaccine news just continues to suggest that the value trade has more opportunity. We can get into a lot more detail on it.
Well, let's go there, because as Guy was intimating, short term, it's like you still have to own tech because 10-year yields are still below 1%. The curve is steeper, but it's still at 71 basis points in the 210. So you kind of have to own tech. So how do you position correctly?
Well, you don't have to own tech. Let's start with that. There's no have to own anything. I think the valuations already reflect that very low interest rate environment. But I would take it a step further, where as you move into February, March, April, irrespective of vaccine timing, and which is probably going to be more impactful in the latter half of the next year, but even as you move to February, March, April, you're going to see some very dramatic changes in comps or comparisons for what you would call the COVID beneficiaries, the ones that were getting stronger business trends because of work from home, because of shelter in place. They were booming in 2020, and they're going to see their momentum slow just because of very difficult comparisons. Conversely, those who have been the COVID-impaired industries, may see their businesses up 50, 60% off extremely low bases. And the problem is that this is going to last for several months. It doesn't mean it's going to go away. Now, I don't want to suggest that we don't like tech at all. We have overweights in semiconductors. We have overweights in technology hardware, though we have that on a downgrade watch. We are worried that software and services are particularly aggressively valued.
Tobias, when I commit to this value trade, how do I know the difference between a business and a sector that is going to bounce back and a sector that is going to have long-term structural changes that are likely to be negative as a result of COVID? Because I appreciate that there is going to be a rebound probably for everybody, but the order of magnitude is going to be significant, and some businesses simply aren't going to come back.
So the question is, let's look at one in particular. Let's look at travel, for instance. So we think corporate travel will be damaged, more structurally impaired, as particularly companies don't necessarily need as many of their people traveling to see other people in their companies. I think client engagement will still come back, but not necessarily, inter-company travel. People are going to use video conferencing and things like that to run their businesses more because they know it works over the past 9 months. I think leisure travel, people can watch drones flying around the Colosseum in Rome to give them a tour of that, but I think they're going to want to do that on themselves, get on planes, fly to Italy when they can. So I think there's kind of a difference, and we have to think about where is there going to be more impact. But entertainment, hospitality, leisure, those things will probably come back once people feel comfortable to go out and do it. So I think there's another thing that you kind of hinted at maybe, and that is particularly leveraged industries may find themselves forced to do equity issuance and dilute shareholders, as we saw, for example, with the banks back in 2009, 2010. We could see that in a couple of areas as well.
So it begs the question then, Tobias, when is the right time to make this pivot? If we learned anything this week from the Pfizer news, it felt like it was buy the news immediately and then sell it kind of thing. And I wonder then how we stack up towards Moderna and then the timing of it.
So it's a great question. I think the problem is that there is such a crowding in these, what I will call COVID winners, that the inability for people to have moved a lot of money in those 1 or 2 days caused these incredibly volatile and even vicious moves. So maybe things went a bit too far in a day and then kind of, calmed down a little bit the next day. But I think it's very difficult for investors to be able to do this, how should I put it, to ease into it. I don't think you can wait till all the news is out because it'll probably be a bit too late to do that. And in some instances, you saw stocks drop 20% in a day and others go up 30% in a day. And that, to me, was just where they were positioned and the illiquidity in the trading activity. So I think any time some of these mega cap tech stocks kind of really run, there's going to be some sellers who want to get out who weren't able to get out. And every time there's pullbacks in some of the value areas, if it's cyclicals, if it's in the travel, hospitality, entertainment, leisure group, or even to some degree financials, so that's its own interesting dynamic, there are going to be some buyers who will bid it every time it comes off a bit. So I think this is going to happen over several months. It won't happen over 1 or 2 days because it shouldn't happen in 1 or 2 days.
Tobias, you're not a bond analyst, but let's kind of just talk about the relationship between what is happening in fixed income and equities. We have heard from a variety of central banks this week, making it very clear that they will continue to provide lots and lots and lots of liquidity. That's likely to keep a lid on yields. We may get up to 1%, we may get up to 1.2%, but we're not going to go much further, certainly seems to be the sense, and certainly the consensus trade. How does that limit the shift to value?
So 3 elements in there. One, our guys, you're right, I'm not the fixed income guy, but our rate strategist, Jabaz Mathai, is talking about 1.25, but it's up to around that 1.2% point you made. But another 30 basis points or 35 basis points is pretty significant for, let's say, the financials and the value trade, the banks, things like that. So they can get more upside, and they are pretty attractively valued. There are other issues there in terms of fintech disruption, but you could see that trade continuing. Number 2, if you were to look at the inability, interest rates aren't driving loan activity. You need confidence in the business community to actually take on those loans, no matter what the cost. Why would I borrow money if I'm not going to do new capital expenditures? And we're kind of seeing that. So the Fed or other central banks can't force anybody to borrow money. That's more about confidence in business, and the vaccines provide that. And then third, as the economy gets better, call it mid next year into the latter part of next year, in a more durable way, I suspect central banks are saying we don't have to provide as much support as we did before because we are getting back towards normal. I don't think we're going to be back to normal for a good while still, but it's the path that gets there, and then the verbiage will probably change from central banks.
Tobias, it's really good to catch up with you. Thank you so much, Tobias Lefkovich of Citi. Thank you very much. But also just talking about what we've seen this week. Here's a stat for you from Bank of America. U.S. equities had their second largest inflow ever. That's taken you to like $32.5 billion. Talking about that whippy action, as a lot of momentum traders and quant funds were really caught off guard by that Pfizer news and had to make some quick allocations. The question is, are we kind of done? And then where do we go from here? Well, coming up, we're going to take a look at new shutdowns here in the U.S. Restaurants are bracing for a brutal winter. We're going to speak to the CEO of Cisco on the company's plans to support the industry during these uncertain times. How do you even stock your inventory? This is Bloomberg.
So when you went to Baltimore, you went initially to be an anchor woman, and then it didn't quite work out.
Yeah, I got fired.
Well,
demoted.
You got demoted, but they didn't. They had a contract, so they didn't say goodbye. Yeah. And then how did you work out to be on a afternoon show where you actually got to be an interviewer? How did that actually happen?
Well, what happened was this is what I now know with age and perspective, that many times getting demoted is an opportunity for something else to show up, or getting fired. You know, lots of people I've interviewed over the years who have these stories about the best thing that ever happened to you. It puts you in the next best place. I was not a good television reporter. I was too emotional. I was making $22,000 a year, and my best friend Gail, who I met there at the time, she was also working there. She said, "Oh my God, you're 22, making $22,000. Imagine when you're 25." Then you're 30. So I'd be making 60 about now. It'd be good, 62. Once I got demoted, they didn't want to pay out my contract. I was making $25,000 a year. They didn't want to pay me the $25,000. Right. So they kept me on and said, "We'll put you on this talk show just to run out your contract."
We don't have a sort of fixed order of use of tools, and I think that
Live from New York, I'm Alex Steele with Guy Johnson in London. This is Bloomberg Markets. So restaurants here, at least in New York, preparing for another potential lockdown as winter approaches, hurting their business yet again. Want to break it down with what it means for the industry as well as jobs. Bloomberg's Michael McKee is here with more. Hey, Mike.
Hey, Alex. Well, this chart kind of tells you what's going on. This is the high-frequency indicators that economists are watching, and we've seen since we saw the rebound back in May and June and July that all of these things have pretty much flattened out until very recently. Now we're starting to see the rollover as more things shut down. And the one I want to point out to you, this is the mobility and retail sales and airplane loadings, but the white line is the open table restaurant reservations, and you can see that they have really rolled over. These are 7-day moving averages, so the number over the last couple days is even worse. And one reason for that is we're starting to see the lockdowns again. Remember what we saw earlier in the year. Now we're starting to see more restrictions on who can gather and how many people can gather. But as you can see from the yellow notes here, it's not as bad as it was back at the beginning of the year yet. People are more reluctant to shut things down. There's also a lot fewer restaurants out there because they have closed. But we're getting into the winter period when the restaurants who have been serving people outdoors are going to have a much harder time doing so. That raises questions about where we go from here. You look at employment in the industry, and it is terrible. We've gained back a lot of the jobs that were lost, but we're still more than 2 million restaurant and bar jobs short of where we were back in February. So a major impact from this virus on that industry in particular, Guy.
Well, let's talk more about it. Mike, thank you very much indeed. The virus clearly having an effect on the virus business, in fact, the whole food industry. Kevin Hurricane, Cisco's CEO, joining us now. The company announcing plans to eliminate maximum delivery requirements in an effort to help restaurants. If you want to know about this company, it is the world's largest global food services distributor. So Kevin knows what he's talking about here. Kevin, what are you getting right now? What are you hearing? What is the industry telling you?
Well, as you just heard, Guy, the restrictions that are happening again here with this COVID wave 2 are pretty significant in the industry. And we, Cisco, are doing more to help those restaurant customers of ours than anyone in the industry to be successful and to make their way through this pretty difficult time that will be in front of them. We announced today the opportunity to waive all delivery minimums, just take one more stressor off of their back so they can focus on serving their customers. And we're also offering free value-added services to help them be profitable during these winter months.
So let's break down kind of then what you're seeing. Anecdotally, obviously here in New York, indoor dining is pretty paltry. It's all about building these outdoor spaces. Whether or not they're safe is a whole different conversation. So literally, like, what are the supplies that restaurants are asking you for? And how is that changing just over the last few weeks as we've seen sort of targeted lockdowns?
Yeah, Alex, it's a good question. And I'm being asked that question often, Kevin. What's the driver of business performance for these restaurants, small, medium, and large? Is it cold weather in the north, or is it restrictions? To be crystal clear, it's restrictions on the customer. We have not seen significant differential in business performance for cold weather versus warmer weather. It's when on-premise dining is reduced from a 75 to a 50 or 50-25, or in some locations have indicated from 25 down to 0. So what we've been working with our customers is to ensure they have a vital takeout capability, a delivery capability, that their website has been converted to a mobile version that's easy to use. As it relates to your question on what are they ordering, they're ordering the same things they were ordering before. They're just ordering at lower volumes, which is why today we've announced that we will eliminate those order minimums that I mentioned a moment ago.
Kevin, can I talk to you a little bit about what impact you think the vaccine news will have? Do you think the effect will be that people will look at it and say, there is light at the end of the tunnel? It's going to be really difficult throughout the winter, but if I can just keep my business going, I now know that there is a way out. Is that what people that are running restaurants are telling you? What is their kind of optimism at the moment?
That's a good question. And I think it's two things. It's therapeutics and the confidence in therapeutics treatment, having the death rate come down, and obviously the vaccine component and the light at the end of the tunnel. And that is what we're hearing from our customers. They're a resilient bunch. These independent entrepreneurs are just that. They're entrepreneurs. They're fighters. And we as a company are doing more, as I mentioned, than anyone else to help them survive and succeed through this crisis. But there were some reports back in that April-May timeframe of things to the nature of 30-40% bankruptcies in this space. And we've been resolute from the beginning. We believe that's greatly exaggerated. In fact, our customers are currently closed at less than 10% that could tick upward through these winter months, but we believe that it's going to be much less of a permanent closure than what some media has been reporting. And we're doing everything we can to help them survive with takeout, delivery, menu redesign, increasing their profitability through consultation that we're providing them.
So, Kevin, in the market, when we got that Pfizer headline, it was literally off to the races, a rotation in the market that people have never seen. So when we get a vaccine, is economic activity going to be the same kind of thing? Oh, there's a vaccine, great, let's like all herd mentality go out to a restaurant. Like, are businesses preparing for that, or what do you think the on-off switch is going to look like?
Yeah, thank you for the question. What we're seeing in our data is that the consumer absolutely is ready, willing, and able to go back out to eat as soon as it's safe to do so. In locations where there are fewer restrictions, our performance to prior year is actually quite good. It's really almost a direct line between the restrictions on the customer performance. So we can clearly see the consumer is ready to go out to eat. They want to experience that meal away from home. There's pent up demand. And yes, we anticipate a robust recovery as soon as it's safe. And safe will be driven in part by that vaccine. And there is a light at the end of the tunnel coming, hopefully, or in the early part of next year.
Kevin, how different is Thanksgiving going to be this year?
It'll be very different. It's Thanksgiving and just the holidays in general. They'll be very, very different than in the past. And one of the things that we've launched is actually what we call a holiday toolkit. We have the largest sales force in the industry, and they're literally going one by one with our customers to help them with things like takeout Thanksgiving, takeout holiday parties, where obviously the size of the number of people going to a gathering will be much smaller this year, but we want our restaurant partners to be able to produce take-home meals that can, in fact, be served to a family that you can confidently say is COVID-free if they come over because they're a part of your close network. So we believe there'll be much more takeout, much more delivered to their home, and think of it from a meal kits perspective. That's something we're very focused on right now.
Okay, give me some perspective on how you are running sort of the day-to-day. How many levers do you feel like you, or quite frankly, the restaurants have to pull to help their pricing power, help their cash flow, in that the easy, low-hanging fruit was probably already pulled already? Give me some insight into that.
Yeah, I'll just talk from a Cisco perspective for a second, then I'll pivot to our customers. We just posted our Q1 results and had a very strong performance. We were operating income positive. We produced over $900 million of free cash flow, and that's in an environment where our business is down more than 20%. So really proud of our team on the work we're doing to manage expenses, manage accounts payable, accounts receivable, really strong financial return. Our concern is our customers. They don't have the financial strength that we as a large company do, and we are extending ourselves meaningfully to be able to help them. And this announcement of waiving the order minimums is exactly that. Their volumes are really going to be volatile, fluctuating up and down through these coming weeks into months. And we want to just take that worry of inventory management off their back, off their plate, if you will. They're having a good week, great, we're here for them. If it's a slower week, no problem. We'll ship to you what you need. And frankly, from a takeout and delivery perspective, how they run their restaurant is very, very different than an on-prem dining environment. And many of our customers are learning that they can be profitable at a much lower level of volume. It's just the staffing of that restaurant's quite different than what it was pre-pandemic.
Interesting point with that. Kevin, thank you very much. We really appreciate your time today. It's always good to get your perspective. Kevin Hurricane, Cisco CEO, thank you very much. We want to turn now to some breaking news in Connecticut. There are reports of deaths and serious injuries following an explosion at a Veterans Affairs hospital. State and federal investigators have gone to the VA Medical Center in West Haven. A television station there reported that smoke could be seen rising from the building. We are going to continue to monitor and bring you any of those developments. This is Bloomberg.
Give you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
Live from New York, I'm Alex Steele with Guy Johnson in London. This is Bloomberg Markets. So Senate Majority Leader Mitch McConnell is moving to set up a confirmation vote for the nomination of Judy Shelton to the Federal Reserve as early as next week. Shelton has drawn criticism for her past support for the gold standard and also questioned the need for a central bank. At the same time, your President-elect Joe Biden is on the hunt for his Treasury Secretary. Federal Reserve Governor Lyle Brainerd is reportedly at the top of that list. For more on what this means for financial regulation, I want to bring in Bloomberg's Sonali Basak. We've been talking about this all week in accordance to Lyle Brainerd. What would that mean if she was head of the Treasury?
Right, and the most important thing we've talked about when it comes to Lyle Brainerd is the fact that she was a little harder on the banks than you've seen a lot of the other Fed governors be in the Trump era. And her at the Biden cabinet in and of itself is one thing. But if you talk about all the other people Biden are talking about to take posts in a potential cabinet and other heads of regulatory agencies, you can start to see a picture that might be a lot harder on the entire financial system than initially expected.
Okay, there's a story on the Bloomberg. It's getting a lot of traction today. It's about the SEC. It's about people like Gary Gensler potentially moving into that post, and that would certainly have Wall Street worried. Is that actually where the focus should probably be from a Wall Street fear point of view?
Yeah, absolutely. And there's a timeline to look at here too, Guy. And Gary Gensler is not the only one being discussed. Preet Bharara is also being discussed, who we know was also very tough on Wall Street, from the banks to the hedge funds. So, and he would really crack down on insider trading in the past as well. So, and that's what I was kind of getting at when I was talking about not just the Treasury, but Treasury, SEC, CFPB. When you look at all of these agencies put together, whoever makes up that group of regulators starts to create the picture of just how hard this administration could be on the industry, despite what you think Congress might look like in the future.
Well, to that point, I'm wondering which part is Wall Street most worried about? Because there's a lot, right? There's a crackdown on white-collar crime. There's more restrictions in general, capital gains issues, carried interest, more M&A scrutiny. Like, where's everyone freaking out?
So the M&A scrutiny right now is not of immediate concern to the bankers, at least. Why is that? Because it would regard a lot of antitrust issues, DOJ, and you are worried about the crackdown on big tech, fine. But you're not necessarily worried about a lot of what's going to drive the deal activity in the next couple of years, which is a lot of distressed firms, which is a lot of pharma, life sciences. Mm-hmm. You are worried about the big banks, the hedge funds, being reined in on risk-taking and what allows them to make money in the first place. Consumer protections. Are they going to have to pay bigger fines because of their dealings with consumers? And is that limited not just to the big banks, but all the non-banks as well? Remember, all the biggest mortgage companies in America are not necessarily banks anymore.
Sonali, we're going to wrap it up there. Thank you very much indeed. Wall Street, a little worried. Sonali Basak, Bloomberg's Wall Street correspondent. Thank you very much indeed. Coming up, we're going to look at the impact of the lockdowns on one of Europe's biggest utilities. Judith Hartmann, the CEO and CFO of Energy, is going to be joining us next. I also want to take you back to the breaking news we've had over the last few minutes from Connecticut. The Associated Press is now reporting that two were killed following an explosion at a Veterans Affairs hospital. We're going to continue to monitor that situation and bring you the key developments. This is Bloomberg.
came in better than expected, not only in terms of job creation, but also a sharp fall in the unemployment rate consistent with higher labor force participation. That's really good news.
Overall, the gain was solid, but even while this is a very robust pace of job gains, it's a lot slower than it has been in the summer months.
Great that we saw the job gains we did, but they still are diminished from what they were, of course, back in April and May. And the scarring, the sort of wounds that were created by COVID are beginning to fester.
I would caution people to look at the top line number because I don't think it tells the entire story. Employment relative to population is still well below where we were pre-crisis, and that's because I think that we're going to have some lasting damage.
Depending on what you look at, jobs creation or the unemployment rate, you have different views as to whether the improvement in the labor force is keeping up or slowing down.
They have been here for quite a while. They have obtained the SVF license back in 2016. They've also been granted a license for the virtual bank. They will continue to play an important role in Hong Kong.
47 minutes past the hour, live from London. I'm Guy Johnson. Alex Steele is in New York. This is Bloomberg Markets. An ongoing ballot counts in the United States and a COVID vaccine on the horizon have sent futures markets into a frenzy this week. Scarlett Fu is here to break it down.
Guy, we had a mixed week in the cash market, and that's reflected in the futures market as well, although the moves here in futures are amplified compared to the cash market. S&P, Dow, and Russell 2000 futures moving more than in the cash market. NASDAQ futures falling more than in the cash market as well. And it all comes back to the twin themes that have dominated this week: a divided government led by Joe Biden and progress on Pfizer's vaccine. Now, vaccine signals a path to normalcy once again, the reopening of the economy, consumers getting on planes, and employees getting into their cars and driving to the office, which means demand for oil. So if you take a look at oil futures, they have shot up in this past week. WTI up almost 9%. That would mark the third 9% move in the past 3 months. It did get up to as much as 9.4%. But keep in mind that in two of the previous spikes we had seen over that 3-month period, they were followed by big declines of 8% and 10% in consequent weeks. So something just to keep in mind there. Something else that's come up a lot, of course, is the collapse of the VIX futures curve. What you want to keep in mind is that the November futures contract, that's the yellow line there, stops trading next week. And in the weeks leading up to the election, we had seen a big bump up in the VIX futures curve in the October and November contract. But as Joe Biden's lead in the polls started to widen in the days before the election, people started to bet on a drop in volatility, and that has come to pass. Alex?
All right, Scarlett, thank you so much. We really appreciate it. And let's stay with energy and commodities, how new lockdowns in Europe may affect demand for power, natural gas. Joining us is Judith Hartmann, ENGIE CEO, co-CEO and CFO. It is Europe's largest utility companies. Judith, just for perspective, the narrative that we're hearing is we had some targeted regional lockdowns and now things are leveling off and getting better. From the power perspective, what are you seeing?
Yes, absolutely. We're seeing an improvement, certainly versus the second quarter, where, of course, the strength of the lockdowns, but also the fact that a lot of big countries were in lockdown all at the same time, had a really big impact back then. Right now, what we're seeing is that we're roughly back up to maybe 3% below a normal level. And then depending on, the country going into lockdown measures, it could go down to -5 or -6%. Of course, this is also testimony to the fact that many of the governments are very committed to keep the economy running. And so we're seeing a lot of activity and really the small dip that I could point to is, of course, coming from the industries, some of them that you have just mentioned, including from airlines, but also restoration and so on, where the demand is just not there at the moment.
Judith, what happens when we get a vaccine? Is there going to be suddenly a huge demand for energy? Or is it just sort of different types of energy? People going back to the office, that's a different type of energy consumption. People not working from home as much. How do you see it shaking out? And do you think it'll be a sudden surge in terms of that shift?
So the vaccine is obviously something that we all hope for to get back to a more normalized life. Not sure that it's coming that quickly in terms of having a full impact on the economy. And so I think we need to be ready to live with the virus for some time to come. But obviously, yes, it would be very much a positive topic if we had the vaccine. Our share price went up 8% upon the news that there is a closer solution now, and clearly that goes to show you that yes, indeed, a lot of hope goes into this vaccine that would, like I said, get us back to a more normal life and a more normal consumption pattern.
Judith, does it change your energy distribution or reaction function, what kind of energy, how you distribute it if things open up?
No, so for us, we still keep the view on the long term, right? As an energy company, of course, the investments that you make are for literally decades ahead of you. Our assets are long-term assets. And so we have made a very strong commitment to renewables. We are, as you know, installing 3 to 4 gigawatts already per year. And clearly, even in this COVID year, we are investing a lot into the future of energy. And quite frankly, that's what needs to happen. We're not going back a step here. On the contrary, this crisis shows the responsibility that collectively we have, the fragility of the economic systems at times, and so you don't want to add climate change as another negative on top of COVID. That's why for us, we see it as an opportunity. We're going to continue to invest into renewables, but also into energy infrastructure that helps to distribute green energy.
Judith, many in the financial markets, many of the analysts that cover your stock were a little surprised when you confirmed your guidance. There was fear that you would not be able to do that. What gives you the degree of certainty to be able to commit to that guidance, given the volatility that we see in just about every aspect of all of our lives right now?
This is, of course, a very volatile world, and I understand the concerns that we were there. What I would say is this is a team, the NG team has been working very hard. We had a difficult second quarter. There is no other way of saying it. We've been very impacted by COVID. You know, on the first 9 months, about $1 billion of our results have basically disappeared into the COVID crisis. So you can imagine with that as a headwind, a lot of effort has gone into relooking all of the processes, making sure, of course, including the social distancing and everything is being integrating in what we're doing. The personal protective equipment, all of that is really things that we've worked on. And then that's one very important element, but also we have really communicated with the governments around us that we have to keep the economy running. Mm-hmm. The governments will not be able to substitute themselves for the real economy, which means, you know, all of us, you and I, and whoever is watching this, needs to be out there, needs to be able to work, of course, while taking care of our health. But it is really important. And so we've done a lot of work. That's what gives us the confidence. We're much better prepared to go into this fourth quarter. In fact, we're seeing it right now. We are in a lockdown in some of our main countries. France is a point in case. But our activity levels are very close to normal rates. You know, to give you an example, in April, our activity rates were down to 65-ish%. We're now above 90. And so, quite frankly, we're committed to make this happen. And we were very happy to confirm the guidance today. And of course, it was well received by the market.
Judith, talk about commitment. When do you have to review your position on Nord Stream 2? We asked you that last time, but recent developments is the U.S. is drawing up even additional sanctions on the Nord Stream 2 natural gas pipeline from Russia. When do you have to change the position?
So right now, there is no reason to change any position. There's different steps in the contracts that would come to play here. In December is when the construction will have been stopped for a year, and of course that will be a big time to relook and rediscuss with all of our partners. But right now we're still hopeful that this pipeline is going to happen, and of course we're working on this, watching this very closely.
In terms of some of the statements you put out on the various core components or non-core components of your business, a lot of work ahead, apparently, to prepare for the carve-out of your services activity. Can you define what that means, how long this process is going to take, and when you see the end game being fulfilled?
Indeed, so two main topics that we've talked about today with the market. One, we just said, which is confirmation of the guidance on the back of a huge recovery in the third quarter in comparison to a very difficult second quarter. And the second topic was indeed the strategic progress. You know, we're really looking at this year. Yes, there's of course a lot of crisis management ongoing, as I've just explained, but the strategic direction is very clear and speed is of the essence here. We have worked on our simplification already in this quarter. We have sold, of course, as you know, a significant participation. We have talked today about the scope that we have defined for client solutions.
I'm going to have to wrap things up. Judith Hartmann, Energy co-CEO. Sorry about that. Thank you very much.
Our generation's biggest problem.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Friday the 13th, live from London. I'm Guy Johnson. Alex Seal is over in New York. We're now counting you down to the European close on Bloomberg Markets. So what do you need to know from Europe this hour? Well, Germany crushing hopes for a normal Christmas. Austria signalling tougher rules. In Italy, well, it's going to extend its regional lockdowns instead of having a national one, but the numbers are climbing. The virus rather than the vaccine is setting the agenda at the back end of this week. Will the departure of Dominic Cummings from number 10 Downing Street deliver a Brexit reset? The pound rises on expectations that without the vote leave architect by his side, Boris Johnson will compromise. And Santander tells its unions that it plans to cut another 4,000 jobs in Spain. It's around 13% of the workforce. Santander's stock, though, this week up by 30%. That's as banks in Europe, that's how as Europe generally has actually had a very, very strong week. Today, it's a calmer day, but the start of the week, Monday, certainly a huge rotation towards value. Today, the Stoxx 600 is up by just 0.1%. It's underperforming what we're seeing over in the United States. The S&P up by 0.6%. The pound, though, is positive. The departure of Dominic Cummings from 10 Downing Street, he's going at the end of the year. Nevertheless, setting off expectations that maybe a Brexit reset is possible and a deal is possible. Interestingly enough, though, we are seeing a continuing move in what we're seeing in the bond markets. Bonds are bid today. Yields are moving back down. Unsurprising, given what we heard from Christine Lagarde yesterday. But more broadly, the virus definitely back in charge. The vaccine news at the beginning of the week, the virus news at the end of the week. Alex.
Such a great way of framing that, Guy. So let's break down the virus issues more. The global coronavirus cases now topping 52.9 million, deaths now climbing to nearly 1.3 million. Focusing on Europe and how it's addressing the virus resurgence. Joining us on the phone from Milan is Bloomberg opinion columnist Ferdinando Giuliano. Ferdinando, at least the story over here in the U.S. is that you guys are doing some targeted lockdowns and it's working and the cases are leveling off. Is that true?
Well, that's the positive side of the story. I mean, lockdowns are certainly less, sweeping than they were in the spring, and there are signs that in some countries like the UK or France or the Netherlands or Ireland, the curve is flattening. The bad side to this story is that the level of hospitalizations are still very high. And as we know, there are capacity constraints, and hospitals are under a lot of pressure. And of course, deaths are rising too. They are a lagging indicator, and they are ultimately the most tragic one. So yes, there are some good news, but overall the situation is still pretty worrisome.
Is there any indication, though, that the effects of A, the virus, and B, the lockdowns will be less this time round? We've had a series of waves coming through. Europe's probably had 2. Looks like the United States has probably had 3. But in terms of what is happening here, is the effect just lessened? Is the virus having less of an effect on society than it did right at the beginning of this process?
Well, so if we're looking just at purely from a medical point of view, of course, we are counting more cases because we are testing more. We'll see what the effects are on deaths, but at the moment it could look quite similar. I mean, we are catching people with the virus earlier, so they may help, and we're probably treating them better. So that will have a positive effect, but overall the wave is still pretty significant. In terms of economic shock, I mean, my impression is that this year in Europe, the economic shock won't be as bad. And that's because lockdowns are less stringent and because global trade and, for example, Asia have resumed really being in business. And so that means that, for example, manufacturing in Europe is doing pretty well, while obviously services are struggling. So in terms of society, I mean, that's the bit I'm most worried about. You know, a second wave of lockdowns, however milder, is having a real psychological impact on people. And I mean, I can tell you, from just from my experience here in Milan, you can see that the situation is more, certainly tougher in a way than it was in March and April, where it was all very new and people were less tired than they are at the moment. So the psychological effect is here, and I think it's pretty strong.
Well, that's a fair point. We also showed a chart earlier that showed the mobility in the major countries over in Europe, from France, Germany to the UK to Italy, etc. Do we have an idea of which countries are doing it correctly? Like, what measures are actually working?
Well, I mean, there are different views. Depends on what it's very hard with this virus to understand exactly what works. I mean, we know in Europe, for example, that Germany has always been able to limit the impact on both the healthcare system and on deaths, and that seems to be through a good, proficient use of tracing, testing, and also just having a lot of hospital beds available. In the first wave, we saw that the countries which enforced lockdowns earlier seemed to be doing better. That was, for example, what happened in Greece in Southern Europe. At the moment, it's very hard because, and then obviously there is the big question mark over Sweden, which in the second wave at the start seemed to have fewer deaths, but at the moment they're climbing again. So, everyone would want to pick his favorite explanation for why some countries are doing better than others. My overall impression is that, still, if you are able to constrain, at least high frequency activities, places where lots of people will crowd and gather, you're going to be more effective in stopping this.
Ferdinando, thank you very much indeed. Bloomberg opinion columnist Ferdinando Giuliano joining us from Milan. Let's look at how the markets are dealing with all of this. Fiona Frick, Unigestion CEO, joining us now to give us her take. We've had a really interesting week. We started off this week by focusing on the vaccine, and we're finishing up the week, as we've just been discussing, focusing on the re-emergence, of the very strong re-emergence of the virus, both here in Europe and over in the United States. As an investor, which one should I be investing for? Should I be investing now and being defensive, or should I be investing for the arrival of the vaccine and this huge shift, like the one we saw on Monday, to value?
I think it depends on your horizon. I think the news of the vaccine, as well as the news on the election, is a positive news for growth on the midterm, because at the end we see end scenario for this COVID crisis. And we see also with Biden and perhaps a more bipolar system in the US, a trajectory for growth for company, because there will be better cross-regional relationship, better relationship with Europe, better relationship with Asia. So I would say that on the medium term, I think there is two good news this week, which is obviously the COVID vaccine and the US election. On the short term, obviously, there is this second wave of COVID, which puts pressure. And knowing that although growth has been strong in the third quarter and has recovered quite a bit, we are entering in the second wave, not in the situation we were in the first wave. So that's why we believe that there is still some struggle on the short term, and that that is seen, by the way, in the rotation we see in stocks since the beginning of the week, because if values and cyclical stocks has rebounding dramatically on Monday, the market is not clear today if you have to play COVID stay-home stocks or COVID go-out stocks when COVID is out.
Yeah, that's a great point. Something else we also saw this week was the steepening of the yield curve, huge gap up, as well as in the U.S. in particular, rates almost at about 1%. And I wonder, when do high rates and sort of less negative real rates start to have a material impact on the market?
I think there will be more volatility on the rates going forward. And I think the good news there is that we know at least that for short-term rates and for some parts as the yield curve, there is a control done by central banks, because they will be quite active on that market by buying bonds, and therefore they will control in a way the level of the long-term bond. In the reunion yesterday of central bank, it was quite clear that the target is to leave yields low for a longer term in order to permit companies to invest and consumers to consume, and that therefore market move will be, I believe, counterbalanced by central bank moves.
As we see this happen, as we see central banks continuing to deliver lots of liquidity, can we find ourselves in a situation where, once again, that provides a sort of perfect scenario? We have at the moment the opportunity to look ahead to a vaccine. The market is already starting to do that. We have gridlock in Washington, which apparently the market seems to like at the moment, and central banks telling us they're going to continue to provide lots of liquidity. That strikes me as a recipe for asset prices to go significantly higher from here. Is that what you would expect to see?
No, we would expect volatility on the short term. Valuation on asset class, especially on growth assets such as equity, are quite expensive. So whatever move in market sentiment can have a strong effect on the stock market. We don't exclude a strong sector rotation in stock markets, even if this will not necessarily mean that the index will be going up or going down, but under the surface, a lot of things can happen in the equity market. So there is still this uncertainty around the fiscal stimulus in the US, which is very important and puts volatility on the market. So I wouldn't be so reassured that we will have a bull market for the next 3 months that will go totally risk on.
So where does then value, and that can be value within an equity market or it can be value regionally, where does that fit into your thesis?
I think what is interesting with value is that at the beginning of the week, what has rebounded is not value in its entire sector or segment, but it's really deep value. So it's really the cyclical stocks, the transportation stocks, the cruise stocks, the airline stocks, etc., etc. I would imagine that next year you could have a move towards more value stocks, but perhaps and more, less extreme deep value, I would say. More cyclical stocks, but which are less cyclical than these industries which I have just said before.
Do you worry that some of those cyclical stocks, and the transport names really stand out here, are still going to have to raise significant amounts of money? You look at the European airlines, for instance, and the possibility of large and highly dilutive rights issues still exist. Could this be a trap? I
think, yeah, that the airline will have to still live another 6 to 9 months, which will be quite tough. And I think if you look at IATA, they say that they don't see a normalization of the transportation airline before 2022, 2023. So even though there is a news of a vaccine, before people can travel as freely as they used to do in the past, and even if they want to, if they can, will they want? I think there's a long term to go. So yes, they will need financing. And it's not only the airline. We saw in Switzerland, for example, the Zurich airport. All the infrastructure around airline is also very heavy.
As we wind up going here, something that is always in the conversation, we talk value and cyclicals, is emerging markets. It feels like everyone likes emerging markets. What's the risk of being too consensus?
The risk is that emerging markets has performed quite well. So you're trading a trade which has already been traded. But the truth is that today, especially Asia and China, the engine of growth for the world, which is also a good news for the other region of the world. But the fact that Asia is positive on growth and will be positive for and China will be positive for the year is quite a good news. And it's true to say that for the next 6 months, we'll see more growth there than we will see in Europe and the US. But Europe and US will profit from that growth also. And it was said by your colleague before, the manufacturing sector in Europe is profiting from this growth.
All right, Fiona, it was really wonderful to get your perspective today after a very interesting week in the markets. Fiona Frick, CEO of Unigestion. All right, coming up, it is the exit of Brexit's architect, Dominic Cummings. We're going to take a look at the turmoil in Boris Johnson's inner circle. That's next. This is Bloomberg.
Every era presents its own unique set of challenges and opportunities. Trade CME Group futures with Interactive Brokers at low cost and seize the moment. Start investing today at interactivebrokers.com.hk.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Live from London, I'm Guy Johnson. Alex Steele's over in New York. This is the European Close on Bloomberg Markets. Let's talk about what is happening here in London. Prime Minister Boris Johnson's most powerful aide is quitting, has quit. Dominic Cummings will leave by the end of the year. Cummings was the second key architect or second key advisor to Johnson to head for the exit after tensions blew up over the way that the inner circle operates. Cummings was the mastermind, remember, of the successful Brexit campaign Vote Leave. UK government reporter Emily Ashton joining us now. Emily, this is being portrayed as an internal fight over communications, over access. Is that what this is about? Because the financial markets are reading this as a significant development in the Brexit story. Is it the former, or is there some degree of Brexit leaking into this story as well?
Well, I think ultimately it's been a bit of a power struggle at the top of number 10 for a while. I mean, Dominic Cummings has been by Boris Johnson's side since he became Prime Minister last July. You know that Dominic Cummings, as you said, led that very successful Vote Leave campaign. He ultimately propelled Boris Johnson to that position as Prime Minister, so Boris Johnson owes him a lot for that. But I think in the past year, we have seen factions evolving in number 10, a lot of criticism about how Boris Johnson surrounds himself with a very small kind of gang of people, and one of them, the main one, is Dominic Cummings. A lot of members of Parliament dislike that team, and ultimately it's kind of spilled over this week with a person called Lee Kane. He was Director of Communications. There was some speculation that he would become Boris Johnson's Chief of Staff. Well, the backlash to that for the parliamentary party was so much that the Prime Minister decided ultimately not to do that. And Lee Kane then resigned, and now we've seen Dominic Cummings resign. So I think this is factions within number 10. I can see how it's playing out in the financial markets on Brexit, but we were assured in a briefing earlier with number 10 that this has absolutely nothing to do with Brexit. Dominic Cummings told reporters himself it has nothing to do with Brexit. But you can see why people would jump to that conclusion, given his innate, involvement in the Vote Leave campaign and Brexit itself.
Well, nevertheless, though, if the UK was ready to make a deal with the EU, give up a little, get a little, does this make that easier or the same for Boris Johnson?
Well, you've seen some speculation that perhaps the UK was about to do that, was maybe willing to give a little ground on the Brexit talks, and that's what forced Dominic Cummings to move. But he has denied that. Number 10 has denied that and said it's nothing to do with that. And you also see that the chief negotiator for Britain, David Frost, who is an ally of Dominic Cummings, has chosen to remain in place. And that perhaps gives an idea that he sees a Brexit deal likely to happen in the next few weeks. So I think we'll just have to see how that all plays out.
Is Lord Frost going to stick around?
Well, that's what allies have said, that he will stick around for the foreseeable. Whether he'll stick around, for however long, we don't know. But yes, for the next few weeks at least, I think we know he's staying put.
Where does this leave the Tory party, if at all, in terms of how united or not they are in terms of an agenda going forward?
Well, so for some of the reaction today, and I've been speaking to some ministers and some senior MPs, they're quite pleased with Dominic Cummings going, because Dominic Cummings was a very divisive figure. I mean, clearly he led the Vote Leave campaign brilliantly. Nobody really expected that to be the result of the Brexit referendum, and that was clearly down to him and his campaigning. But he's always said he doesn't like the establishment, the civil service, and ultimately he doesn't like MPs. He doesn't like parliamentary party, and he's made that very clear. And it's got people's backs up, frankly. And they don't like the Prime Minister being close to a person who's pouring poison in his ear about them, about whose MPs who've been elected to their places by the public. Dominic Cummings has not been elected. So they're happy, that he's going, and they want to see a reboot of Boris Johnson's whole strategy in government. A senior MP I was talking to earlier wants a cabinet reshuffle after this. He wants him to appoint a couple of chiefs of staff who actually have the MP's ear and know what's going on.
Emily, I really appreciate it. Great detail. Emily Ashton, a Bloomberg UK government reporter. Thanks very much. This is Bloomberg.
the outlook for the economy is extraordinarily uncertain and will depend in large part on the success of efforts to keep the virus in check.
They're torturing themselves to explain that they're there, ready, willing, and able.
The Fed has basically done all it can do, with the exception of extreme emergency measures.
I don't believe the renminbi will be a viable reserve currency quickly, but I do believe it'll happen much faster than anybody expects. The question is, what is the storehold of wealth in the meantime?
All right, it's time now for Bloomberg Business Flash, a look at some of the biggest business stories in the news right now. The biggest food delivery platform in the U.S., DoorDash, has filed for an IPO. The company will list shares in the New York Stock Exchange. It's set to join Airbnb in a finale to what is already a record year for IPOs. Private investors valued DoorDash at about $16 billion back in June. And DraftKings is also higher after the company raised its revenue forecast for this year. It's an indication that the rise of sports betting shows no signs of slowing down. DraftKings now looking at revenue growth of up to 30% this year. That assumes all sports calendars are maintained through the end of the year. And Johnson & Johnson wants to speed up the testing of its experimental coronavirus vaccine, so it has turned to data experts at United Health to help recruit 60,000 participants. The companies hope their partnership will cut the trial time in half. And that is your Bloomberg Business Flash. Well, let's pick back up on the virus there, Guy. At least here in the U.S., we are urgently watching New York City schools if they'll be shut down. The positivity rate is just a stone's throw away from a 3% level that will trigger an automatic shutdown here. California also has new curbs as well. The question is, there is no national policy right now, so it's a hodgepodge of different states and different regions trying to get it under control.
You absolutely sound like you've memorized those numbers from New York in terms of where the critical line in the sand is.
A little bit.
For schools, yeah. What a week, though, Alex, in so many ways. The Monday story was really dealing with the reaction to the presidential election, the Biden win. That didn't last very long. Then what you got was a few minutes later, or a couple of hours later, into the European session, the news on Pfizer, which completely changed everything. And at that point, you had this massive rotation, this move to value, this pent-up coiled spring kind of unwinding very, very quickly. And that's really been the story. We started off the week that way. We're finishing the week looking at what is happening with the virus and the huge numbers we're seeing. We've just seen the numbers coming out of Italy. We're getting pretty alarming numbers out of the UK this afternoon as well. The numbers, as you say, out of the United States. And the other thing that's amazing this week is that the dollar has held up. In fact, the dollar has strengthened. But just to give you a few numbers, the IBEX in Spain is up by 13% this week. The Nasdaq is down by 1%. The Chinese equity market is down by 0.5%. Huge differences in terms of the performance that we've seen.
And I think the question now becomes for investors in the short term is what of the Moderna results, which we're expecting to get kind of at any time, how much of that's actually priced into the market? Many are saying because the Pfizer news result in the market was so extreme that a lot of that news has already been priced in. As you mentioned, the Nasdaq sort of underperforming on the week, and that will determine a lot of the short-term momentum.
Yep. And the bashing of tech has been really significant this week as well. You've seen it particularly in China, but you've seen it broadly in the United States as well. And there's a regulatory overlay to that. There's a virus overlay to that. There's a rates overlay on all. It's just amazing to see what's happening here. But as you say, have we had that initial kind of knee-jerk reaction to vaccine news? And does that now start to fade? Kind of the amplitude just going down with every positive piece of news? Because it's also need to be seen against the rising virus cases. What a week. What a complete swing from one side of the boat to the other. More details to follow. The European close is next. This is Bloomberg. So we're winding up the European equity session for the session and the week. Friday the 13th, something of a non-event for European equity markets. As you can see, we're up by 0.2%. Not much to fear there. In fact, a very mundane session relative to the week that we have had. I'll give you an idea of what that week has looked like. Monday, the real catalyst for change in these markets. The Pfizer news on the vaccine really providing some significant movement, as you can see. That was Monday. We came in basically with a small gap higher. That gap higher generated by the general election in the United States and the election of Joe Biden. Can't really see that. But what you can see is that movement on the Pfizer vaccine news, which really shot European markets to the upside. We've climbed through kind of Monday, Tuesday into Wednesday. Since Wednesday, to be honest, we've really been going nowhere. And the reason for that, from Wednesday, basically, we find ourselves in a situation where we've refocused not on the vaccine, but on the virus. Two really different narratives, two sides, you could argue, of the same coin, but with very different reactions in terms of the way the markets are going to read them. Let's give you an idea of kind of the differences that we've seen around the world, just to kind of compare and contrast. Have a little bit of fun with this. The IBEX, the Madrid market, the Spanish economy has been absolutely smashed by COVID, highly exposed to services, highly exposed to tourism. That market this week up by 13.5% at an index level. The Nasdaq, on the other hand, by way of comparison, down by 1.17%. This rotation away from tech into value really benefiting Europe. The Chinese market down by 0.6%. Again, that was a tech play. It's less really about what's happening with the virus story, funnily enough, and more about actually the regulatory review that the Chinese Party, Communist Party, is having of the way it treats the tech sector, driving that. But that gives you an idea of the kind of spread difference we've seen around the world. In terms of some of the individual names here in Europe, wow, we have seen some incredible performances this week. IAG, now that's the owner of Iberia, the Spanish flag carrier, and also British Airways, amongst a whole host of other names. That stock rising rapidly, as you can see, up by 40%, emblematic of the story that we've seen within the travel sector. Retail, also a huge benefit of this as well. Klépierre is a developer of retail. Basically, it's a property developer, but specializes in the retail space. Its stock up by 64% this week. Santander, I mentioned it a little bit earlier on in the headlines, cutting 4,000 jobs, making that announcement today to unions. But its stock, with its exposure into the UK and also the Spanish economies, that stock up by 34% this week. Some incredible performances being generated here in Europe as a result of that vaccine news that we got back on Monday, Alex.
Well, let's dig deeper into vaccine news. GlaxoSmithKline CEO Emma Walmsley said that drug companies are staking their reputation on that COVID-19 vaccine. The world will pay a high price if any of the vaccines fail. Earlier this week, she talked about the challenges with Carlyle co-founder David Rubenstein.
We've all been delighted to see the very recent news of some of the first results that's coming through on vaccines. Yesterday, I was just on a call last night with 10 of the global pharma CEOs who are all very heavily involved in bringing solutions to COVID. And we're really excited and optimistic to see some of the first data coming through and looking forward to seeing a lot more in the next 6 months or so. We have 3 vaccines in the clinic and 2 therapeutic treatments.
So some people are not willing to take a vaccination. Some people have said in surveys in the United States, only 25% or less of people say they want to take this vaccine because they think it's either been politicized and not sure it's safe, or some people just don't like vaccines anyway. Are you worried that people won't take the vaccine?
Well, yes, of course. I do think, and we remain concerned about vaccine hesitancy, but we also have to be incredibly respectful about why people have these questions. You know, have we been able to move fast? Have the companies put in the right kind of processes and scales of trials? What transparency are we going to bring to these processes? And why do you hear about things being stopped and started again? What does all of this mean? So I think our job is to make the commitments we have, and we have very publicly about that alongside other manufacturers, but also make sure we share data transparently and partner with governments who ultimately are those that guide in different countries around policies and distributions to reassure people.
Now, you're a member of the Microsoft board.
I am.
So I assume you have a fair degree of background now in technology and IT and other things like that. How have you been able to apply that to what you're doing at GSK?
Well, I would never describe myself as having a background in technology and IT, and I'm absolutely sure that was not why I was brought onto the Microsoft board. But it's an extraordinary company doing extraordinary things in an incredibly responsible way.
Conversation with the GSK CEO, Emma Walmsley. That's going to go out next Wednesday. It'll be on at 9 p.m. in New York and next Thursday at 7 p.m. in London. It's a relevant conversation, really, for everybody at the moment, trying to figure out exactly what impact a vaccine is going to have on your investment portfolio and whether the virus is something that you should be focusing on now. Soc Gen says, should a vaccine developments remain on track? That's good news for US equity markets. Earnings could grow by 28%. Sophie Hooden, Soc Gen's multi-asset strategist, joining us now. Sophie, this week it's Europe that's benefited, not the United States. If we do get a vaccine, is the US the place to be?
In terms of the region allocation, it's clear that the S&P or NASDAQ are not going to be the place to be, given that QE and the low interest rate environment have been a huge contributor to the price performance. So mid-caps are something to be in the US, but Eurozone and EM equities will be the other place you would want to invest in case the vaccine momentum keeps going.
How consensus is that right now? How much of that is priced?
It's clear that when you talk to investors, like being into long EM equities due to the bearish dollar view is quite consensual, but I think there's a discrepancy between what the consensus is saying and what the actual money investors put in play. And I think that at this point, investors are still sitting on the sideline, and you saw with the reaction of equity market this week that investors were not into value, were not invested in risk-on assets, and this should keep going into next quarters.
So how far through this process are we, do you think? As you say, we probably started the week with very few people invested into this trade. How many do you think have now made a decision that this is the moment that they need to start maybe not moving wholesale into the value or cyclical position, but they need to start that process? And how long do you think it will take?
I think it's gonna be very gradual. So we're not expecting a crash on tech stocks that have been playing the role of protection because treasuries are not protective anymore. So you're gonna have this gradual reallocation out of US tech into the more cyclical components. And I think that's why people are going to keep this bubble mindset where you're going to keep some growth, and we think old tech could make sense where they're geared to 5G and they're cheaper than the big tech. But on the other side, you're going to go into strong value. So companies with cash, a strong balance sheet, but could benefit basically from a vaccine and the reopening of the economies. So bubble portfolio from there could really make sense with this gradual reshift in portfolios.
What kind of move in the treasury market are we going to have to have hedge funds really rethink a lot of their positioning?
The threshold everyone is talking about is 1% at this point, and I think what we need to be careful about is which equity indices will be able to withstand such a level in an economy and corporate world where companies were leveraged into the crisis and even more leverage out of it. So I think out of it, 1% could be the threshold, but we see 120, 125 as another threshold because that's where the fair value is. And above this, if we don't have, confirmation that the economy is on a V-shaped recovery, then it's going to be very hard for the most leveraged part of the corporate world to bear that. So we would continue to stay away from leveraged companies, and I think the investor community are quite aware of that.
Sophie, if I'm an index investor, am I going to make money during this shift? Are we simply just going to see money rotating out of the tech sector into the really beaten up areas? And at an index level, we're going to go nowhere?
On an index level, it's clear that I think all the equity indices are going to go up because what is going to be priced in is going to be the new mini cycle. What's clear on the equity market at this point is that all equity indices are still in a sector picking mentality, so not stock picking yet. So I think what you're going to have to find is which equity indices are more geared to the cyclical sectors, and it's clear that NASDAQ 100 are not going to do as well as the mid caps, for example. So you're going to have to be careful which equity indices you're going to choose.
Okay. Sophie, we're going to wrap it up there. Thanks for your time today. Thanks for your input. Sophie Hoon of SocGen. We greatly appreciate it. So that's it. We're done for the week here in Europe. We're through the auction process. Quick look at where we have wrapped up, just to give you an idea of what is going on. It has been an incredible week in so many ways for European equities. And we've kind of finished the week more focused on virus than we have on vaccine. But nevertheless, we've been watching that very carefully. Those are the final numbers. I just want to bring you the news as well. I think this was largely expected, to be brutally honest. The TikTok has been granted a 15-day extension on the forced sales deadline. I think a lot of people have been watching for this. The court filing says the deadline now extended to November the 27th. Another extension in this process. If you want to carry on with the coverage at the top of the hour, we'll do that on Bloomberg Radio. John Ferro will be joining me here in London. We're going to be on DAB Digital Radio. A bit of post-game analysis, a bit of post-week analysis on what we've seen this week. This is Bloomberg.
That is certainly good and welcome news for the medium term, although significant challenges and uncertainties remain about timing, production, distribution, and the efficacy for different groups. And from our standpoint, it's just too soon to assess with any confidence the implications of the news for the path of the economy, especially in the near term.
Gradually, as we get more news on the vaccine situation, I hope that not only will it obviously give encouragement and hope, but it will also start to begin to reduce that level of uncertainty over the outlook for the future. Now, we're not really there yet, as Jay has said, but that is important, I think, for monetary policy, because we are having to make monetary policy in conditions of extreme uncertainty.
I don't want to be exuberant about this vaccination. Because there are still uncertainty about the logistic, about the transportation, about the rolling out, about the fabrication, about the number of people that will be vaccinated in the course of 21 so that we can reach the herd immunity, which will then give us more certainty from the health point of view.
Three of the world's most powerful central bankers, the Fed's Jay Powell, the Bank of England's Andrew Bailey, and of course the ECB's Christine Lagarde, speaking on the impact that a vaccine will have. Let's look at the long-term impacts of the pandemic with David Miliband, former UK Foreign Secretary, of course, and the current CEO of the International Rescue Committee. The IRC helps those caught in humanitarian crises. David, let's talk a little bit about the vaccine. How worried are you that we will not see an equitable distribution of the vaccine when it becomes available?
Good to be with you. Yes, I'm not just worried. I'm afraid one has to expect that there will not be a fair distribution of the vaccine. Obviously, it's right that essential workers are in the front line. It's right at the front of the line. It's right that the elderly and those who are susceptible to disease are in the front line. But the great danger, obviously, is that large swathes of the world are left out. And the reason for this concern is really based on very recent history. We know, for example, of the massive economic stimulus packages that have been given in the richest countries of the world. But we also know that the global macroeconomic response for developing countries has been very weak indeed. We know, for example, that 64 developing countries spend more on debt interest than they do on health coverage. And so we're in a situation where large swathes of the world, I think, are having to plan on the basis that the pandemic will become endemic and that this will be a 2, 3, 4-year process before they get the benefits of the vaccine. That obviously strengthens the need for immediate action to protect communities, not just on the health side, but on the economic side as well.
David, not to be Pollyanna about it, but does a President Biden change this scenario on a multilateral countries working together scenario?
Well, that's a great point. Look, I, like everyone else, we're desperate for a bit of Pollyanna, so I don't apologize for being a bit Pollyanna-ish. But look, the Biden administration has made some really quite detailed commitments. I'm obviously from a European background, albeit I'm now leading a US headquartered global NGO. The American tradition isn't to have the kind of detailed manifestos, but if you look at the Biden campaign plan on things like engagement with the World Health Organization to ensure a global pandemic response, not just a different kind of US response. If you think about what they've said in respect of the largest humanitarian catastrophe in the world in Yemen, they've been very clear about what they want to do. If you think about the way in which they've talked about bringing American presence more clearly into global diplomacy, it's not a question of being Pollyanna, but it's saying there's clearly a new start.
How different is that going to be for what you do? The Trump administration took a very hard line on refugees. It took a very hard line on those that needed to move because of what they had to deal with at home. China was one area you could argue that was an exception when dealing with the Uyghurs. But nevertheless, how different in terms of the approach that's going to be taken do you think we'll see between the two administrations?
I think that in some areas, a very stark difference. I mean, one example for a US-based audience would be to think about the number of refugees allowed into America. President Reagan admitted more refugees than any other American president, over 200,000 a year. President Trump cut the Obama level of 90,000 down to just 15,000 who were allowed in the pre-COVID year. President-elect Biden has said he wants to go back above that historic average to 125,000. So there's a big change there. These are people who come from the most vulnerable communities in the world. They're security vetted, and they become patriotic and productive Americans. On the global scene, there are some areas of big change, like the World Health Organization, like engagement, I think, with the European Union. In other areas, it will be more nuanced. There are very, very difficult issues, for example, around Syria, around Libya, where the differences or the change, I think, will be taking place over a longer period of time and will be measured more in inches than in miles. So I think it depends on the policy area that you're looking at. One final point, though, I think we have seen over the last 4 years quite a systematic demonization of many of the people who we serve, refugees who are who are branded as a terrorist threat rather than as civilians in need. I think the Biden camp, and certainly the campaign and the president-elect's team, have made clear that they want America to reestablish its place as a humanitarian leader. And I think that's quite significant and in tune, interestingly enough, with Congress, which has resisted President Trump's attempts to cut the humanitarian aid budget, and also in some of the recent polling with the American people.
So, David, I wonder on a more immediate front, Biden has been mentioned very much in the Brexit conversations, his Irish heritage being spoken about. Boris Johnson, President Trump definitely saw eye to eye on that kind of issue. How do you think the Biden administration or President-elect Biden plays into the Brexit conversations?
I think that the Biden team are serious people. They're not interested in playing games. That has two immediate implications for Brexit. One, they will see the European Union, 500 million people, as important and powerful global allies, just by force of numbers, a more powerful ally than the UK of 65 million people. And the Biden team can see the power in Paris, Berlin, and in Brussels. Secondly, bilaterally with the UK, I think there's a couple of messages that are very clear from the Biden camp. First, that they value the UK and they want the UK to bring its resources to the table. Second, they want the UK to ensure that it does nothing to undermine the peace in Northern Ireland that was so hard won and which America played an important role in. And thirdly, and hopefully, I think that the Biden team will be saying to the UK, look, you've left the European Union, that's your business. But for goodness sake, don't cut off your foreign policy, security policy, intelligence policy, foreign policy links with the European Union. And in your argument about the trade deal, beware allowing those foreign security intelligence policy aspects to get lost.
David, you spent a lot of time in the corridors of power in London. What is your assessment of what is happening in 10 Downing Street right now? We are seeing the departure of Dom Cummings, the Vote Leave campaign, and the power that it had within 10 Downing Street seems to be fading fairly fast. Do you think that is a prelude to Boris Johnson doing a deal?
Well, I'm not sure if I'm meant to say this since I'm being interviewed on your show, but I don't know, honestly, about the goings-on inside the Conservative Party. What I do know is that in common with many other countries, although with some additional challenges, the UK faces a very challenging time and needs clear and coherent government. I mean, the UK is dealing with a very, very bad pandemic situation at the moment. It's at the absolute last chance saloon for the Brexit negotiations. There's a roiling of the Scottish nationalist issue, which I think you've covered on your programme other times. This is a time when people need coherent, consistent government. And you can see the kind of tone that's being set in a transition here by the incoming Biden administration. I think there are some lessons about how government can convey sureness of purpose, clarity of touch, and above all a view that it's the people's needs that count, not the internal feuding.
Well, David, we love your perspective. Thank you very much, David Miliband, International Rescue Committee President and CEO and former UK Foreign Secretary. This is Bloomberg.
It came in better than expected, not only in terms of job creation, but also a sharp fall in the unemployment rate consistent with higher labor force participation. That's really good news.
Overall, the gain was solid, but even while this is a very robust pace of job gains, it's a lot slower than it has been in the summer months.
Great that we saw the job gains we did, but they still are diminished from what they were, of course, back in April and May. And the scarring, the sort of wounds that were created by COVID are beginning to fester.
I would caution people to look at the top line number because I don't think it tells the entire story. Employment relative to population is still well below where we were pre-crisis, and that's because I think that we're going to have some lasting damage.
Depending on what you look at, jobs creation or the unemployment rate, you have different views as to whether the improvement in the labor force is keeping up or slowing down.
We explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe.
Live from New York, I'm Alex Teal with Guy Johnson in London. This is the European Close on Bloomberg Markets. Guy, you've been freaking us out with the Friday the 13th thing. Second one this year. That's pretty rare. Typically, the markets handle it like any other day. Stocks are up slightly over 52% of all days, but a gain of like 56% on Friday the 13th. I should say 0.65%, I think. But let me freak you out on this. March 13th was the last Friday the 13th, and New York City schools shut down that Monday. Probability is New York City schools are going to shut down this Monday.
You don't care about the market, do you? This is the only thing that Alex cares about right now, basically, is whether or not schools are going to be shut down. And it looks increasingly like that's going to happen in New York on Monday. Yeah, but there was a huge swing on the last one. So that's interesting as well. So the last one, remember, you can only have 3 Friday the 13th in a year. You can't have any more. So in March, let me just check my numbers here. The S&P gained by 9.29%. So it does make you wonder what's going to happen next Monday. If your kind of mirroring of these two events also holds true for the financial markets as well.
Yeah. Did I mention that schools closed the Monday after the last Friday the 13th? Okay. Happy weekend, Guy. That does it for Guy and I. And myself, coming up, Balance of Power with David Weston on Bloomberg Television and Radio. I'll be speaking with University of Minnesota Director of the Center for Infectious Disease Research and Policy. This is Bloomberg.
The big concern is climate change. We can see the global warming accelerating at the moment, and the goals that we must hit are so ambitious. It's 1.5 degrees by 2050, being climate neutral in terms of emissions by 2050. That's a huge challenge. We have to reduce emissions by 50%, 2030, 2040 again. It's very, very ambitious, and mobility plays such a crucial role in there. One thing is to do it in developed countries. I think we're going to get there by 2030, but then the rest of the world, and that's just as important. If you look at developing countries, emerging countries, that's where probably the biggest challenge we are going to face, to also deploy EVs there and make mobility greener in those countries. I know it's possible to move mobility forward fast enough to be able to do its part in this fundamental threat that we're facing.
We would love, at the right time and the right way to have
rising.
From Bloomberg World Headquarters in New York to our TV and radio audiences worldwide, I'm David Welston. Welcome to Balance of Power, where the world of politics meets the world of business. I want to check on the markets right at the beginning here. Joining us now is Abigail Doolittle. So, Abigail, I got to tell you, these markets have been all over the place this week. We're back up again today.
We are back up again, and you're right, all over the place this week, and lots of news to digest, including the virus worsening. But at this point, bulls not seeming to care, looking past this, thinking perhaps it won't be as bad as it was before, even though there are some signs that are certainly concernings and restrictions. So at this point, we have the S&P 500 higher. We really have some outperformance for the Russell 2000, that small cap index, up 1.4% relative to the S&P 500, up about 0.9%. The energy index is up sharply, almost up 3%, and the banking sector doing very well, David. So what makes this interesting, this week started off with a huge rally for the cyclical sectors and small cap. Overall, we're ending that way, and that, of course, had to do with the vaccine possibility of Pfizer. So it seems as though investors, once again, looking past the difficult months that may be ahead toward, let's call it July or August, pricing forward at 6 months to 8 months to 9 months ahead, hoping that we get past the virus. But again, there could be some difficult time ahead. But this week, you wouldn't know it.
I should say thank you so much to Abigail Doolittle for that report on the markets. Overnight, we were reminded once again of the complexities in the U.S.-China relationship as a foreign ministry spokesman congratulated President-elect Biden, even as the Trump administration was banning U.S. investment in specified Chinese companies they said are tied to the Red Army. Richard Haas, president of the Council on Foreign Relations, published this week a foreign affairs piece titled Repairing the World, in which he lays out the issues that will be in President Biden's inbox the day he walks into the Oval Office. So welcome, Rich. It's great to have you back with us. China is certainly in that inbox that you described, but it actually is not the first thing. The first thing isn't COVID-19.
I agree. China's in the inbox, and it will be for presidents as far as the eye can see or the brain can imagine. It's one of the structural challenges, shall we say, conceivably an opportunity of the 21st century. And as a result, there's no urgency to get it right in the first couple of months. And the contrast there is with COVID. We may not think of a pandemic as a national security priority, but it's exactly that. And unless we get it under control here at home, we're simply not going to have the bandwidth to do much of anything else. Obviously, it'll hold back the economy. And so I think that becomes the priority. It also, though, has real foreign policy dimensions. There's the question of the U.S. getting back into the World Health Organization. I think that makes sense, even though it's flawed. It's the only way to gradually improve it. I think there's the question of participation in global efforts to produce and distribute and fund any vaccine or other therapeutics that may emerge. I also think there's one other foreign policy dimension, David. If we can get COVID gradually under control here, it sends a powerful message that the United States is back, that essentially we can continue to function, and that with our technology and despite our political divisions, we can still make good things happen in this country. And I think that sends an important message to the world.
Richard, if COVID-19 is first on the list, it sure makes sense it would be. Is this the worst possible time for a transition? Because we can only have one president at a time, as you know so well. We're not going to have a President Biden until January 20th. And right now, it doesn't appear that President Trump is deeply engaged in fighting COVID-19. At least to the outside world, I can't see it.
No, he's not. It seems to me he's disengaged. He's abdicated. The only thing worse than a transition, David, would be no transition. And the idea that you would have 4 more years of an administration that has essentially not taken ownership of COVID-19, that would be a nightmare. That would be a disaster. So you're right. We're going to lose the best part of the next 2 months when it comes to things like promoting the use of masks, unless some governors get on it. We're not going to have a national testing priority to develop one. The situation's going to get worse before it gets worse. I think, though, by the spring, some combination of greater use of masks, the development, hopefully, of some better therapeutics. Obviously, people are optimistic about 1 or more vaccines. So I think if I had to sort of lay it out, things are going to get worse before they get worse, before hopefully, ultimately, they will get better.
Let's come back to that U.S.-China relationship because it doesn't look right now like President Xi's making it that much easier for President-elect Biden as they made that move in Hong Kong that caused the opposition to all resign en masse. What do you think is the Chinese position on President-elect Biden?
I don't think they have any great hopes in the sense that this is going to usher in a new age of U.S.-China comity. They understand. Indeed, there'll probably be more continuity than change. If one looks at the people around Vice President, President-elect Biden, a lot of them have said or written fairly tough things about China, particularly over human rights. If anything, they'll be tougher than the outgoing administration. You have widespread concerns across the political spectrum on trade-related issues, on technology. And some of the people around Mr. Biden have worked in places like the Pentagon and have very strong views about Taiwan or the South China Sea or what China's doing on its border with India. The one constant here, David, is Xi Jinping's China is a very different China. It's more repressive at home. State ownership is not only continuing but growing in the economy. It's more assertive and more capable in its foreign policy. And I think the Chinese are plowing ahead. This is the trajectory they are on.
So as a practical matter, Richard, what is the realistic possibility of having multilateral efforts to really cabin or redirect China at all? Because one of the things you write about in your piece is returning to multilateral efforts, to some of the international institutions that we have. Sure. Can that really redirect or even a little bit where China is headed?
Oh, absolutely. It's called, in a sense, that's what diplomacy is about. The United States has this great structural advantage or potential leverage called its allies and partners. The Europeans could play a big role on things like human rights pressure or technology. The Asian and Pacific allies could have all sorts of role to play on economics, on strategy. I think there's a real question, though, for the new administration, whether it's prepared to join into what was the Trans-Pacific Partnership and work with other countries in the region to force China to raise its standards, whether it's economic standards or climate-related standards, in order to have access to half the world's markets. So again, I think the real advantage we have is changing the means of our policy. I think there'll be considerable continuity in ends. I think the real difference will be a Biden administration will work much more with our allies, South Korea, Japan, Australia, the Europeans, partners like India, to approach China. And I think potentially that's what foreign policy is about. It's to shape the foreign policy choices of a country like China. And history suggests that's possible. What's not possible, which is a tack the Secretary of State has been on, is to try to transform China. They're not going to walk away from the Communist Party. They're not going to become liberal Democrats overnight. That is, to me, just folly. But I do think there's a chance we can influence what China does.
Richard, the title of your piece in Foreign Affairs is, as I say, repairing the world. You draw a distinction between repairing and building. You have to repair before you build, as I understand what you're saying here. One of the major issues in repairing is those international alliances of all sorts that you talk about here. How quickly can that be done? Are people waiting for us with open arms, or has there been longer-term damage that will take a long time to repair?
Well, the answer is both. I think particularly the democratic countries in Europe and Asia are very happy about the turn of events here. Still in the back of their minds, there's some concern about the long-term trajectory of this country. They saw that President Trump got 70 million votes. They believe that Trumpism will be a permanent or at least long-standing factor in politics. So I think there's a wariness about the United States that didn't exist before. If this could happen once, it could very well happen again. But in the short run, the European countries, many of the Asian countries are extremely happy that you'll have a government that is oriented towards multilateralism. We'll rejoin things like the Paris Climate Accords. We'll get back into the WHO. We'll basically believe in diplomacy, and rather than hammering allies every other day, we'll be more prepared to work with them. Who's not happy are the authoritarian governments, the Russians, the Chinese, the Turks, the Brazilians, and so forth. And I expect Israel and Saudi Arabia are, shall we say, less than thrilled with the outcome here.
At the present time, it appears that President Biden will face a divided Congress, with the Senate probably, not certainly, but probably being in Republican hands. Typically, we think of the president as having more maneuver room in the international sphere than domestically. At the same time, you write in your piece that it's time for us to try to reestablish more of a relationship with the Congress and the Senate, actually, and that might be possible.
Yeah, I think the value of it is if the United States could operate in a fashion in which the president just doesn't do things unilaterally, but instead does it with the Congress, it adds a lot more staying power. It makes it much harder for future presidents or Congresses to come along and reverse things. So I think the rest of the world would welcome that kind of a change. That said, it obviously is much more difficult to get things done if they're from different parties and they can't agree. But I do think there's a decent chance, David, we could see agreement on such things as the broad outlines of policy towards China, on things like restructuring supply chains, on policy towards Russia. I don't even rule out some possibilities for things on North Korea. Where I think it gets tougher to get bipartisan agreement is when it comes to Iran and probably when it comes to trade. Though in trade, the problem might not just be Democrats and Republicans not agreeing. It might be Democrats and Democrats not agreeing.
Yeah, that's exactly right. Finally, do you expect a reversal of some of the decisions on troop withdrawals, such as West Germany, talk about South Korea, Afghanistan?
Absolutely. I think Germany for sure. I think the pressure on South Korea will fortunately go away. I think Afghanistan's a little bit more complicated, but my guess is we'll end up with some kind of a residual force, a modest force there. The agreement the United States signed with the Taliban, I think, is a really unfortunate agreement. It's not about peace. It's simply basically a cover for the United States to rush to the exits. And rather than promoting peace in Afghanistan, it'll promote a whole new wave of violence and turmoil. So I think that's likely to be our return, revisited. And I think you'll probably also see some questions about some of the other pullouts from the Middle East. So I think we're going to see a much more internationalist foreign policy and a more multilateralist one. But I don't think Mr. Biden has any interest in going back to the era of the last couple of decades when the Middle East overwhelmed the rest of American foreign policy and military involvements overwhelmed the rest of American foreign policy. Fortunately, I don't think we're going back to that either.
Richard, thank you so much. It's always a treat to talk with you. That's Richard Haas. He's president of the Council on Foreign Relations and author of the best-selling book, The World, A Brief Introduction. Coming up, we talk with a veteran of the Senate who knows where the center is. Former Senator Joe Lieberman of Connecticut joins us. This is Balance of Power on Bloomberg Television and Radio.
Give you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here? It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week. This is Balance of Power on Bloomberg Television and Radio. I'm David Weston. President-elect Biden will come to office with a long agenda and what looks to be a divided Congress, raising questions about how much he can accomplish and how he would do it. Joe Lieberman served 24 years in the United States Senate and ran for the vice presidency with Al Gore in 2000, losing an exceedingly close election and one that's very much contested. We welcome him now back to Bloomberg. So, Senator, thank you so much for being with us. Great to have you. Give us your sense, because you always, in my experience, were pretty much in the center in your own way. In fact, you were independent for the last few years you were in the Senate. What are the prospects for a President Biden dealing with a divided Congress?
Thanks, David. It's great to be back with you. So, look, it really, if you look at American history, it's in the center when people of left and right, Democrat, Republican, come together, talk to each other, listen to each other, negotiate, compromise. That's when things get done. And that is Joe Biden's history for decades in the Senate. He's a proud Democrat, as he said throughout the campaign, but he also said he's going to govern as president of all Americans. And he knows how to make the Senate work. And in some ways, having a Republican Senate, which it looks like he will, is something that he will be familiar with. I mean, it's been discussed over and over again, but Joe Biden has a good relationship with Mitch McConnell, and they both understand that it's in the center where things get done. So I expect that nothing's easy. We have a polarized country. We have very zealous people on left or right, but there's a broad middle that just wants the government to work again for the benefit of the people, to deal with the virus, to get the economy going. And I think that's the main reason overall why Joe Biden is our president-elect, that people wanted a unifier, somebody who could, from inside their experience in government, make the government produce for the American people again. And I think he can.
So as you look at it, where is that overlap in the Venn diagram, potentially, between a Joe Biden and a Mitch McConnell? We hear a lot about infrastructure, for example, but then some people say maybe some limitations on prescription drug pricing and maybe some disclosure on the prices, maybe even DACA, the Dreamers Act, maybe if it's tied with E-Verify or something. Where do you see a possible sweet spot there?
Well, I expect that President Biden will focus very much at the beginning on dealing with COVID-19 and the pandemic, getting it under control. That's the priority. And then related to that, but also separately, to get the economy really pumping, growing again. So everything else, I think, will give way to that. You'll have some of the things happen abroad that Richard Huss just talked about. I'm sure the U.S. will re-enter the Paris Climate Change Accords. I'm pretty sure we'll re-enter the World Health Organization. Those are symbolic, but most of the concentration will be on the problems that America faces. And I think as part of the economic growth that Joe Biden will make a real run with Mitch McConnell at an infrastructure investment bill, which would be good for the economy. Actually has support in both parties, but somehow never seems to get done. I think when you look at some of the groups within the country that gave Joe Biden support and are important within the Democratic Party, and a contrast to what President Trump did, I think President Biden will look for ways to reform our immigration laws. And I expect that he will do whatever he can by executive action, order, to restore the status and security of the so-called dreamers, the immigrant kids who were brought here by parents who came illegally. I think there may be a surprising run at some kind of immigration reform. And I think there are going to be some Republicans, I hope McConnell, who will want to do that because it's good for the country and frankly good for the economy, and maybe good for them, Republicans, politically, because they're watching some attrition happening as the number of Hispanic Americans grows, and they're sensitive to what the government is saying about them. So it can be really productive.
Senator Lieberman, let's turn to something that you have been very involved in, very devoted to, and that is the state of Israel and the Middle East more broadly, for that matter. It was widely perceived that President Trump has been a true friend to Israel, sometimes in controversial ways, but Israel certainly has felt he's a friend. There's some nervousness now over in that part of the world. What do you think President Biden will do with respect to Israel and the Middle East?
It's a really important question, I guess I'd say this about Israel. Throughout most of its history, certainly the 24 years I was in the Senate, Israel enjoyed broad bipartisan support. Even when the parties were divided, they came together in support of Israel. The U.S. and Israel, and particularly the Democratic Party, went through a very tough time around the Iran nuclear agreement, which the Obama administration supported, and the Israelis thought was really dangerous for them. So did the Arabs, but the Israelis stepped forward on it, and that left some scars, and in a way may have left an impression that sort of Israel was growing closer to the Republicans, in that case against the Iran nuclear agreement, and moving away from the Democrats. And then President Trump came in, and honestly, just been one of the most pro-Israel presidents the U.S. has had since the State of Israel was established in 1948. So now it's going to be a time of regrouping, really. And the Democrats in Congress who are pro-Israel are going to play an important role, I think, in forming a bridge between President Biden and Prime Minister Netanyahu. Incidentally, these two men know each other forever, and they have a pretty good relationship, but they've got to get it back on heel and really restore the bipartisan support at every level for the government of Israel. From the Biden administration point of view, a critical factor to Israel and to the Arab countries will be what will President Biden do with regard to the Iran nuclear agreement. Mm-hmm. It was a major achievement of the Obama administration. I thought it was an awful agreement. President Trump pulled us out of it. It really won the applause from not just Israel, but the whole Arab world. Right. And I think in many ways led to this extraordinary peace agreement and diplomatic relations between Israel, United Arab Emirates, Bahrain, and then Sudan. Right. So just hope that the Biden administration doesn't rush back into the old Iran nuclear agreement, but tries to build on what President Trump did, and most of all consults with our allies in the Middle East before they do anything, and that begins with Israel and the Arab.
It's always such a pleasure to talk with you, sir. That is Joe Lieberman. He's former Democratic Senator of Connecticut, and this is Bloomberg.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
We don't have a sort of fixed order of use of tools, and I think that's appropriate. It would always be dependent upon the state of the world and the state of the economy that we found ourselves in.
This is Balance of Power on Bloomberg Television and Radio. I'm David Weston. It's time now for Stock of the Hour, and it is the Walt Disney Company. The company's fourth quarter results in some ways took a big dive on the COVID-19 shutdowns. At the same time, they really beat expectations, surprised to the upside. And Scarlett Fu is here with the full report.
Yeah, on an adjusted earnings per share basis, David, it means Disney closed out the fiscal 2020 year with a plunge in earnings, 65% drop. Analysts see a recovery this fiscal year and a pickup in growth the following year off easy comparisons. The problem, of course, is that Disneyland in California is still closed. It'll stay that way through the end of the year. Attendance is capped at other locations, and there's not much of a U.S. box office to speak of. So the savior here for the CEO, Bob Chapek, is really streaming, which is housed in the direct-to-consumer division, and you can see their revenue jumping 41%. It's still unprofitable, but the losses there are narrowing. Now, within streaming, clearly Disney Plus is the star. It's a one-year-old service, and it ended the quarter with almost 74 million paid subscribers. That's 13% above what analysts had expected. And just by contrast, Netflix expected to end this year with 200 million subscribers. India is really leading Disney Plus's growth. It now makes up about a quarter of total subscribers, but Indian users pay about $20 a year versus about $70 a year in the U.S.
So with that much emphasis on streaming, is it going to be trading as a tech stock rather than a media stock?
Yeah, that's a great question. If it were to trade as a tech stock, it would have a higher multiple. That would mean a higher stock price. And in a way, that's kind of how Disney executives are framing their approach during COVID. We know the company reorganized their reporting lines to account for the shift, the focus on streaming. And with good reason, of course, because streaming made up 30% of total revenue in the fiscal fourth quarter versus 17% last year. Clearly, theme parks and ESPN packing much less of a punch.
Yep. A company on the move. Thank you so much. That's Scarlett Fu. Up next, former Fed Governor Dan Tarullo on the Biden administration and where it's heading. This is Bloomberg.
Generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
We explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe.
This is Balance of Power on Bloomberg Television and Radio. I'm David Weston. As we come back, we have a red headline just crossing the Bloomberg right now. President Trump reportedly is going to rush drilling leases in the Arctic before President Biden can take over. This is in the Arctic National Wildlife Refuge, and they're going to reportedly advance the time that they can auction off drilling rights. And of course, if they actually were auctioned, it would be awfully difficult, maybe impossible for a Biden administration to reverse it. Perhaps one of other actions we may see in the coming weeks, actually, for the Trump administration to do things that are going to be hard for a Biden administration to turn around. In the meantime, before his term as governor of the Federal Reserve, Dan Tarullo served in senior roles in the Obama and Clinton administrations dealing with international economics and trade. I recently asked him whether there were areas of economic regulation that might not be all that different under a Biden administration.
Trade and China, and of course, those two things are related for sure. Now, I would expect that a Biden administration will be substantially less belligerent in its rhetoric. Firmness rather than belligerence is probably what you would get. And I also expect that some of the things that the Trump administration did on trade, such as declaring that Canada presents a national security risk, might not be sustained. But in general, I think that the center of gravity on both China policy and on trade has shifted in the United States perceptibly in the last 10 years. And that's coming from both the left and the right. So obviously the new administration and its appointees will have to work out exactly how to walk down those paths. But there, I think, when we talk in 4 years, I think we'll probably identify those two areas as ones in which you could see more continuity in policy rather than less.
One of the things I think we saw in the Trump administration was the bringing together of trade as an economic matter, a matter of international economics, and national security. And it was always there, but it really got brought together on some of the decisions made by the Trump administration. Is that here to stay?
To some degree, I think it probably is. But whenever I listen to a paper presentation on some part of China policy and the like, I'm always trying to think: does the author regard China as an economic rival, kind of like we regarded Japan 20, 30 years ago, a mixed geopolitical competitor and an economic rival, or third possibility is fundamentally as a geopolitical threat and rival that needs to be countered. I don't think you can analogize to the Soviet Union situation just because China is so much bigger an actor in the economy. And the United States and China do have some shared interests on climate change for sure. One that people don't recognize is financial regulation, where China was usually a supporter of tougher regulation in international fora. So any administration has got to work through how they're going to both deal with the perception that China is more of a rival than maybe some people 10, 15 years ago thought, while at the same time maintaining those channels of cooperation. And this is, again, to use my 3 C's, this is where competence, coordination, and consistency are going to be especially important.
Coordination is something that candidate Biden has really emphasized. We expect it from President-elect Biden as well, particularly multilateral cooperation when it comes to trade, having to do with China specifically. At the same time, in your experience, can multilateral institutions really shape China's behavior? Some people question whether admitting to the WTO had the effects that were hoped for.
Well, it certainly didn't have the effects that were hoped for. There were discussions of that at the time, what was the best way to try to ease China's integration into the WTO system. I don't know, David, how robust or how effective international institutions can be. But I do think that the president-elect's commitment to working with allies and with other like-minded countries that also confront issues related to China's economic policies, that is where they could probably get some considerable amount of traction. Now, one little caution there. Sometimes other countries who share the U.S. interests think it's kind of a good idea to have the U.S. out there leading the struggle while they can sit behind waiting to see whether they get some good outcomes that they then say would like to share in. But that's where experience matters. And again, we're to anticipate that a group of people appointed by Biden and the president-elect himself, his area, one of his longtime areas of specialization is foreign policy. So I would think he'd be playing a significant.
That was part of my interview with former Fed Governor Dan Tarullo. Coming up, the refrigeration challenges of distributing the Pfizer vaccine. We talk with David Gitlin. He's CEO of Carrier, the company that may have to step it up to get that job done. And a programming note now, Wall Street Week airs tonight at 6 p.m. Eastern Time. I'll be joined by Larry Summers, Steve Ratner, Afsani Beschloss, and many, many more. This is Balance of Power on Bloomberg Television and on radio. This is Balance of Power on Bloomberg Television and Radio. I'm David Weston. The world got hopeful news on Monday with reports of a vaccine candidate from Pfizer that may be over 90% effective in success. They're planning on producing maybe billions of doses for around the world, but a possible catch is the need to freeze the vaccine during transportation at a temperature of minus 70 degrees Celsius. One of the companies that could produce the special freezers necessary is Carrier Global, and we welcome now the CEO of Carrier Global. He is David Gitlin. So, David, thank you so much for being with us. Great to have you with us. Give us a sense of how big a problem this is. I mean, how much refrigeration could be required here?
Look, we're dealing with unprecedented problems that require unprecedented solutions. So clearly the Pfizer pharma that you just mentioned is at minus 70 degrees C. Almost all vaccines today that get distributed are between 2 and 8 degrees C. So clearly that's an added challenge. But if you just step back and look at the overall challenge of pharma distribution through the cold chain, you're dealing with a situation where from the time of inception till the time of administration, it needs to be kept cold, either refrigerated or deep freeze, as in the case with the Moderna and the Pfizer vaccines, either minus 20 or minus 70 degrees C. throughout that entire chain. And what you're dealing with is going from source of inception onto a van or a trailer to an airport, onto a plane, off the plane to a trailer, distribution centers, and so on. So you have multiple handoffs where you have multiple opportunities for excursion. One of the keys is going to be data and data integrity. And that's why we have formed a partnership with Amazon Web Services, AWS. So without all of those silos, aggregate all of that data in a data lake. And then once you have it there, you can start to use AI and machine learning to really be part of the solution and provide really an unprecedented solution to this significant challenge.
So no question, from what I understand, data would be critical, and how to manage that supply chain would be absolutely critical. But can you make enough of these freezers as a practical matter? Is this going to be sort of like the N95 masks where 3M had so much pressure, or the ventilators where we just didn't have enough? Can you make enough of these freezers?
Yeah, when you look at, if you parse it back, 3 of the 5 vaccines are at traditional vaccine temperatures, that 2 to 8 degrees C. And Moderna is not, when you're dealing with that minus 30 degrees C, we have deep freeze capabilities like the one that you see over my shoulder here, where we are very adept at producing minus 30 degrees C. When you get into that Pfizer solution with the minus 70 degrees C, what you're really looking at is self-contained packages with dry ice. And what they're going to be do is distributed from point of inception to point of administration through a self-contained dry ice box. What you can do is preserve the life of the vaccines in that dry ice container by 2x by putting it into a container that's kept at minus 30 degrees C. So again, with this container, this 40-foot container that we can put at minus 30 degrees C, which is mobile, you can put anywhere in the country or throughout the world. Once you put that dry ice in there, you can extend the life of that vaccine by 2x by keeping it in a broader environment that's at minus 30 degrees C.
And are you ramping up already for this eventuality? And for that matter, is this part of the Warp Speed initiative, which was really getting a vaccine distributed fast?
Yes, you look at Operation Warp Speed and the CDC taking the lead on that in the U.S., working very broadly with industry. And of course, we're working with governments around the world, but we're absolutely ramping up production. We make some of these container refrigeration units in Singapore. We're already increasing our own demand in anticipation of not only the refrigeration units, but the container units, to have them at the ready to ship point of use. You look at the challenges globally, you look at India, 1.4 billion people, where they spend a fraction on cold chain that we spend in the US. So they're going to need a lot of temporary capabilities, temporary storage locations. So we're already managing that ramp internally in anticipation of the need that's out there. I mean, David, we have 1.2 million refrigeration units out there. So we have a broad infrastructure today, but clearly there's going to be additional capacity needed.
Let's spend a minute with us, if you would, David, on something we've talked about before, which is HVAC, because it's not just the vaccine. It's also, as we all are going indoors now for the winter, a lot of us are spending a lot of time indoors. We need cleaner air, if possible, scrubbed from that COVID-19 germ of virus. So how are you on manufacturing enough HVAC? What's the demand like?
The demand's been very positive. You look at the traditional HVAC, and it used to really be all about comfort. What's happened now is we now have much more focus on healthy. So we look at filtration systems, we look at ventilation systems, but we also now look at not only healthy and comfort, we also look at productivity. We've proven that as you monitor things like CO2 levels, you can increase cognitive functionality by 2x as you lower CO2 levels and increase ventilation. So the focus on the new normal is going to be critical, because clearly I think of this as 3 phases. One is, we as a society globally, we have to work together to avoid the spread of the virus as best as we possibly can. Then you have the second phase, which is going to be about the distribution of the vaccine. The third phase will be the new normal. And we saw that with security post 9/11, where it became ubiquitous to see metal detectors at stadiums and at airports. The new normal is going to have much better indoor air quality, much better ventilation. And that's going to just become a thing of the future. And it is going to be a part of the new normal, because COVID has not been the first airborne transmitted disease, and it certainly won't be the last.
David, we are asking all global business leaders a similar question, and it's about where we go after the pandemic. It's going to take an awful lot of us working together to overcome the economic damage done by COVID-19. There is no magic bullet. We all know that. But if you had to prioritize one thing, what must global leaders do to build a stronger, greener, and more equitable global economy after the pandemic? This is something I know that you've been thinking about.
infrastructure spend, David. You know, when you look at stimulus spending and infrastructure spend, you have a lot of small and medium businesses that know they need better, healthy, safer indoor air environments, but they're going to need help from the government. And, you know, the Vice President Biden has talked about spending on 4 million buildings. You look at the greener environment, it's going to require more infrastructure spend and supporting technologies that are more climate friendly, like the ones that we have. In fact, the technology you see over my shoulder here is at a global warming potential of 1. So it only uses CO2 and not traditional refrigerants. So infrastructure spend, stimulus spending to help schools that are tight on budgets, to help restaurants, to help the hospitality industry, to help the people that really need it, and help society get back into the new normal.
David, it's always a pleasure to talk to you with you. Thank you for your time today. That's Carrier CEO David Gitlin. Coming up, the Trump administration generated a fair amount of litigation over things like Obamacare and immigration. We talk with the state attorney general in many of those cases. He is Javier Becerra of California. This is Balance of Power on Bloomberg Television and on radio.
Have been here for quite a while. They have obtained the SVF license back in 2016. They've also been granted a license for the virtual bank. They will continue to play an important role in Hong Kong.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here? It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
This is Balance of Power on Bloomberg Television and Radio. I'm David Weston. One of the hallmarks of the Trump administration is how many times it got sued by individual states objecting to what it was doing, as we saw just this week, actually, when the Supreme Court heard arguments in a challenge to the Affordable Care Act. A principal party in that case is California, represented by its Democratic Attorney General Javier Becerra. And we welcome Attorney General Becerra now back to Bloomberg. So welcome, Mr. Attorney General. Great to have you here. Let's start with that Obamacare case, because California's a named party in the case. Were you encouraged the way many were by the questioning from the bench indicating they're not going to strike the whole thing down?
So, Dave, thanks for having me. And absolutely, we were guardedly optimistic after hearing the questions and the comments from the justices. At the end of the day, they're human. They recognize that lives are at stake with regard to the Affordable Care Act. If you strip it away, and if you do it based on this one provision dealing with what's called the individual mandate, if you use that one little entry point to try to say that the entire law is infected and must go, you're going to hit millions of Americans who probably wouldn't be alive today without the Affordable Care Act, millions of Americans who lost their jobs and with that their health insurance, who today have coverage because of the Affordable Care Act.
Affordable care is not the only issue between a number of states, including yours, and the federal government under President Trump. You've sued him a fair number of times. I will say you've won a fair number of times. When President Biden takes office, January 20, do those lawsuits go away involving things like Dreamers, involving immigration, all that range of issues?
So 106 times the state of California has caught Donald Trump red-handed breaking the law, and we've had to sue him. Unfortunately, not all of those lawsuits will go away simply because you have a change in administration, but many of them can be resolved fairly quickly, some not as quickly. Some have other parties in the action, so it's not just the federal government and the state coming to terms. You need to make sure that it's resolved completely. So fortunately, some will. Others, we're going to keep at it.
Are there some actions that the Trump administration has taken that basically the Biden administration cannot simply wave a magic wand and make go away? I mean, for example, notice and comment rulemaking, you can't just make it go away because you don't like it. You have to go through it again, as I understand it. So are some things that may well last into a Biden administration?
Well, and here, David, the important point is the Biden administration can't behave the way the Trump administration did. The Trump administration was sloppy and impatient in trying to make changes to law. And that's why they lost so many times to the state of California. The Biden administration can try to reverse course and take us back to the future again in some of the policies, but they still have to go through the rules. They have to follow procedures. And so if they try to do it in a way that would be like the Trump administration, sloppy and impatient, they're going to have the same problem. So I have a feeling that this new president coming in, Joe Biden, understands these things, and he'll have a team that does them right.
Do you have hopes for the Dreamers at this point? Something that they tried to do a deal with under President Trump, couldn't get there. And would you favor something that actually took care of the Dreamers at the same time, had something like E-Verify included in it?
So, David, what I'm about to say probably has the support and concurrence of about 85–90% of Americans, and that is that the Dreamers are home. This is their home. This will be their permanent home. It's just a matter of the politics finally catching up to the sentiment of the public and the reality of where we are. So we need to get a change in the law to make their permanency, safe without the anxiety. We in California, we sued. We won against the Trump administration. The program is still in place, the DACA program, but we need a change in the law. That requires Congress and the president. Joe Biden has said that within his first 100 days, he's going to propose a fix to our broken immigration. I think Joe Biden knows exactly how to get that bipartisan support.
One of the things that has been percolating has been antitrust and big tech. And I don't want to talk about the lawsuit that's been filed. That's under sub judice, as they say, so we can't talk about that. But more broadly, do you think that the Biden administration would be open to some sort of curtailing or regulating of big tech?
Without a doubt, I think all of us are looking closer. At the end of the day, we all want competition, right? But here's the thing, that competition is essential if you want innovation. If you want to spur an economy, and California is all about spurring its economy, that's how we became the economic engine for the country, you need innovation. And so you cannot stifle innovation. But what you don't want is, under the guise of innovation, that you have these behemoths who are born and just take over everything. And so what we want to do is make sure that we continue to see the tech industry just really blossom in the United States. But at the same time, it's blossoming because there's competition driving that innovation. And so AGs have taken the lead in saying, we want to see innovation, but we need to see the competition that really brings that innovation.
One of the issues that has really divided the states in the Trump administration was auto emissions, and particularly California, where essentially, as I understand it, the Trump administration said, you can't have your own rules in California. It's got to be our rules nationwide. What happens to that now under a Biden administration?
Well, let me frame it this way, David. This is 2020, not 1920. That's what this fight is all about. Clean car standards. It's not something unachievable. It's not some kind of Jetson kind of car mentality that you can't go there with our vehicles. We've proven, not just in California, the nation, that you can produce cleaner burning cars that are safe and people want to buy. And the Trump administration took the 1920 approach, saying, no, we got to go back to the old days where they can let them pollute so they can sell them. No. So my sense is, with the Biden administration, we're going to move forward. But again, you got to do it the right way. And we'll get back into the 21st century. You got to go in this direction. For California, it's not a choice. It's a necessity. We cannot afford to pollute our air more than it already is.
If I can put it this way, you've played a fair amount of defense over the last 4 years. Let's go over to offense. If you have a Biden administration that wants to work with you on some things to do, what would you like to work affirmatively with the federal government on?
Well, I think we just touched on one, and that is moving fast and aggressively when it comes to climate change. We have lost 4 years, and Mother Nature doesn't wait. And so we have to catch up because it is time. And California has proved these wildfires that we're experiencing in California, that is not normal. The floods that the South is experiencing, not normal. Hurricanes where you run out of letters in the alphabet to name all the hurricanes in the East Coast, that's not normal. And these super tornadoes in the Midwest, none of that's normal. Got to tackle climate change. Secondly, it's time we settled this immigration issue so that we know who really has a right to be in the country, who doesn't. Let's have an orderly process, not a mean process. You need to have carrots and you need to have sticks, but Donald Trump was using not sticks. He was using bludgeoning hammers, and that's just not the way you do it. The other thing I'd say is criminal justice reform. I think we all have a sense that we need to do something. The system isn't as broken as some would like us to think, but there are bad apples, and there is some embedded bias, and we need to deal with that. I believe Joe Biden is ready for this. The level of experience he has and the commitment he demonstrated in the campaign, I think a President Joe Biden is going to really launch this country.
So I'm struck by the fact that you're lacking a senator come January 20, because we're going to have Kamala Harris as now the Vice President of the United States. There's a seat open there. Do you have any thoughts on who might fill that? And could they be named Becerra by any chance?
Yeah. Well, first, you got to name Harris. Kamala Harris has done a phenomenal job, not just for the state of California, but now she's going to show just for this country. And I think for those of us from California, we're just tickled and proud that she is now going to be at the center stage as the dynamic duo for the country with Joe Biden. And so we wish Kamala Harris nothing but the best because she can give us the best. And in terms of that Senate seat, the interesting thing here, David, is that California has a lot of very talented people. Governor Newsom's got a tough decision. It's his call completely. Where he goes, I think we're all going to be really happy. Gavin Newsom breaks ground. Gavin Newsom takes California further into the 21st century. So I think we're all going to be very happy wherever he goes.
Really enjoy talking to you every time you're on. Thank you so much to Javier Becerra. He is California Attorney General. Coming up, Balance of Power continues on Bloomberg Radio. In our second hour, we'll talk with George Magnus, an associate at Oxford University's China Center, about the developments overnight, actually, in U.S.-China relations. This is Balance of Power on Bloomberg Television and on radio.
It came in better than expected, not only in terms of job creation, but also a sharp fall in the unemployment rate consistent with higher labor force participation. That's really good news.
Overall, the gain was solid, but even while this is a very robust pace of job gains, it's a lot slower than it has been in the summer months.
Great that we saw the job gains we did, but they still are diminished from what they were, of course, back in April and May. And the scarring, the sort of wounds that were created by COVID are beginning to fester.
I would caution people to look at the top line number because I don't think it tells the entire story. Employment relative to population is still well below where we were pre-crisis, and that's because I think that we're going to have some lasting damage.
Depending on what you look at, jobs creation or the unemployment rate, you have different views as to whether the improvement in the labor force is keeping up or slowing down.
From the City of London for our audience worldwide, Bloomberg Real Yield starts right now. We begin with the big issue, markets grappling with near-term risk and long-term hopes.
Investors have yet to decide which narrative they are going to go with.
The setup for 2021 is quite positive.
But I think there's a lot to get through first.
Over the very near term is a lot of choppiness.
Honestly, the virus is really raging out of control.
There is a lot of uncertainty around the profit outlook for markets.
The resurgence of the virus.
People are going to be talking about nothing but the misery that COVID is inflicting upon us.
Volatility will still stay high for the weeks to come.
When you look toward next year,
we could see the economy doing much better by the end of 2021.
2021, we will see an acceleration in growth.
We will go into 2021 with more optimism.
We had a big kind of euphoric rally.
We saw credit spreads really come in a lot.
Even then, we were taking some chips off the table.
Basically, this tug of war.
Do you look at the near-term challenges or do you look at 2021?
I've been looking to this conversation, looking forward to it over the last couple of days, and I'm pleased to say that Gershon Distenfeld, with his mask on from AllianceBernstein, good practice for social distancing. Not in this environment, though, Gershon. You can take it off for the interview. He joins us right now. Gershon, it's great to catch up, sir. The short-term risk versus the long-term risk. That's part of the big conversation at the moment. And one thing you've said, Gershon, that I think is really important is that you can't draw a hard distinction between the short-term and the long term, that the short term can actually shape the long term. Can you walk me through your thinking at the moment?
Absolutely, John. But I just want to tell you, the mask it's not what you think. It's not that I lost a bet. It's a plea for you to come home, John. You don't belong in the UK.
I'll come home soon.
Just because we don't know how to run elections here doesn't mean you can't come home. I mean, you guys might have voted for Brexit over there, but you not exactly know what you're doing over there. So please, John,
I don't think you want me to weigh in on the election right now. I don't think you need the view from London, Gershon. I'll come home soon. Don't worry about that. Can we get to business and start with the question?
Absolutely, John. Yeah, so look, I think it's very important to really separate out the long term from the short term. The short term, we got great news this week on the virus. That's obviously great news. It remains to be seen some of the details. But remember, the vaccine. I think I said the virus. The vaccine itself, though, doesn't put anyone back to work today. We're still going to need fiscal support here. The monetary authorities the Fed's done everything they're supposed to do and then some. We're going to need more fiscal support in the short term. But even if we get the vaccine and everything is rosy, we have to remember there's a longer term picture here. We've been in this kind of rut for a decade plus now of low growth, low inflation. And in order to get out of that rut, we're going to need the fiscal authorities, fiscal stimulus to play a big role in that over the next few years. And divided government is unlikely going to provide that. I know that the conventional wisdom is that divided government is good, but when you need government to actually help you get the economy back on track, it's not necessarily so good.
So, Gershon, this is really important because we came into this crisis, this pandemic, with quite low trend growth. There was a hope that the Trump administration could get us out of that. Are you essentially saying that even if we do have a vaccine in the long term, the decisions made now and the decisions that we stick to through the medium term into next year could basically end up where we were last time, which is low trend growth, low inflation, a huge monetary policy regime, but same as before?
I think that's very possible. Look, one of the things, whether you like or dislike what the Trump administration did, he did a lot of the things he said he was going to do. The one thing he didn't do was spend a lot on infrastructure. And I think that's going to be key going forward. Certainly, I think the Biden administration is going to be willing to do that. The question is is the Republican Senate, assuming that they do hold at least one of the 2 seats in Georgia, and a Congress that is certainly, while still being controlled by the Democrats, is going to be much weakened. Are they going to go along with it? Are the Republicans going to find kind of newfound religion, quote unquote, in terms of spending and deficits? I think the bet you would make is they will. And, are they going to have the ability to do what they need to do to help the economy going? And I think you have to bet against that at this point.
Well, Gershon, let's talk about markets then. This is the framework for thinking about the world right now, your framework at least. Let's talk about high yield, an area of fixed income that typically you're quite constructive on. I want to start with price. You could look at absolute yield near the lows we haven't seen for a long time, if ever, or you can look at the spread and you could say we've got 100 basis points still to go before we get to the tights of the year. What's the best way of approaching that right now as an investor, Gershon?
Well, I think the positive way of looking at it is you can compare it to what happened when Europe got to these kind of yield levels. And there, you still had a long way to go in terms of price appreciation because spreads went a lot tighter and the underlying yields kept on going lower. That's unlikely to happen in the United States, right? The Fed has been pretty clear that they're not going to go negative interest rates. You have a huge, money market here, so to speak. The Fed has been very clear they're going to keep on doing more QE, yield curve control, more forward guidance before they go negative rates. So it's unlikely you're going to get the same kind of outcome you had in Europe over here. So I think yield does become much more important here in the United States. And you look at that kind of closing in on a 4.5% yield. Remember, in order to get what I would call a clean portfolio, where you don't buy the kinds of things that are trading at levels, they might have a 15% yield on it. But you don't really believe it because they're probably going to have to restructure. You're looking at a yield of closer to 4%. So it's priced kind of for perfection. And we believe that for investors that need yield, they need income, there are better alternatives today to U.S. high yield.
So I know one of those alternatives is EM. I just want to sit on high yield just for a further question if I can. Gershon, many people believe that this credit market is really insulated in the United States because of the role of the Federal Reserve. Do you just not like the yield for the risk you'd have to assume in the United States? Or are you worried about spreads gapping wider, even with the Fed having a presence in the credit market in the United States?
Well, I think it's always hard to, I'm always reluctant to answer getting paid for the risk because that means different things to different people. I mean, in fixed income, it isn't like other markets. If you are a long-term holder, let's say you had this magic, yields are at 4.5% today. Really, they should be at 6%. As long as you don't have massive defaults, it just means you're going to earn less than you would have otherwise. It doesn't mean you're going to lose your shirt. That being said, I do think that you are, as I said, priced for perfection today. You're not priced for a lot of bad things to happen. On the other hand, though, it is important to note that unlike the equity markets where, multiples would suggest that you need to have a decent amount of growth in order to justify the valuations of today, the credit markets are somewhat bifurcated. You do have your companies that, quite frankly, it was the E&P space, the retail space, they were going to be in trouble and probably have to restructure, even if we never had COVID happen. And on the other side, most companies have had years of ample liquidity, access to low rates, have been able to term out their maturities, so they're going to be okay. So I don't think there's a disaster coming down the road. I don't think we're going to have massive defaults above what we already on hand. We all affection. There isn't a lot of upside here either.
Gershon, just a final question for me then on diversifying. You've made the push to say diversify by going abroad and don't be afraid by emerging markets. Walk me through the thinking around EM right now. It's something that comes up a lot in conversations I have, that people want to diversify by going abroad. And it's something different, that they're worried about the risks in the United States and more interested, more compelled by the opportunity in emerging markets.
Yeah, John, I think that there's some things that are misunderstood about emerging markets. People are citing the high defaults this year in emerging markets. You look at Argentina, Lebanon, and Ecuador. It's important to remember those were all headed for a restructuring sometime in 2021. It just got moved up from the COVID crisis. You don't have a lot of problem areas elsewhere, so we're not expecting a lot of defaults there. You think about lockdowns have been much less severe in most emerging economies. A vaccine actually should be more positive for most emerging economies that are reliant much more on tourism. So a lot of good things, to the extent we do get growth, a rising tide lifts all boats, a lot of good things going on in emerging markets, and there's a lot more yield there. So one has to be very, very careful. I wouldn't just say, just go buy blindly every emerging market economy. There's certainly corporates that are interesting in some areas of the world, but in general, we are finding more value in emerging markets than we are in kind of domestic corporate high yield.
Gershon, great to catch up. We'll have to continue the conversation, particularly on the currency exposure as well. Stay safe, wear a mask. I know you will. Great to see you, sir. Thank you. Time now for the final spread. The week ahead coming up. Another 5 days jam-packed with Fed speak. Vice Chairman Richard Clarida kicking things off on Monday, followed by Presidents Bostic, Daly, Rosengren, Kaplan, Williams, Bullard and George, all speaking throughout the week. Plus the data point of the week, retail sales coming on Tuesday. And finally, another round of jobless claims on Thursday. That does it for us. We'll see you next Friday at 1 p.m. New York time. That's 6 p.m. in London. For all of you at home, our audience worldwide, you stay safe too. This was Bloomberg Real Yield. This is Bloomberg TV.
또 다른 프리미엄의 시작. 느껴보지 못한 가벼움. 생각하지 못한 견고함. 경험해보지 못한 지속성. 프리미엄 그 이상. 레노버 요가 카본.
Welcome to Bloomberg Markets. I'm Bonnie Quinn. In moments, Mark Lasry, Chairman, CEO and co-founder of Avenue Capital Group, his thoughts on the election, the credit markets and, of course, the NBA. And later this hour, the man representing 46,000 Disney employees, President of the Services Trade Council Union, Matt Hollis, joins. First, let's get a quick look at the markets now. We are Friday the 13th and we're midway through the session, of course, more than midway, in fact. We're seeing the S&P 500 now up a full percentage point. The 10-year yield down to 89 basis points to finish off the week. The VIX below 24 again and the dollar index below 93. So, Biden, bankruptcies and the bucks. Let's get straight to somebody who can answer all of our questions on all of these topics. Mark Lasry is Chairman, CEO and co-founder of Avenue Capital Group with $9.9 billion in assets under management at this point. So, Mark, I know that your thinking was that the economy was fundamentally sound some time back. Is that still your thinking, and for how long can that remain the case?
I think it is. I mean, I don't think, I think there's parts of the economy that are doing really well and there's parts that aren't. The parts that aren't are really on the leisure side. But there's going to be another stimulus bill. I think if it had been a Democratic Senate, it would have been somewhere around sort of $2 to $3 trillion. I think with the Republican Senate, it'll be somewhere around 1 to 2 trillion. So I think for the U.S. economy, everything is good right now.
You mentioned the Senate. Obviously, you've been a Biden mega donor. You were a Harris supporter before she dropped out originally. What happens in Georgia? I mean, for Wall Street, it would probably be good if it stayed red, but would there be any attempt to, fund at least some of the effort in Georgia between now and then to perhaps overturn those seats?
Yeah, look, I think it'll be what it is. I mean, I think Democrats are going to spend a huge amount of money to try to win those 2 seats. I think Republicans will. And at the end of the day, it's going to be the Georgia voters. So I think what you'll probably find is it'll be one of each, Democrat and a Republican. So it'll be a closed Senate. But at the end of the day, I think what will end up happening is it seems that Wall Street would rather have a bit of a divided government as opposed to a government which is all Democratic.
So what would that mean, for example, for Biden's tax plans, and specifically things like capital gains and dividends? Would they get enacted? Would Wall Street see a hit there?
I don't know. I mean, I think it's, part of it is really, if you have a Republican Senate, I think that's going to be hard. And I think at the end of the day, taxes will probably go up a little bit. And it's going to be a question of sort of what's the deal that Biden and McConnell will be able to cut. But I think it'll end up being, you'll see taxes go up, maybe just not as much as people had thought before.
So some kind of a brokered plan, you think? So we won't see the same taxes?
So. Yeah, I think so. I think it'll go up a little bit. I mean, our deficit is going up. So I think ultimately at the end of the day, the government's going to need some more revenue. So I think people will end up doing what makes the most economic sense, but you're going to need to have a little bit of higher taxes because we have borrowed a huge amount of money and those dollars are still continuing to grow.
Mark, what would your preference or Wall Street's preference be, that they be extra payroll taxes or that there would be extra taxes across the board?
I think probably payroll, but I haven't looked at any of the plans. So I'd have to really do some work on it. I just think you're going to need extra revenue. The benefit for the U.S. government today is that rates are very low. I think as you stated earlier, I think rates right now are around, the 10 years around 89 bips. Hopefully that stays there. But I mean, if it starts moving up, the cost of servicing this debt is going to keep on growing. So I think right now we have an opportunity where rates are low to try to pay off some of that debt.
Let's talk a little bit about the pandemic and the markets. So the vaccine rollout, does it come in time to save some of these companies that are desperately holding on, or will we see a wave of bankruptcies?
I think what you're going to see is a wave of lending. And the reason for that is really what Wall Street was worried about was nobody knew how long everything was going to take. So if you thought about it, people could say if you were optimistic, it was 6 months. If you were pessimistic, it was 2 to 3 years. Now, I think if you're optimistic, it's 3 months. And if you're pessimistic, it's a year. So ultimately, really what that means is you're going to be more willing to lend money to companies because things will be working out sooner. So there's just going to be a cost to that. You'll have some companies that will be filing, but the opportunity to do rescue lending and to lend money, that's going to grow exponentially over the course of the next year.
Now, Mark, early on in the pandemic, you invested in, companies like Macy's, for example, bankrupt companies like Frontier Communications, which says now it's going to come out of bankruptcy next year. You also had JCPenney, Intelsat, Diamond Offshore. What have been the changes to your positions that you can tell us about?
Well, I think on Frontier, those bonds have gone from 30 to 45, so they've gone up about 50%. So we've tried to keep the same percentage, but because of the price of how high they've gone, we've had to sell a bunch of the bonds. And I would say, Macy's, we've continued our position. Diamond Offshore, we've increased our position. So I think for the majority of all the positions that we had, Revlon would be another one. Over the course of the last 3 to 6 months, things have been working out. So we've been taking some profits and investing in new situations.
Yeah, new situations. Oh, do tell.
I'd rather wait if that's okay, just simply because we're trying to build positions there. So I apologize, but happy to do it next time when we're.
I know you were looking at AMC Entertainment last time. Do theaters survive in some form, and when do we see them with audiences?
I think they absolutely do survive. I think people are going to go back to movies. I think that's actually a pretty good situation. If you take a look at it, you're creating that company around sort of a 2 or 3 multiple. So, unless you're going to tell me that people don't go back to movies, they will. And, they may not, you may not have the same number who went back, but it's still going to be a pretty good amount of people. So I think AMC and a bunch of the theater companies will survive and actually will be doing fine.
And airlines?
Airlines, we're continuing to invest. I mean, I think that has been, for us, we were a big believer that people were going to fly back again over the course of the next couple of years. I think that amount of time has gotten reduced. So I think on the airline side, you're going to see that come this summer, as more people have gotten the vaccine, that things will start getting back to normal, at least by this summer.
Mark, you mentioned there that you had to sell off some of your positions because things got so expensive. I mean, they did across the board, right? Post-Fed and then post-stimulus, and there were a few little catalysts. Where is the opportunity now that, that you see? Is anything cheap anymore? And what's the pandemic discount?
So things are still cheap. I mean, they are. There's a lot of specialty lending. I mean, we just did a deal literally about, I think we closed on it about a week ago in the UK, where we're investing around sort of a 14-15% return, where you're lending money, and you're lending money anywhere between, I would tell you, 10 to 15%. And the reason you're doing that is because people need that capital. So you're going to see an increase in that, in those specialty lending. You're still going to find special situations. There's this belief that because things are working out and because of the vaccine that everything is back to normal. It isn't. I mean, it's getting back to normal, but you still have hundreds of billions of dollars of opportunities out there on the leisure side, on the energy side, and on special situations.
Hospitality?
Hospitality is another one, absolutely.
All right, we have to talk about the NBA. The league has obviously suffered, something like 10% lower revenue, which actually is good when you think about the amount of expenses that you had to put into the bubble and, all of the revenue lost. Can it survive another year of bubble, lost revenue, and, how do you manage that?
I think it can. I mean, I think when we look at it, the really hard part is, and I think it's for all sports teams, that ultimately at the end of the day, you do need fans, right? Players want to play in front of fans. People want to go to games. So I think for us, we'll start the season December 22nd, and then we're going to work with the local authorities. And, really the focus is going to be the health and safety of the players, but of the employees at the arena and of the fans. So the question is going to be, how many fans can we let in the beginning? And then ultimately, as the vaccine takes effect, the question is, how long does it take to get things back to normal? It'll definitely be back to normal by next season, by the following season. I think for this year, I think you're just going to see that starting January, February, March, April, May, June, each month you'll be able to have more and more fans. So I think it's going to be slow, but it'll get back to normal.
Can you do it without having to make major adjustments to the league's salary structure? Or do you have plans to talk about that with the rest of the league?
Well, it's actually pretty simple. I mean, we're partners with the players. So at the end of the day, the players end up having 50% of our revenue. So if our revenue is down 10%, players will get paid about 10% less, right? If it's down 40%, then it's 40% less, right? So it's a partnership, and the goal is that obviously what we'd like to do is have the revenue be as low as possible, which is exactly what the players want. So I think we're all aligned to try to do what's best for the league and for our fans.
So Giannis has been tweeting in the last day or two, a lot of speculation as to where he is in the last few hours. He might be in Sweden, he might be somewhere else, maybe you know.
Right.
What happens with him, Mark? What have you offered him?
I haven't offered him anything. What I do offer him is my love. But ultimately, at the end of the day, I think it's November. I'd have to go back and check, but it's either November 18th or the 20th, where we can start talking to players. And as soon as we're able to do that, he's going to be the first one. I think it's whatever it is at midnight. At midnight and 1 second, we'll be speaking to Giannis to try to get everything done.
Would you be okay if he went somewhere else? Would Russell Westbrook be somebody that you'd be interested in as a sort of maybe a consolation prize?
No, not at all. I wouldn't be okay. I don't think I'd be okay at all. I love Giannis. I think he's an exceptional individual. He has been the most valuable player on our team, but not only in our team, but in the league. So I think for us, especially for the Bucks, we're going to need Giannis, and hopefully things will work themselves out.
Your thoughts on them? I have to ask on the Miami Marlins hiring Kim Ng to be the general manager today. Obviously, you yourselves are very progressive that way, and you do have assistant GMs that are female and so on. But it is a big day, right, for the major leagues?
I think it's a great day. I think it's absolutely fabulous. It's always hard to be the first person. So I want to congratulate her, but I think what we're going to find over the course of the next couple of years is she's not going to be the only person. I think there's a lot of exceptionally talented women. So sooner or later, you're going to find that within the NBA, within football, and everywhere else, you're going to find that that's not going to be the exception. It should start becoming the norm.
Speaking of the NBA, Steve Cohen obviously just buying the Mets. I'm sure he'd really appreciate some advice from you, Mark. Do you have any for him?
Sure. My advice to Steve would be, do what you think is right. That he's been a huge fan of the Mets. I'm sure he's been thinking of the things he could do. What I would tell you is that leadership matters. It matters on the field. It matters as an owner. And try to always do the right thing, and don't let money be an issue.
I like that last bit. All right, spend the bucks and get the players, right? Mark Lazary, thank you. We have to leave it there. Much appreciate your time. Mark Lazary, Avenue Capital Group, co-founder, chairman and CEO there. Coming up, we're going to be speaking China. We're also going to be speaking with the man responsible for 46,000 Disney workers, the head of that union. And Ken Frankel there joining us from the Canadian Council for the Americas. This is Bloomberg.
We love the new apartment.
The natural light is amazing.
Every era presents its own unique set of challenges and opportunities. Trade CME Group futures with Interactive Brokers at low cost and seize the moment. Start investing today at interactivebrokers.com.hk.
is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
I'm Ed Ludlow. Let's get to the first word news this afternoon. President Trump's lawyers have ended their efforts to dispute some election results. In Arizona, the campaign has dropped a lawsuit alleging widespread irregularities with voting machines 1 day after a hearing revealed that fewer than 200 ballots were affected. Major media outlets have called Arizona for President-elect Joe Biden, who leads Trump by more than 11,000 votes in the state. More than 130 Secret Service officers who help protect the White House and the president when he travels have tested positive for the coronavirus or had close contact with infected co-workers. That's according to the Washington Post, which says the outbreak is believed to be partly linked to a series of campaign rallies that President Trump held in the weeks before the election. Several Trump campaign allies and White House officials have fallen ill in the wake of campaign events where many attendees did not wear masks. Microsoft says state-backed Russian and North Korean hackers have been trying to steal valuable data from leading pharmaceutical companies and vaccine researchers. The software giant says most of the attacks have been unsuccessful. But Microsoft didn't say how many did succeed or how serious the breaches were. The US government said in July that Chinese state-backed hackers have also been targeting vaccine makers. And parents in New York City are being told to prepare for schools to end in-person learning as soon as Monday. Mayor Bill de Blasio has said schools would go fully remote if the COVID test rate hit 3%. The positivity rate for the past 7 days is 2.83%. De Blasio tells WNCY parents should have a plan for the rest of the month of November. New York City schools began reopening in September when a blend of remote and in-class education. Most parents opted to keep their kids at home. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ed Ludlow. This is Bloomberg.
Live from Toronto, I'm Amanda Lang. Welcome to Bloomberg Markets.
And from Bloomberg World Headquarters in New York, I'm Vonnie Quinn. We're now joined by both our Bloomberg and our BNN Bloomberg audiences. And here are the top stories we're following from around the world. World leaders congratulating Joe Biden. China is the latest to acknowledge the president-elect. One holdout, Mexico's López Obrador. We'll discuss the future of U.S. relations with Latin America with Ken Frankel, president of the Canadian Council for the Americas. Plus, we'll speak with Matt Hollis, president of the Service Trades Council Union. Among others, he represents 43,000 Disney workers. We'll discuss the company's plan to cut jobs and what exactly can be done to help those workers. And dashing to public markets, we'll take a look at DoorDash's IPO filing and break down Palantir's first earnings since hitting the public markets. Amanda.
And Vonnie, we are seeing markets moving higher today. That S&P 500 closer to the highs of the session than the lows, just off the high, in fact. And we are seeing energy as the group that is really powering us higher. Tech doing okay today in positive territory, but not the real powerhouse of this market today. So one of those days when you're seeing, although they're still buying for the tech space, we're seeing a bit of rotation into other names that didn't get this market where we are today. Real estate, industrials, both strong. You can see in Toronto we're also moving higher, although we note that here energy isn't playing a big role. Materials is still strong as we see gold stocks still very much in favor. Interesting as investors make their bets amid rising cases of COVID-19, worrisome signs like New York schools shutting down, new restrictions imposed in big cities right across North America. Meanwhile, of course, markets still digesting President-elect Joe Biden and world leaders congratulating him. He's heard from many of them. Some notable exceptions. China belatedly did send salutations, but we have yet to hear, as Vonnie mentioned, from Mexico's López Obrador, the very important relationship, of course, and one that is a gateway to a pretty important series of relationships right across Latin America. Ken Frankel is with us now. He is president for the Canadian Council for the Americas. And Ken, great to have you with us. And I want to start just right there. Let's start with that Mexican relationship. There are a bunch of really important ones, obviously, and they'll have different views of a Biden presidency. But what does the silence from Mexico signify?
Well, first of all, hi, Amanda, and hi, Vonnie. It's great to be back on with you.
Let me just, before I answer that question, Amanda, add to that the list of maybe ignominy is Brazil. As far as I know, Jair Bolsonaro, the president of Brazil, has also not sent his congratulations to President-elect Biden. And so that's another major country that we need to talk about. Look, the feeling has been all along that López Obrador might be a lot more comfortable with the Trump administration than the Biden administration. There are those who dispute it, but certainly the trip that AMLO made up last May to the White House and praising President Trump, even though President Trump's words and actions against Mexico would seem to have prohibited any support from a Mexican president. There's always the feeling that, well, what does he really want out of it? My feeling all along is he actually supports Trump, would rather have Trump win because Trump doesn't really care about Mexico. And Biden does. And Biden is the kind of person, and has been through his political career, as certainly he was as vice president, who would get involved in some of the domestic affairs of what's going on in the countries, like Mexico's environmental policy and its increasingly dirty grid, its human rights policy, corruption. Those are things Trump wouldn't care about, wouldn't say anything to, but Joe Biden would. And so, I think that could be, I think that's a, might account for some of what you're seeing coming out of Mexico now.
Right, and obviously, trade is going to be a huge issue with China, but obviously with Mexico too, Ken, and coronavirus. I mean, there's so many things just over the next 6 months alone that both leaders will have to handle and cooperate on. When do you think they'll meet first?
I'm sorry, did you say when do I think they will meet?
Yeah.
Well, I think traditionally the first meeting would be between the president-elect and the Canadian Prime Minister, if I'm not mistaken. That had been a tradition for a while. I think Trump broke it. But I would think that President-elect Biden would want to meet López Obrador as soon as possible. It's pretty hard to meet with somebody who won't recognize the legitimacy of your victory. So I guess that's going to be a little bit of a waiting game to see how that relationship evolves. But the countries need each other very, very much. So obviously, they will meet, and obviously they will develop a relationship. And there certainly will be, below the presidential level, through the many, many, many ties that the governments have in interagency entanglement. So those meetings will come around, and a relationship will be developed. The question is, with what emphasis and with what rough patches to follow.
You mentioned Brazil's Bolsonaro. Brazil, obviously, important not just to the U.S., but there's also the China factor right across Latin America. What's the significance? What can and should Biden do about Bolsonaro?
Yeah. Look, there is a legitimate argument to be made that without Trump coming to power, and sort of the implicit imprimatur for that kind of political behavior and populism, that Bolsonaro may not have ever won the election in Brazil. Be that as it may, wasn't terribly complicated between Trump and Bolsonaro. Bolsonaro was fawned over Donald Trump, and Donald Trump gave him the imprimatur to do what he wanted. And as I mentioned, in the same case in Mexico, Bolsonaro can do what he wants with the Amazon. He can do pretty much anything, say what he wants about the people or minorities in his country, et cetera, et cetera. And Trump doesn't care, right? In fact, probably cheers it on. I mean, there were a strong, warm relationship, but that's not the case anymore, right? And so it's clear that they have to work out a relationship. It's clear that they will. The problem, Bolsonaro hasn't recognized Trump yet, and part of it is because he's whipped up his base also, that they basically bought into the whole, Trump narrative of politics and even on the election. So now Bolsonaro, to a certain extent, has to walk back a little bit against what his base has been whipped up into thinking, because he realizes there needs to be a relationship that needs to be developed. The question there, of course, is like Biden's policy throughout Latin America. While there are going to be themes that are going to be heard throughout: democracy, climate change, human rights, good governance, corruption. You could go down the list. In certain cases, it's going to be immigration, particularly Mexico and the Northern Triangle. The emphasis on each country is going to be different, right? So the first conversation with Bolsonaro, I imagine, is going to be on climate change in the Amazon. That the environment will be a conversation with other presidents as well. But in many parts of Latin America, they have been pursuing sound or trying to pursue sound environmental and climate policy. So I think it'll depend. The emphasis will depend on the country with whom he's dealing.
Ken, thank you. I have to leave it there, but looking forward to having you on again soon. Ken Frankel is president of the Canadian Council for the Americas. Coming up, not so much the happiest place on earth these days as the pandemic continues to hurt Disney's parks. It leaves cast members without job security. We'll speak to the Services Trades Council Union President, Matt Hollis. That's next. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Give you a sense of the real-time action. The 10-year yield tumbling now 11 basis points. So continuing in this knee-jerk risk-off feel.
This is Bloomberg Markets. I'm Bonnie Quinn in New York alongside Amanda Lang in Toronto. The pandemic has left Disney's parks division in a dark place, but CEO Bob Chapek still has hope.
Despite the many challenges and hardships, I'm proud to say we have been steadfast in effectively managing our businesses under enormously difficult circumstances. We haven't just persevered during these tough times, we've also taken a number of deliberate steps and smart risks that have positioned our company for greater long-term growth.
From the earnings call last evening, meanwhile, Disney announced it plans on cutting 28,000 jobs in its parks division in California and Florida, leaving employees feeling decidedly less optimistic. Joining us now is Matt Hollis, president of the Services Trade Council Union that represents 43,000 Disney World workers. Matt, it's a difficult time for everybody. It's not that Disney wants to let go people either, right? It's that it's being forced to do so. Give us an update on what the situation is now for employees of all types, from cast members to restaurant employees and so on, in the Orlando region and beyond.
Well, first of all, thank you for having me and for the opportunity to be able to comment today. You know, times are tough, that's for sure. When you look at the landscape of Central Florida, there's no question Disney World leads the way in the tourism industry there. And with Disney having to take such huge step backs and really drastic cuts that are being taken, it is impacting the entire region. And like I say, Disney leads the way there. And so the cast members that have found themselves on furlough, a lot of them have been furloughed since remember March or April. And so times are really, really tough. And without the tourism industry in Central Florida, it's going to be tough for a little while.
And when you say furlough, that's important, Matt. I mean, part of your negotiations is that Disney does have, they have promised to rehire a great number of these workers if and when the businesses reopen. How hard was that to get as a concession, and how firm is that commitment, depending on how long this pandemic lasts?
Well, what we were able to do was to secure the recall rights for employees that would avoid what is being witnessed or seen in some of the other parks in Central Florida that don't have a union representation. And so before Disney would be hiring new hire employees, the members that we represent under the Service Trades Council, those employees would have the opportunity to be able to return to work. And so as far as the makeup of the negotiations, there's always the give and take and kind of back and forth. But Disney certainly recognizes the value that their cast members bring and the experience that they have. And so we were proud to be able to deliver that for all of the members working under our agreement.
Yeah, it's just so tough. We see awful stories about people living in motels, from very short amount of time periods, because the motels can't have people longer than 2 weeks, or eviction proceedings have to start and so on. It's so difficult. How many of your members, Matt, are really suffering, whether it be, lack of stimulus money, or the fact that they're facing eviction, or literally can't eat?
So there's still about 18,500 of the cast members that we represent that remain on furlough at this time. And so when you think of Florida, you have to understand that Florida's unemployment system was one of the worst in the country. And so shortly into the pandemic, these cast members had exhausted unemployment resources. And so that remains to be the case today for those that remain out of work. And again, back to the comments that I made earlier, the tourism industry in Central Florida is what makes up the bulk of the business there. And so it is an absolute, it really is a tragedy for thousands of workers and thousands of Floridians that are in desperate need of help and that are unable to find work. And hopefully a vaccine is rolled out, and hopefully the traveling public can pick up and the business can resume to a normal level at Disney World. But until then, there are, again, tens of thousands of workers in Central Florida that are being very drastically impacted by the current pandemic.
Mm-hmm. And of course, Matt, that is in the context of no stimulus package. So government supports that had been available to Americans, not available at the moment. Businesses that were seeking support, not getting them now. What's your message to, lawmakers are still presumably going to wrestle through something. How important is it for the folks you represent that some form of fiscal stimulus is brought around?
Well, so I would say that workers in not just Central Florida, but if you look at Florida, you could see a real impact in a very concentrated area. But you don't have to look at just Florida to see that. It's impacting literally every state in our country. And there's one thing that every state has in common right now, and that is that workers are hurting and workers need help. And we've had people that have been out of work since March and April and don't really see any relief as far as recall in sight in the near future until there is an increase in the traveling public. The union that I work for doesn't just represent Disney World workers. We have a lot of workers in other industries. For instance, the commuter railroads or Amtrak. Those industries are likewise very being impacted in a great way, and relief is needed. But it's not just relief for business. We need real, meaningful relief that finds its way into helping the working families in America that are being impacted today and for the foreseeable future.
Matt, obviously you said tourism around the Orlando and greater Orlando, Florida region, is huge. But healthcare is another thing that Orlando is very famous for. How many of the people that have been furloughed or laid off, how many of them might be able to switch industries or perhaps be mobile and move to another state for work? Is that even possible? Do they have the means?
Well, as far as the possibility of that, that's not something that I or my staff have had a lot of conversation around. As far as we are not familiar with a ton of opportunities that are presenting themselves to furloughed or laid off Disney cast members to cross state lines to find work. I suspect that there may be some instances of that, but that's not the most practical given the current economic status of these people.
All right. Not a lot of time here. We have a president-elect. He will form a cabinet. We assume Bernie Sanders has been floated as a potential labor secretary. Thoughts on the direction of this next government when it comes to labor?
Sure. So I think that it's safe to say that most all of the labor in this country is sharing an optimism that President-elect Biden will implement worker-friendly platforms and policies, and that he'll appoint worker-conscious people in positions of leadership that are directly involved with the jobs of the members that we represent every single day throughout this country. And so we're hopeful for the best, and we wish him the best as he builds that transition.
Matt Hollis, president of the Service Trades Council Union, thank you very much for being with us. Really important perspective there on the tens of thousands of workers across the U.S. Coming up next, despite, of course, volatile markets, we are seeing businesses willing to take the plunge with an IPO. After this, our stock of the hour with a closer look at one of them and some of the other names that are on the way. Stay with us.
We would love, at the right time and the right way to have a digital bank license. We would almost certainly do that in partnership with a strong local partner, and we would use the technology and the experience that we've gained from Mox in Hong Kong.
Well, it's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Welcome back. I'm Amanda Lang in Toronto alongside Vonnie Quinn in New York. And we have seen Palantir, a data collection company, report a big loss. It doesn't seem to be holding back the enthusiasm, though, nor are these markets holding back other businesses from seeking IPOs. Our Abigail Doolittle has more. Abigail?
Well summarized there, Amanda, because lots of worries for the markets. And also with Palantir, that loss, you would think the stock would be down, but not so much. We have a rally for markets. We have a rally for Palantir, although it's been a wild ride for Palantir In the after hours yesterday, initially reacting to that loss and the fact that the revenue growth forecast a little bit less than some had expected, the stock was down more than 5%. Now it's up 6%, but overall a strong first quarter for this company to be reporting as its first publicly traded quarter, I should say. Their sales in the third quarter up 52%. They also did guide to some revenue growth for the rest of the year, but just 1.5%. Initially, investors wanted more, but you can see this stock, since it went public back in September through direct listing, skyrocketing up 150%. So Morgan Stanley actually cut shares to an equal weight from an overweight, citing valuation. But investors really seem to be looking past that at this point, thinking that the trends for this company that actually been around for 17 years, Peter Thiel's data collection company, that perhaps more of the strength will be ahead. And you were mentioning that this is a very strong IPO year, a good year to go public. We had another announcement today that DoorDash plans to go public on the NYSE. Look at all these companies this year that have gone public and the huge gains. Unity Software up 120%, ZoomInfo up 98%, Snowflake up 94%, and Array Technologies up 75%. This year, 2020, with the pandemic and everything else going on, it's amazing, Vonnie. It's expected to be the best IPO year going public company since 1999, which really begs the question, is this the strength that folks are seeing out there, or are companies being urged by bankers to go public while the window is open?
Yeah, exactly. We will get to the bottom of it at some point, Abigail, and looking forward to seeing the DoorDash financials for sure. Going a little more macro, it's been a week for the markets, right? What stands out to you the most?
Well, you know, probably the rotation that everybody is talking about, that rotation out of technology into the cyclicals and value. In fact, if we go into the Bloomberg terminal and we take a look at a great chart here, a value ETF, it is now seeing inflows for the